Welcome to F9 Financial Management. This is the first video in this course, and I will go over the nature and purpose of financial management. So what is financial management? Why is it so important? And why should you learn how to manage an organization's finance? Financial management is the efficient sourcing and use of financial resources to ensure the objectives of the organization are achieved. It includes both short and long-term sources of finance and short and long-term objectives. The purpose of financial management is to create wealth for the business and its shareholders, generate income, and provide an adequate return on investment when taking the risks into account. It involves decision-making in the following key areas: investment decisions on projects that are long-term investments in non-current assets, for example, like a factory, and short-term investments in working capital, for example, ideas for reducing debtor days and increasing cash available. Finance decisions on where the money's needed to run the organization, so the working capital, and to invest in projects can be sourced. The impact and risk of gearing must be considered when making financial decisions. Dividend decisions need to be made about how shareholder wealth should be increased, through a high dividend or by reinvesting cash funds and increasing the value of the shareholders' shares. The financial impact of these decisions on the company value must be considered. Risk management in the company. This area examines the financial risk from exchange rates and interest rate risks. Financial management is a long-term activity involving a long-term view of raising finances, controlling resources, with the objective of achieving an organization's goals. For example, the investment decision to build a factory is one that spans many years. Management accounts are prepared to give information on daily operations so short-term decisions can be made. Management accounting timeframe is much shorter, with organizations preparing them on a monthly or annual basis. There is no standard management accounting format, and businesses will change their format to reflect the information needs. The information needs of management accounts are like those of financial management, and management accounts can be used to monitor and assess the organization's financial management. Both financial management and management accounting are used to ensure the resources are used to achieve the organization's objectives. Financial accounting, in contrast, gives a historical view of the company. It is also used by parties external to the organization, such as government bodies, potential investors, and financial institutions. It does not provide detailed information for operational decision-making like management accounts. The financial accounts are usually prepared on an annual basis and give an overview of the position of the company. They are important when seeking external sources of finance, such as bank loans or private investment. The format of the financial accounts is set by international standards, and financial accounts usually must be produced annually under company law.
Hello. In this presentation, I'm going to look at the role of financial management and, in particular, the central role played by financial management objectives. Specifically, this presentation will cover the role of financial management, financial objectives, financial decisions, financial constraints, and not-for-profit organisations. Let's look at each of these in turn. The role of financial management. If you are asked to define management, or what managers do, you are likely to come up with terms such as control, decision-making, coordination, resource allocation, motivating employees, etc. Whilst these are all valid terms, what do they actually mean? In other words, what or how do we control? How do we know what decisions to make, etc.? Returning to the original question, therefore, all of the terms defined above combine to guide the organisation towards a predetermined outcome. In other words, an organisation cannot think about management until it has identified what it is that it is trying to achieve, i.e., what its objectives are. In the context of financial management, before we can consider the types of decisions that financial managers have to make, we must determine what our financial objectives are. Financial objectives. Firms will usually have a number of objectives, and these are often characterized as primary objectives, the reason for existing, and secondary objectives, the actions which promote the achievement of the primary objectives. For example, improving staff morale may be a secondary objective if it is believed to improve customer service and therefore the profitability of the organisation. Putting that to one side, the primary objective of a profit-making organisation is usually assumed to be the maximisation of shareholder wealth. Maximisation is not ideal in that it is very difficult, arguably impossible, to know when something is as good as it can possibly be. In practice, companies will aim to increase shareholder wealth by a level that is acceptable to them, and this aspect is considered in the cost of equity presentation. Notwithstanding this last point, the maximisation of shareholder wealth can be achieved either by increasing the company's share price or by paying out a dividend. The success or otherwise in achieving this objective can be measured in terms of total shareholder return, which is the dividend yield plus the capital growth, both expressed as a percentage. Dividend yield equals the dividend paid in the year divided by the share price at the start of the year. Capital growth equals the movement in share price during the year divided by the opening share price at the start of the year. Financial decisions. In an attempt to achieve the objectives, financial managers have to make a number of decisions. These can be categorized into three groups as follows. 1. Financing decisions as to how the company will raise the necessary finance. This is considered in the sources of finance presentation. 2. Investment decisions as to where the company will invest the finance raised. This decision can itself be split into three categories, namely working capital, investment appraisal, the improvement in the infrastructure of the existing business, and company acquisitions, the purchase of new businesses. 3. Dividend decisions as to whether companies should reinvest profits earned, referred to as internal finance, or distribute them to shareholders as dividends. Whilst these decisions have been defined individually, it is important to remember that in practice they will impact on each other. For example, the cost of raising finance discussed in the weighted average cost of capital presentation will be a major consideration in determining the viability of an investment appraisal considered in the NPV presentations. Financial constraints. So far we have described how financial managers will make decisions that it is hoped will guide an organisation towards the achievement of its predetermined objectives. It is important to remember, however, that managers' ability to do so freely will often be constrained by other stakeholders who have their own objectives for the company. Examples may include governments may impose regulations around health and safety concerns, or refuse to allow acquisitions if they see them as reducing competition. Banks may impose restrictions, referred to as loan covenants, in an attempt to ensure that loans are repaid. For example, they may limit the size of dividends or restrict the amount of other borrowings. Managers themselves may have their own agenda in terms of their own pay and perks or popularity. This is referred to as the agency problem and may be overcome either by good corporate governance or by incentivizing them in a way that benefits shareholders, for example, share options. Not-for-profit organisations. So far, this presentation has assumed that all businesses are profit-making, or at least trying to be, and that they aim to maximise shareholder wealth. Clearly, this is not the case. Many organisations are non-profit-making, and often these will not have shareholders. Examples will include central and local government, public sector organisations, for example schools, hospitals, etc., charities and so on. This certainly does not mean that finance is unimportant. Indeed, arguably, finance becomes even more important simply because the amount of finance is limited. It may also be the case that there are limited opportunities to raise finance. For example, schools cannot issue share capital, etc. For this reason, it is essential that any money they do have is used well. This is often referred to as demonstrating value for money and is measured in terms of the 3 E's: economy, efficiency and effectiveness. Economy refers to obtaining inputs of appropriate quality at the lowest price. Efficiency refers to maximising the outputs from any given quantity of inputs, and effectiveness refers to the achievement of organisational objectives. As with the 3 decisions outlined above, financing, investment and dividends, again it is the interaction of the 3 E's that is important, and in particular achieving an appropriate balance between them. Thank you.
Welcome to F5 Financial Management. In this video, I will go over the stakeholders and impact on corporate objectives. A stakeholder is somebody who has an interest in the business. It doesn't have to be a financial interest. With such a broad definition of stakeholders, there are many in a business. Let's look at a few found in most businesses. Ordinary shareholders are also called equity investors. They own the company and take on the most risk. Shareholders are taking a higher risk by investing their money in a company rather than leaving it on deposit in, say, a bank. Therefore, they expect a higher return than the returns offered by risk-free investments. Their main objective is to maximize the value of their investment, be that through dividend income or increasing share value. They have long and short-term objectives. The organization's directors. They manage the company on the shareholders' behalf. Their short-term objectives would be profit maximization, leading to increased bonuses, and in the long term, fending off takeovers. The organization's employees and the trade unions that represent them. Their objectives are fair salaries and safe working conditions in the short term. Job security and pensions would be a long-term objective. Customers. They want a quality product or service that gives value for money. Suppliers' short-term objectives are to supply the organization and get paid on time. Their long-term objectives would be to build long-term relationships and get repeat custom. Finance providers. Their objective is to get the loan they made repaid in full with interest. They are interested in the organization's ability to generate cash for this repayment in the short and long term. Government agencies. Their interests are many. They want to ensure that the organization is following the relevant legislation such as tax, employment, health and safety. The government also has an interest in the organization's employment levels, encouraging these and motivating the organization to increase its exports. The community at large. This is a broad stakeholder. Their objectives is that the organization has a positive impact on its surrounding community and environment. There can be conflict between the stakeholders of an organization because their objectives can be competing, and it is not possible to meet all the stakeholders' objectives. For example, between shareholders and directors, shareholders want to maximize their investment and may not agree with the directors' methods or their salaries, which are decided by often an independent remuneration committee. We will look at this conflict in the next slide. The organization wants to maximize its profits, and salaries are expenses that eat into these profits. Another conflict that would arise between staff and the organization. Other conflicts arise when it does something that is unpopular in a community. For example, a business wants to build a factory in a green space. Local community groups protest because it is ruining the landscape and increasing pollution in the area. The local government welcomed the decision, however, because it provides jobs. Agency theory. As I said, the owners of the organization are the shareholders, but often they don't manage their businesses. This is done by the directors. The director's job is to act in the best interests of the shareholders. However, they may not always do this and could act in their own best interests. For example, deciding to maximize short-term profitability, so they will receive higher bonuses at the expense of long-term growth for the organization, and higher share prices in the long run for shareholders. Agency theory deals with problems arising due to the competing objectives between the principal and the agent, i.e. between the shareholders, who are the principal, and the agents, who are the directors. To avoid agency problems, the objectives of the shareholders and the directors should be aligned. This can be done by basing the directors' bonuses on the organization's net profits and relating the directors' pay to their achievement of the shareholders' objectives. However, beware, because sometimes focusing solely on the short-term net profits can encourage short-term thinking on the director's part. Another option is also to give the directors share options in the company. By giving them share options in their remuneration package, they now are shareholders and their objectives are now in line with the shareholders. Measuring corporate achievements. The main objective of most organisations, as I've said, is to maximise shareholders' wealth. The directors need to put a plan in place and targets to chart the progress of the organisation. But how can they measure their progress? Progress and achievements are measured by looking at the following ratios: return on capital employed, return on equity, earnings per share, dividends per share. You should already be familiar with some of these ratios. Please refer back to F3 ratios if you want a quick refresher. Now, let's look at an example. These are the financial statements of Top Dog Inc. for the years ended 20x7 and 20x6. How do you get good at calculating ratios in your exam? By practicing. Please pause this video and calculate the return on capital employed, return on equity, earnings per share, dividend per share. Have you done them? Okay. So starting with calculating the return on capital employed. This ratio is very important to investors because they can assess how much profit is being generated for the amount they invested. It can be used to compare the returns offered by different companies. The formula to calculate it is profit before interest and tax divided by the capital employed, and then getting the percentage. Capital employed is measured as equity plus interest-bearing finance, so long-term loans plus share capital and reserves. Here you can see 20x7 and 20x6 return on capital employed. So for every $1 invested, the shareholders are getting back about 6% in 20x7 and 5 cents in 20x6. I am assuming that no accounting policy changes have occurred during the year, so I can compare them. The increase is a good indicator. The organisation will use this ratio to assess their efficiency at converting revenues into returns for their investors and to measure their progress towards their target return. They can also benchmark against other organisations in their industry. Shareholders will look at the return offered at Top Dog and what risk-free investments are offering, and the returns offered by other companies. The return on equity is calculated by dividing profit after tax and dividends by ordinary shares and reserves. Top Dog has no preference dividends, so we can just take the profit after tax. Again, we can see that the return on equity has increased slightly. This ratio measures how much profit a company generates for its ordinary shareholders with the money they have invested in the company. It is similar to the previous return on capital employed, only profit after tax is used rather than operating profit, and it looks only at the equity invested, whereas the return on capital employed also took debt into account. As you can see, Top Dog took on long-term debt in 20x7, so it is more geared than in the previous year. This impacted the return on equity, which is sensitive to gearing. Directors may feel the return on equity does not reflect their achievement to maximise shareholders' return, as the profit after tax is used and tax rates are outside their control. Also, solely looking at profits, like with the return on capital employed, is a very short-term viewpoint to take, and long-term investments that grow shareholder wealth may be ignored. The return on equity ratio is useful to benchmark against similar companies who are applicable to the same tax laws. Earnings per share. The earnings per share are calculated by dividing the profit after tax and preference dividends by the number of ordinary shares in the company. The result is the amount of profit per share. For Top Dog, this increased to 40 cents a share in 20x7 from 33 cents in 20x6. This increase is good and reflects the increase in profits. However, it does not reflect the actual earnings received by the shareholders. It just shows the shareholders' share of the profits after tax. Earnings per share is not a useful comparison tool to compare other companies. However, the growth in earnings per share is something that can be compared. Dividend per share. This is calculated by dividing the total ordinary dividend by the total share capital issued. If there are any special one-off dividends paid in the year, these are deducted from the dividend figure. Topdog did not issue any special dividends in the year, so there is no deduction, and we see that the dividend has increased dramatically. In 20x6 it was 10 cents a share, and 20x7 it was 25 cents. The dividend in Topdog increased by 150%. This is a huge increase. Investors want to see a regular dividend, and because the companies are reluctant to increase dividends, even for a particularly good year, because they may not be able to sustain it during leaner years. Therefore, by increasing a dividend, this sends a good message to shareholders that the company believes that its current profitability and dividend, which is increased, is sustainable. This would cause share prices to increase. If a dividend rates were to fall, then this would send a negative message to shareholders, indicating the profits are reducing and the company does not see the situation improving in the foreseeable future. This would cause the share price to fall. A lot of planning and forecasting goes into the dividend policy. An organization's dividend policy depends on its shareholders' profile. Some shareholders don't want to receive a regular income from their investment, instead wanting the money to be reinvested in the organization, which will increase the value of their shares. This could be due to higher tax rates on dividends versus the capital appreciation on their shares. And some shareholders invest in shares to generate a regular income. Shareholders will look at companies' dividend policies in the past and invest in it if it matches their needs. So changes in the dividend policy can cause shareholders to sell their shares and invest their funds elsewhere. This can cause share prices to fall and leave the company open for a hostile takeover. The company's dividend sends a message to the shareholders, and it should be a consistent one. A shareholder's return on investment is made up of the dividends and capital gain on the value of their shares. How do we measure it? Let's say the share price of Topdog was $5 in 20x7 and $4.50 in 20x6. You know that the dividend paid in 20x7 was 25 cents. You can then calculate the total shareholder return. So it is the current share price less the previous year's share price, add on the current year's dividend, and then divide it by the previous year's share price, and then make it a percentage. So it is 16.66% for Topdog. Corporate governance. As you know, there is a separation between the owners and the management. Directors have a fiduciary duty to the shareholders to act in their best interests. However, over the years there have been countless corporate scandals where directors have acted unethically to inflate profits and share prices. Organizations should implement corporate governance codes of best practice. These have the following impact. Corporate governance codes increase directors' accountability. They aim to reduce the shareholders' risk due to unethical behavior. Directors' salaries should be decided by an independent remuneration committee. These codes ensure a more balanced board of directors by having non-executive directors who are independent and not involved in the daily operations of the organization. The chairman of the board of directors can never be the CEO. these roles are separate. The chairman should be an independent when they are appointed. Although corporate governance is not obliged under law, in most countries, companies usually must comply with corporate governance codes of best practice to gain a stock exchange listing. A stock exchange listing means that the company must produce financial reports annually that give detailed information about the directors' salaries and pay attention to their corporate social responsibilities. Welcome to F9 Financial Management. In this video, I will go over the financial and other objectives in not-for-profit organisations. A lot of this syllabus was covered in F5, so please refer back to F5 Performance Analysis in Not-for-Profit Organisations and the Public Sector to refresh yourself. There, I examine the qualitative nature of not-for-profit objectives and other aspects. Not-for-profit's goal is to provide for a need in society on a continuing basis and not to maximise shareholder wealth. The contributors of capital to these organisations are unlikely to get a benefit from it. This is very different from a for-profit organisation, and all the company objectives are affected by the organisation being a not-for-profit rather than a for-profit. So wealth maximisation is not important to donors, and so not an objective, but value for money and stewardship are. Not-for-profit's income is irregular and unpredictable, so achieving funding is a key objective of these organisations, as well as getting value for money. Stewardship is where money received for a certain purpose is used for that purpose, and that purpose only. For example, if a government transport department received government funding to build a road, that is where the money must be spent, not on finishing off, say, a railway station. Performance measurement is measured using financial and non-financial indicators. Non-financial data is very important in a not-for-profit to measure the achievement of non-quantifiable goals. In a traditional business, performance management is very important, and there is a motivation to undertake it for management bonuses and appraisal, as well as the good of the organisation itself. As not-for-profits often have a lot of volunteer staff, performance measurement may not be seen as a priority, or it may even be seen as a waste of time and resources. It is, however, important for the organisation's success and the achievement of its objectives.
Hello. In this presentation, I'm going to look at the circular flow of income. The circular flow of income is a diagrammatic representation of the economy, the main players, the terminology, and some of the approaches that might be adopted by governments in an attempt to manage the economy. Whilst this is not intended to be a detailed economics lecture, it will provide an overview of the economic environment within which companies operate and highlight how actions taken by governments can affect the operations of companies. Specifically, this presentation will cover the economy in its simplest form, monetary policy, fiscal policy, balance of payments, and other policies. Let's look at each of these in turn. The economy in its simplest form. In its simplest form, the economy has two players: firms who manufacture goods and households who supply the factors of production, such as labour and capital. To show this diagrammatically, households supply labour to firms, which in turn allows firms to manufacture goods which they supply to households. As goods and services flow in one direction, the associated money flows in the opposite direction. As such, households receive wages in return for supplying their labour, and this means they can pay for the goods provided by firms. This is referred to as consumption. For this presentation, we are only interested in the flows of money. We now have a continuous circle of money flowing around the economy, and this represents the size of the economy. Governments will want to grow the economy, i.e. the volume of money flowing around the circle, and increase employment. However, they will wish to avoid creating inflation, which arises when households are demanding goods at a quicker rate than firms can supply them. Governments can attempt to address inflation using either monetary or fiscal policies, and we will now look at each of these in turn. Monetary policy. As discussed above, in simple terms, inflation is caused when demand outstrips supply, and consumers end up competing for limited supplies, which pushes prices up. In response to this, governments will want to stop consumers spending, and one approach is to encourage them to save instead, which they can do by increasing interest rates. To reflect this aspect of our diagram, we need to introduce a new player to the economy, banks. Banks and other similar institutions take deposits from savers and use these to provide borrowings to lenders, both households and firms. Governments, through central banks, may choose to take some of the money saved out of circulation, thereby reducing the money supply, the amount of physical money in circulation. This combination of using interest rates and the money supply to control inflation is referred to as monetary policy. High interest rates can impact on companies in a number of ways. Sales may fall as consumers save instead. This is likely to affect companies providing luxury items more than those providing necessities. The cost of borrowing for consumers will increase, which may reduce disposable incomes. For example, the cost of existing loans may take up a bigger proportion of their income as interest rates rise. And this will make it harder for consumers to afford large items for which loans may be required. The company's own borrowing will be more expensive, which may make the investment in infrastructure more expensive. Fiscal policy. An alternative approach that governments may adopt in an attempt to reduce consumer spending is to increase taxes, such that households have less disposable income. The money generated by the government can then be used to redistribute wealth by providing benefits to households, or stimulate sectors of the economy through government spending. For example, if the government decides to build a hospital, not only is this a worthwhile project in its own right, but will also create jobs in the construction industry. There are, of course, other things that governments can spend money on. However, these are the key choices in this context. From the perspective of firms, their sales and profits are likely to suffer as disposable incomes fall, and this will hit hardest at firms who provide luxury products. Balance of payments. Balance of payments refers to the relative size of imports and exports. Given that we are focusing on movements of cash as opposed to goods and services, exports are an inflow to the circle, whilst imports are an outflow, as money is paid to overseas firms in return for goods purchased. As such, it is extremely difficult for a country to continue long-term in a situation where imports exceed exports, and this situation is referred to as a balance of payments deficit. Faced with this situation, governments may try to make our exports more attractive to foreign customers, and imports from foreign suppliers less so, by manipulating exchange rates. Clearly this will be helpful to companies trying to export their goods, however, can equally increase the costs of firms who import raw materials. Governments could also try to artificially increase the cost of foreign imports by charging import duties or levies. However, their ability to do so may be challenged, for example by the World Trade Organization, and this aspect is not considered further here. Finally, governments could attempt to reduce consumer demand overall. However, given the previous paragraph, this may affect domestic firms as much as foreign ones. Other policies. Finally, there are other government policies that could potentially impact on the decisions and actions of firms. These include competition policies that may veto acquisition or mergers on the ground that they would afford the firm too much power and be bad for consumers. Environmental policies may force companies to change processes or to build in safety checks to existing processes. Either could increase the operating costs. Conversely, governments may offer consumers grants, for example for loft insulation. These may create an opportunity for firms able to offer such services. Finally, health and safety policies and employment legislation may also require process changes and increased costs. However, could also provide a competitive advantage for firms who already have high standards in these areas. Thank you.
In this video, I will go over the nature and role of financial markets and institutions. Financial markets are where financial securities like stocks or bonds can be bought and sold, and commodities can be bought and sold. High value commodities like, say, gold. Financial markets are where those who need funds can meet those who have funds, and they will supply these funds for a return. So a company who needs to raise money can go to the financial markets and sell securities or bonds that offer a certain rate of return. Investors will buy these securities if they meet their required return. Financial markets facilitate organizations to raise capital, to manage risk or transfer it. For example, like foreign exchange risk can be managed with the derivatives market. International trade, so by enabling organizations to buy foreign currencies in the currency markets, enabling them to trade internationally. As I already said, match those who need capital with those who have it. Capital and money markets. So what are capital markets? They are where debt and equity are traded. They are markets where longer-term investments are sold. The organizations who seek finance from these markets are seeking long-term finance. The main securities sold in capital markets are public sector and foreign stocks, company securities, and Eurobonds, also called international bonds. These are bonds that are in a currency that is not the national currency of the issuing company. So a US company could issue an international sterling bond. There are national and international capital markets. National markets tend to be smaller. International markets enable organizations to access foreign currencies. The main international markets are the euro markets and the foreign bond markets. The euro market is an international capital market organized by international commercial banks, where financial institutions buy and sell currency deposits that are not held in their country of origin. Companies who have a high credit rating can raise finance in a foreign currency. Money markets are used by companies to access short-term funding for, say, liquidity and working capital purposes. They offer investors shorter-term investments where deposits that are not needed now but may be required in a year or so. These deposits can be invested and earn a return for the company or the investor. Financial intermediaries. You now know the financial markets are where those needing finance can meet those who have the funds to invest. But the market is full of all different types of organisation and investor. The role of the financial intermediaries is to bring these parties together. Through an intermediary, investors can put their money and it is invested on their behalf. So the receiver receives the money indirectly because it comes through the intermediary. Typically it works like this. People and organisations with funds deposit their funds with an intermediary. For example, you deposit your savings with a bank. This is an intermediary financial institution who lends out your funds to borrowers at a higher rate of interest that you will earn for your deposit. Although your money has been loaned to a borrower, you will have no contact with the borrower. Examples of financial intermediaries are banks, building societies, finance companies, pension funds, insurance companies, and investment trusts. These intermediaries fulfill the following roles. They aggregate small investors' deposits together to supply a large borrower. So, for example, a pension fund may be made up of lots of investors who have each put in, for example, $1,000 invested. But the total value of all these investors could be $1 million. This $1 million can be invested into one big borrower. Individually, these investors would not have been able to invest in such a big project. Risk transformation. This is where investors' funds are attracted to low-risk securities. They are then issued to the borrower, who is a higher risk. Sound confusing? So, think about a normal merchant bank. They offer you a 3% interest return on your deposit and a guarantee that you will be returned your deposit within 1 week of requesting it. So it is a low-risk security for your funds. The bank, in turn, would issue your funds to a high-risk investor. In finance, the higher the risk, the higher the cost of finance, or the higher the return must be for the investor. This high-risk loan will be issued to a borrower at, say, 20%. Your money has been loaned out at a 17% more return than you receive for it. This is because the intermediary is taking the risk. Maturity transformation. Often those who need finance need it for a longer period of time than the investor has the finance available. So take, for example, somebody wanting to buy a house. They save their funds for a year. They deposit these funds with an intermediary for a year. The intermediary issues these funds to a long-term borrower, say for 20 years. Even though the two parties' timeframes are different, it is okay because the financial institution is receiving deposits from other investors when the person who wants to buy their house, the original person, withdraws their funds. Other deposits can be used. So the intermediary in this situation can satisfy the borrower's finance maturity needs and the investor's. What is a stock market? A stock market is also called a stock exchange. It is a collection of markets where equity is issued and traded. The role of the stock market is to facilitate companies issuing equity to investors, facilitate the trading of shares and stocks. The stock market offers security to investors and companies by acting as a clearinghouse for the transactions, which ensures payment from the purchaser of shares and delivering of the shares from the companies selling them or issuing them. Shares can be traded easily on the stock market. This means that investors can quickly sell on their investment, making it more attractive to invest. Here's an example of what can be traded on the stock market. Issued shares of public companies, which are equity, corporate bonds, this is a debt instrument that can be traded as well, it's issued, government bonds, and local authority loans, again debt. What is the corporate bond market? A corporate bond is a form of debt financing issued by a company directly to an investor that offers a rate of return. So the company has issued a bond instead of, say, going to a bank for a loan. These are sold by the corporation to raise finance. Bonds can be secured. This means that they can use a specific asset for collateral. This reduces their risk. Unsecured bonds do not have collateral backing on them. Only the issuing companies promise to pay. Governments also issue bonds called government bonds. Government bonds are considered to be less risky than corporate ones, so offer a lower return. When discussing the rate of return of bonds, you talk about bond yield. A bond is different from shares because it is a debt instrument. When an investor invests in a bond, they will get the yield from the bond, but they will not own shares in the company like they would if they had bought equity in the company. Corporate and government bonds are issued on a specific market, the bond market. This is a primary financial market where companies and governments can issue the new debt. Once issued, they can be traded on a secondary market like the stock exchange. I've touched a little on the concept of risk and return. Investors invest to make a return. When they invest, they must assess the risk of 1. Not making a good enough return, and 2. Losing the funds they invested. Investments are categorized according to their level of risk. The general rule of thumb is the higher the risk, the higher the expected return. Let's go over some common securities traded on the financial markets and the risk attached to them. Treasury bills. These are short-term debts sold by a government at a discount. Because they are short-term, they are considered low risk. Long-term government bonds. The level of risk attached to them depends on the financial stability of the country issuing them. Their value will fluctuate in line with the changes in the country's interest rates. Because they are riskier than treasury bills, they have a higher rate of return. Corporate bonds, again a long-term debt instrument. These are riskier than the previous two because a country is less likely to default on paying their bondholders than a company. To protect investors, bond agreements can contain many restrictive covenants. Bonds are credit rated, and the higher or better the rating, the lower the perceived risk. Secured bonds are considered less risky than unsecured bonds. Junk bonds are risky investments and their risk of default is high. Therefore, these high-risk investments offer high returns to an investor. Preference shares. You should already be familiar with preference and ordinary shares. Please look back at F4 share capital if you need to refresh yourself. Preference shareholders are paid ahead of ordinary shareholders and often at a fixed rate, so they are less risky than ordinary shares. Ordinary shares carry the most risk, and when a company is wound down, they are the last to get paid. But they also can make the highest returns. Returns and losses are determined by the rise and fall of the share price on the stock market. In this video, I will go over the nature and the role of the money market. The money market was introduced in the earlier section. The nature of financial markets and institutions. Please go back and review this section now. The money market is the global financial market for short-term borrowing and lending. Investments tend to last up to 12 months. Companies and governments issue short-term debt on the money market. They are considered to be secure investments, so offer a low rate of return when compared to the returns offered by long-term investments on the capital market. On the money market, the following can be traded: treasury bills, commercial paper. These are short-term unsecured debt issued to fund short-term debts of an organization, like trade receivables, bankers' acceptances. Another short-term debt instrument that is guaranteed by a commercial bank, similar to a treasury bill. The money markets provide an important role for public and private sectors. Firstly, by allowing private and public organizations to raise short-term cash for liquidity. For example, to fund short-term payables such as inventory or payroll expenses while they are awaiting cash, for example from the sale of said inventory. These investments are also considered very liquid by investors, so attractive as short-term investments. Companies need to have liquidity in their organization to enable them to speculate, so take advantage of opportunities for emergencies and for their normal transactions. The money markets enable this by offering liquidity and short-term trade finance. The money markets also allow organizations to manage their exposure to foreign currency risk and interest rate risk. Managing foreign currency risk is covered in managing exchange rate risk. Please look at this section to understand how organizations can use the money markets to reduce foreign exchange risk with forward contracts, futures, and options. Managing interest rate risk is covered in Managing Interest Rate Risk section, where this risk can be managed using futures and options, types of derivatives that are available on the money markets. So the money markets offer very important services, but what are the financial institutions' role in the money market? They act as financial intermediaries. Their role was examined in an earlier section, the nature and role of financial markets and institutions. I advise you have a look at it now. The main advantages of the financial institutions is they reduce the cost of the transactions. On an individual level, this would be very high, but financial institutions have large volumes of transactions, so they reduce the transaction costs of the money markets through economies of scale. They can reduce credit risk. For example, an individual with $200,000 to invest will have to engage a specialist or many specialists to assess the credit risk of various investments options. This will be costly and will quickly eat into their investment monies. A financial institution often has access to these specialists in-house and has experience in investing in specific areas, so can produce more credit risk information at a cheaper rate, reducing this credit risk to the investor. Banks and other financial institutions can also convert their illiquid assets into marketable securities and sell them on. These are usually attached to an underlying asset. This is advantageous for the financial institution. In recent years, financial institutions have received a lot of bad publicity for this practice, particularly in countries affected by the recent mortgage crisis. Illiquid assets, such as long-term loans like mortgages for personal homes, can be grouped together and sold as mortgage-backed securities. These are long-term loans backed by the asset, a person's home. The investor who buys this security from a financial institution has the security that if the borrower defaults on their loan repayments, they can sell the underlying asset, i.e. an individual's home. These securities were traded internationally and caused political tensions when homeowners realised that their debt was sold onto an international institutional investor without their knowledge. This conversion of illiquid assets like long-term debt to a marketable security is called securitization. Now you have a clear understanding of what the money markets are. Let's look at what is commonly sold on them. They can be divided into the following categories: interest-bearing, discount instruments, and derivative products. Interest-bearing products are any products that bear an interest to their owner. Examples of these are certificates of deposits, which are abbreviated to CDs. These are certificates for amounts deposited with a bank for a specific time and rate. There are two types of certificates of deposit. They are negotiable, meaning that they can be sold by the bearer before the time is up, i.e. if the bearer needs their deposit back before the deposit's maturity date, they can sell their investment. Then there are non-negotiable CDs. These pay a set interest rate, called a coupon, and repay the capital as normal. They cannot be readily sold by the investor. Repurchase agreements, also called repos, are where two parties agree to buy or sell an instrument at an agreed price and then repurchase back at an agreed price at a set time later. To the party selling the security and agreeing to repurchase it at a later date, it is called a repurchase agreement. But what about the buyer who are buying something that the seller promises to buy back from them in the future? Therefore, they will call it a reverse repurchase agreement. These can be very short term. Bank deposits. These are deposits made to a bank. You should already be quite familiar with these, and they were covered in the previous section, the nature and role of financial markets and institutions. Government securities are bonds issued by a government authority. These were also covered in the earlier section. Local authority bonds are fixed interest bonds that are repayable on a specific date, used by local authorities to raise a loan. These are similar to Treasury bond. A non-interest bearing security traded on the money market would be a bill of exchange, which is an unconditional promise to pay a specific sum either on a future date or on demand, so it can be called in at any time. They can be sold to third parties after their creation. Discount instruments. Discount instruments don't pay interest to investors. Instead, they are sold at a discount to investors. So, for example, an organization issues a security of $100, available at a 20% discount. That means that it is being sold for $80 On maturity, $100 will be paid to the investor. The difference is the income for the investor. Unlike interest-bearing investments, where investors must wait to receive interest, investors can get their gain at the beginning when they buy the product. The following instruments are discount ones. Treasury bills, which are issued by governments at a discount on their face value. Commercial paper. These are issued by big organisations with a very good credit rating. They are unsecured for a short period of time, usually for 30 days or so. These organisations use them to fund short-term investments. Bankers' acceptance. These are issued by companies like commercial paper, but a bank guarantees them. They are guaranteed because the organisation may not have a good enough credit rating to offer a commercial paper. The guarantee makes them more secure, so the return offered will be low, but the organisation will have to pay a fee to the bank for that guarantee. These can be traded on the money market before maturity. Derivative products. I have already mentioned that they can be used to manage currency and interest rate risk, but what exactly are they? They are contracts between two parties. Their price is determined by an underlying asset. Assets such as currencies, interest rates, bond and market indexes. The value of the derivative is affected by fluctuations in the value of the asset. There are many different kinds of derivatives. Future contracts, or just called futures, are the most common. They are used to hedge against risk over a certain time. For example, ABC Limited is a UK company that is committed to buying a US shopping mall. They will need to pay $10 million in 1 year's time. ABC's currency is British pound sterling, and they want to use derivatives to manage the risk of dollars going up in value against their base currency, which is British pound sterling. They agree to buy $10 million for £8.5 million, which is the current exchange rate, from Z Limited. Z Limited speculates that the dollar will lose value over the next year and that they will make a profit on this exchange. After 1 year, $10 million is worth £9 million due to the sterling falling in value. This means that ABC has benefited from this forward contract and Z Limited has lost out. As well as future contracts, there are forwards. They are like futures but are traded over the counter and not on a stock exchange, often through dealers. Swaps are another form of derivative where two parties contractually agree to take on the other's, for example, loan liability. So if ABC Inc. is paying 5% fixed rate interest on a loan and they expect interest rates will go below 5%, they can swap their loan rate with QTZ Incorporated, who have a variable loan rate. The underlying loan agreements remain the same, but ABC will pay QTZ's loan and they will get a variable interest rate, and QTZ will pay ABC's loan. If interest rates go above 5%, ABC has lost out because they must pay a higher interest rate. And finally, options. These are similar to futures. The key difference is the buyer or seller can decide not to go ahead with the transaction if they don't want to. An option can be short, where an investor expects the value of the asset to fall. They sell shares of borrowed stock. This works by the investor borrowing shares from a dealer and paying interest for this loan. They sell the shares for the current market price on the open market, receiving cash for their sale. If the share price falls, they will then buy the same amount of shares back and give them back to the broker. The only cost is the interest they paid on borrowing the shares. If the shares increase in value, the investor loses out and owes the brokerage firm. A long option, in contrast, is where the investor owns the stock and expects the prices of the asset to rise. A call option gives the investor the right, but not the obligation, to purchase a stock or a bond, etc., at a specific price within a specific time. That means that the investor gains if the asset value increases from when they put the call in place, because they can access the asset at a lower rate. Or a put option. This is the opposite of a call because it gives the seller of the asset, not the investor, the right, but again not the obligation, to sell their securities at a specific price and in a specific time frame.
Hello. In this presentation, I'm going to take you through an introduction to working capital. The management and financing of working capital are the subject of separate presentations. Specifically, this presentation will cover what is working capital, what are the objectives when managing working capital, how do we measure it, and why is it important. Let's look at each of these in turn. What is working capital? Working capital, or net current assets, is represented by current assets minus current liabilities. In their simplest form, current assets will include the inventory that is sold, the receivables due from customers in respect of sales made on credit, and cash. Current liabilities will include payables owed to suppliers in respect of purchases made on credit. Collectively, it reflects the short-term investment that companies make in their day-to-day operating infrastructure. It has been described as the lifeblood of an organisation. In other words, businesses cannot survive without it, and whilst its significance will vary from one type of entity to another, most, if not all, organisations will require some level of investment in this area. Objectives of working capital. There are two objectives: one, profitability, and two, liquidity. Profitability can be improved if a company appears attractive to its current and potential customers. A customer who likes a company will buy more and, conceivably, be prepared to pay more for what they do buy. A company can appear attractive by offering generous credit terms or by holding lots of inventory. High inventory levels suggest that a business can offer a wide choice and/or fast delivery. Liquidity refers to the amount of cash and cash equivalents that a company can rely on when meeting financial obligations, i.e. paying the bills. Unfortunately, these two objectives conflict. For example, to promote profitability, a company may use all of its cash resources to acquire inventory. However, having done so, they then have no way of settling debts. Accordingly, working capital management is concerned with finding the right balance, i.e. investing enough to attract customers whilst at the same time maintaining sufficient liquid resources. The compromise required can be depicted by the cash operating cycle, and this aspect will be discussed in more detail in a separate presentation. How do we measure it? The simplest measure of working capital is the current ratio, calculated as current assets divided by current liabilities. For example, a company with current assets of £200 and current liabilities of £100 has a current ratio of 200 divided by 100. This indicates that they can meet their short-term liabilities twice over. But let's look at this relationship in a little more detail. Assume that a company has current assets of £500, comprised of cash of £50, receivables of £100 and inventory of £350. It also has current liabilities, represented by payables, of £250. As above, the current ratio is 500 divided by 250. However, let's consider the practicalities of the situation. Imagine that all of the suppliers to whom we owe money, £250 worth, turn up on our premises demanding payment. The only way to satisfy the immediate demand is to give them cash. However, we only have £50, which still leaves £200 worth of liability. Our next approach is to persuade the suppliers that we are owed money by our customers, and that as soon as we can recover that, we will settle with them. This should buy us some time. However, we are only owed £100, and even if we can collect all of it, we will still owe a further £100 to our suppliers. The only resource now left is inventory. However, can we turn inventory into cash quickly enough to keep our suppliers happy? The only true answer to this last question is it depends. It depends on what the inventory is and the line of business you are in. If you are a supermarket and inventory is loaves of bread, they were baked this morning and are cash in the till by lunchtime. If, however, you are a construction company and inventory is bags of cement, this will take much longer to turn into cash. Notwithstanding this debate, it may be more appropriate to exclude inventory from the current ratio. So current assets minus inventory divided by current liabilities. This more prudent view is called the quick ratio or asset test. There is no such thing as a single correct or optimal value for the current or quick ratios. However, we can get a feel for the appropriateness or otherwise of the ratios by comparing them to industry averages or similar companies in our industry. Why is it important? As described above, companies need to find an appropriate balance between the conflicting objectives of profitability and liquidity. Failure to get this balance right can have damaging and potentially catastrophic consequences. An organisation that invests too much in working capital is sometimes referred to as overcapitalised. Conversely, a company that does not invest enough, with insufficient long-term finance to support it, is said to be over-trading. Thank you. Hello. In this presentation, I am going to take you through the working capital cycle, also known as the cash operating cycle or cash conversion cycle. The working capital cycle refers to the period of time that a company is deprived of cash during a normal business operating cycle, and can be used to measure the level of money tied up and the associated cost to the company. This session provides further detail to that provided in the Introduction to Working Capital presentation, and it may be beneficial to watch that one first if you have not already done so. Specifically, this presentation will look at an explanation of the components of the cycle, negative working capital cycle, the importance of the cycle, how to measure the cycle, an interpretation of the cycle, and the sales to net working capital ratio. Let's look at each of these in turn. The components of the cycle. Imagine you are going to undertake a production process. Firstly, you will need some raw materials, and so will order some from your supplier. Upon receipt, these will be placed in the warehouse until you are ready to start producing, and will show in the accounts within raw material inventory. When you're ready to start producing, the materials will physically be transferred from the warehouse to the factory, and in bookkeeping terms will be moved from raw material inventory into work in progress or WIP. Other costs incurred, for example labour and overhead, sometimes referred to as conversion costs, will also be added into the WIP account. By the end of the process, the materials have been turned into products available for sale and are moved back into the warehouse or other appropriate area to await a customer. In the accounts, the relevant amount is now showing as finished goods inventory. At such time as the goods are sold, the value will be charged to profit or loss as cost of sales. However, assuming the sale is made on credit, no money is received from the customer at this stage. Instead, the amount owed to us by the customer is added to receivables. Effectively, the costs incurred are still shown within current assets, albeit now include a profit element, i.e. are based on sales value, and have been moved from inventory to receivables. Finally, the customer settles the debt, the amount is removed from receivables, and the company has received some cash. Whilst it will vary considerably from one industry to another, it is conceivable that many days will have passed between receiving the original raw materials and receiving the customer's settlement. The only offset to this is that assuming the company is itself creditworthy, it is likely to obtain the materials on credit, such that no cash will be paid out upon receipt. Rather, the amount owed to the supplier will sit in current liabilities as a trade payable for a period of time until the account has to be paid. Despite this, it is likely to be the case that for most businesses, cash for the raw materials will be paid out before cash relating to the eventual sale is received. It is this period between cash being paid out and received that is referred to as the working capital cycle. A negative working capital cycle. Notwithstanding the previous scenario, it is conceivable that an organisation could receive money from its customers before they are required to pay their suppliers. For example, a supermarket will hold items in inventory for a very short period, especially in the case of perishable food items. They will sell items for cash so that receivable levels are also short. Even where credit cards are used, the vendor will usually receive cash from such transactions within a few days. Finally, supermarkets have the power to negotiate extended credit terms with its suppliers, resulting in long periods of payables. This situation is sometimes referred to as a negative working capital cycle. The importance of the working capital cycle. In a previous presentation, an introduction to working capital, it was explained that profitability and liquidity were the objectives of working capital management. To date, this presentation has described that it is usual for a business to pay out to its suppliers prior to receiving in from its customers. The period between these 2 points is referred to as the working capital cycle and clearly puts pressure on the liquidity of the business as it is left with no cash with which to pay the bills. Additionally, there may also be an adverse impact on profit, as the company may need to borrow money to finance this period. The eventual cost of this borrowing will be influenced by both the amount of cash borrowed, i.e. tied up in working capital, and the length of time it is tied up for. Accordingly, it is important that both aspects can be estimated. Measuring the cycle. The amount of money tied up in the working capital cycle, and therefore the amount that is needed to be borrowed, is equal to the net current assets, i.e. current assets represented by inventory and receivables, minus current liabilities represented by payables. In order to establish the length of time money is tied up for, it is necessary to calculate the number of days for each element individually. Once these have been calculated, the working capital cycle can be calculated as receivable days plus inventory days minus payable days. Receivable days will equal trade receivables divided by credit sales multiplied by 365, the number of days in a year. Effectively, if receivables are £90 million and sales are £360 million, this suggests that a quarter of the year's sales are still outstanding, which equates to 3 months or approximately 91 days, a quarter of 365. On the same basis, payable days equals trade payables divided by credit purchases multiplied by 365. Raw material days equals raw material inventory divided by raw material usage multiplied by 365. WIP days equals WIP inventory divided by costs of production multiplied by 365, and finished goods days equals finished goods inventory divided by cost of sales multiplied by 365. Depending on the accounting information readily available, it may be easier and or necessary to combine the raw material, WIP and finished goods days into one inventory calculation expressed as inventory days will be inventory divided by cost of sales multiplied by 365. Interpreting the cycle. In arriving at the above days, a number of estimates and assumptions need to be made. For example, credit sales and purchases may not easily be separable from total sales and purchases, and so the days are often based on totals. Similarly, raw material purchases may be used as an approximation of raw material usage. Additionally, the year-end values may not be representative of normal operations. For example, inventory levels may be high in preparation for a new product launch or an upcoming sales campaign. For these and other reasons, the number of days calculated may not be completely accurate. Having said that, unless there is a dramatic change in the way the company operates, they are likely to be consistent from one year to the next. Accordingly, whilst the number may not be totally reliable, the trend should be, and so companies will often use the trend or movement in the days to assess the impact of control actions taken. There is no single correct answer as to what the various days should equate to. However, they are likely to be influenced by industry norms. Consequently, companies will often use industry averages or data from similar companies in the industry to gauge the appropriateness of the levels. More specifically, receivable and payable days ought to reflect the credit terms agreed with customers and suppliers respectively. Where this is not the case, tighter management controls may be required, and management of receivables and payables will be covered in more detail in a separate presentation. Sales to net working capital ratio. The sales to net working capital ratio shows the sales that can be generated from an investment in working capital of £1. For example, if a company has inventory of £100,000, receivables of £200,000 and payables of £120,000, this equates to net working capital of £180,000, 100 plus 200 minus 120. If sales are £1,260,000, this suggests that £1 of investment in working capital generates £7 of sales, 1260 divided by 180. The significance of this number is that it enables the company to estimate the additional investment that will be required as sales grow. For example, if sales are forecast to grow by £140,000 to £1.4 million, an additional investment of £20,000, 140,000 divided by 7, will be required, bringing the total investment to £200,000. A company that fails to plan for this requirement is effectively trading beyond its means or over-trading. Thank you. Hello. In this presentation, I'm going to look at the management of inventory. Inventory, or stock, refers to the raw materials input to a process, the finished goods that will be sold to customers, and work in progress whilst it is being transformed from one to the other. It is likely to be a significant value in both trading and manufacturing operations. Accordingly, it is important that inventory is managed carefully to ensure operational efficiency. Specifically, this presentation will cover the objectives of inventory management, elements of cost, the economic order quantity model, quantity discounts, and just in time. Let's now look at each of these in turn. The objectives of inventory management. Management implies guiding or controlling activities towards the achievement of predetermined goals or objectives. Accordingly, before we can consider how inventory will be managed, it is necessary to clearly identify what we are trying to achieve. The objectives of inventory management are twofold. 1, to avoid stockouts, and 2, to minimize the costs associated with the purchasing, ordering and holding of inventory. In order to achieve these aims, rather than thinking of inventory in total, as was the case in the working capital cycle presentation, we need to think about each individual item of inventory. Potentially, this will entail a tremendous amount of work, and in some cases the time and effort required to manage an item may not be justified given the relatively low value of the stock item itself. Consequently, many firms will adopt an ABC system, whereby high-value items are designated as Category A and will be subject to rigorous scrutiny. Conversely, low-value Category C items have far fewer controls and may be available on free issue. Obviously, Category B falls in between. Elements of cost. In simple terms, there are 3 categories of cost in relation to inventory. The buying or purchase cost, P, which refers to the cost of acquiring an item. In accordance with financial accounting standards, this will also include costs incurred in getting the item to its current location, for example, delivery costs. The total annual purchasing costs incurred will be P multiplied by D, where D is the annual demand. The cost of placing an order, CO, which includes all of the costs incurred in ordering inventory from a supplier. Though not exhaustive, these will include stationery, computer processing costs, postage costs, etc. The total annual ordering costs will be CO multiplied by the number of orders placed. The number of orders placed will be D divided by Q, where Q is the quantity ordered each time. Finally, the holding cost, CH, is the cost of holding one item for 1 year. This will include the costs associated with holding and moving an item around the facility, and or the opportunity cost of having money tied up in inventory, and therefore not available for other investment opportunities. The total annual holding cost will be CH multiplied by the average quantity held, i.e. Q divided by 2, where inventory is used at a constant rate. Similarly, the average quantity held will be Q divided by 2 plus B, where B is a buffer or minimum inventory level held. Economic order quantity. The economic order quantity, EOQ, is the quantity to order each time in order to minimize inventory costs, and is given by the following formula. The square root of 2 multiplied by the cost of placing an order, CO, multiplied by the annual demand, D, divided by the cost of holding one item for 1 year, CH. You may notice that the purchase cost P does not appear in this formula. This is because the EOQ model ignores the possibility that quantity discounts may be available. Accordingly, whether you order one batch of 1,000 or 1,000 batches of one, the total purchase cost will be exactly the same and as such does not affect the decision. Other assumptions of the EOQ model are: inventory is used at a steady rate throughout the year, and replenishment is instantaneous once the reorder point is reached. Or, perhaps more realistically, the lead time is consistent and can be predicted with accuracy. Quantity discounts. As discussed already, the EOQ model identifies the quantity to order in order to minimize inventory costs, i.e., the cost of ordering costs and holding costs combined. A business that is placing orders for any other quantity will incur a higher combined cost for CO and CH than is necessary. However, as also discussed, the model does not consider the potential existence of quantity discounts and will not consider this aspect where they do. Accordingly, where discounts are offered by suppliers, an amended approach is required. 1. Calculate the total inventory cost incurred, i.e. ordering, holding and purchase costs, if the economic order quantity is used. 2. Calculate the total inventory cost incurred as defined above at the minimum order quantity required to earn each level of discount. And 3. Choose the order quantity with the lowest total annual cost. For example, imagine a company has calculated the EOQ as being 50 units. The supplier is willing to offer a 1% discount if 75 units are ordered, 2% if 150 are ordered, and 5% if 250 are ordered. The company would calculate the total cost based on order quantities of 50, 75, 150 and 250 units, and then select the quantity with the lowest cost. Just in time. Just in time, or JIT, is a business philosophy built around excellent quality to provide the customer with what they want when they want it. This presentation is not going to discuss JIT in detail. However, central to a JIT approach is the principle of holding little or no inventory. This appears to be contrary to the EOQ model, as whilst holding costs will be very low, the company will need to place lots of orders for small quantities and will, as a consequence, incur high ordering costs. Supporters of JIT would refute this and would argue that the EOQ does not consider all of the costs associated with inventory. Specifically, they would suggest that companies hold inventory to cover up problems or weaknesses within the business. These problems will include unreliable suppliers, poor industrial relations, lack of or poor planning systems, poor quality work leading to rework or scrappage. All of these will make the coordination of material needs and supply extremely difficult, and indeed the holding of inventories allows these inefficiencies to exist and to continue. All of these issues will damage the organisation and accordingly will represent a cost to the business that should be considered. Thank you. Hello. In this presentation, I'm going to look at the management of receivables and payables. In many ways, receivables and payables are the same thing, the difference being determined by which side of the negotiating table you are sat at. As such, this presentation will focus primarily on receivables, however, will end by explaining how the issues discussed can equally be applied to payables. Specifically, this presentation will consider what are receivables, the credit control process, cost versus benefit, and payables. Let us now look at each of these in turn. What are receivables? Receivables, or debtors, are the amounts owed to a business by its customers in respect of sales made on credit. Offering credit is one way that a business can attempt to attract customers, and this is discussed in more detail in the Introduction to Working Capital presentation. It does, however, expose the company to additional administrative effort and the risk of payment default. Accordingly, it is important that 1. The company has appropriate processes and controls in place, and 2. Any benefits associated with offering credit in terms of additional sales volumes are weighed against the costs of managing the process and of tying up financial resources. These factors will be looked at in more detail below. The credit control process. When a cash sale takes place, for example in many low-value retail transactions, the provision of goods or services and the resultant payment take place instantaneously, and no record keeping is required other than the recognition of the transaction for financial accounting purposes. Conversely, when a sale is on credit, the provision of goods and the payment are separated by a period of time, the credit period. Effectively, the supplier is trusting the customer to pay at a later date. Indeed, the term credit comes from the Latin word credo, meaning belief or trust. Under these circumstances, the supplier must protect themselves from the risk of non-payment, and therefore, having proper controls and processes in place, including accurate record keeping, is extremely important. The process can be broken down into 3 broad categories. 1. Determining whether to offer credit and how much. 2. Deciding who to offer credit to. And 3. Debt collection. Whether or not to offer credit will, to some extent, be influenced by the market and customer expectations. However, the company will also need to consider what it can afford. This latter aspect is discussed in more detail in the Working Capital Cycle presentation. In deciding who to offer credit to, the company will need to consider the credit worthiness of the customer. This can be assessed by reference to their accounts or by obtaining credit references from banks or other suppliers. Alternatively, they may use the services of credit rating agencies. Once the decision to offer credit has been taken, it is imperative that processes are in place to invoice accurately and promptly, issue any credit notes required swiftly, issue monthly statements, and trigger appropriate action where payment is not received in line with contracted terms. These actions may include phone calls, letters, visits, legal action, etc. Finally, the company should ensure that credit limits are reviewed based on trading history and that credit is withdrawn from non-payers. Cost versus benefit. As has already been discussed, companies will offer credit to attract customers. They must ensure, however, that the benefits in terms of additional profits outweigh the costs associated with the administrative effort and the money tied up in working capital, especially receivables. This cost-benefit analysis can also be applied to using debt factors, offering settlement discounts, or increasing the credit period offered. A debt factor will provide a range of services for a fee. These may include management of the credit control function, advancing monies invoiced, and, in the case of non-recourse debt factoring, protection from bad debts. The company will need to compare the factor's fee to the benefits derived. For example, reduced admin costs, reduced bad debts, and lower receivables. A company offering a discount for early settlement is effectively giving away part of its profit. It should only do so if this is outweighed by the savings associated with lower average receivable levels. Increasing the credit period will mean that more money is tied up in receivables and therefore increased financing costs, as discussed in the working capital cycle presentation. Accordingly, it can only be justified on financial terms if the profit on the additional sales are greater than the finance cost incurred. In practice, it will be extremely difficult to estimate the sales increase due to the extra credit. It should also be remembered that additional sales are likely to require additional inventory, further increasing the need for investment in working capital. Payables. As alluded to above, payables and receivables face the same issues, albeit from opposite perspectives. Accordingly, many of the issues discussed above can also be assessed using a cost-benefit approach. For example, if a company is offered a settlement discount, the reduction in the purchase cost should be compared to the additional finance cost associated with paying out money more quickly. More generally, companies should aim to take advantage of as much credit as possible, it is effectively free finance, without jeopardizing the relationship with their suppliers. Thank you.
In this section, I will go over determining working capital needs and funding strategies. You should already be familiar with working capital before starting this video. Please take the time to look over working capital in introduction and the working capital cycle. In this video, we are going to look at calculating the working capital investment needed. We're also going to look at the key factors when determining working capital funding strategies. So let's begin. Calculating the working capital investment needed in an organization. You already know that working capital is the lifeblood of an organization. But how do you know what level of investment is needed? The level of working capital depends on the following: the length of the working capital cycle, the organization's terms of trade, the organization's policy on the level of investment in current assets, such as inventory, and finally, the industry the company is in. The length of the working capital cycle. This is the time period between the organization paying for its costs and receiving cash from its customers. These depend on the organization's industry. The working capital cycle is explored in earlier videos. The longer this time period is, the higher the organization's working capital investment will be. Organizations that have a long working capital cycle would be accountancy firms or construction companies. These organizations will have higher levels of current assets, such as cash, to enable them to keep up their daily operations. For example, it may take a construction firm a few years to get paid for a real estate development, but they will need to fund their staff salaries and the construction of the project in the meantime. So they will have to have high levels of cash to fund this. The organization's terms of trade. What does this mean? These are the terms the company offers to its customers. The length of credit terms will determine the length of the cash flow cycle. To reduce them, companies can offer discounts for early payment. Although companies can decide on their terms of business, often they must follow what their competitors are doing. For example, if an organization's competitors are offering 30 days credit, they will need to offer similar terms so as not to lose out on business. When deciding on their terms of business, organizations should calculate how much the proposed terms of business will cost them. For example, if the weighted average cost of capital of an organization is 5% per annum and the average credit sale is $5,000, they offer their customers 60 days credit. The cost of this is $5,000 at 5% and then 60 over 365 days. This is $41.10. So the cost of financing these credit terms will be $41.10 for the average customer. Now companies could look at how much it would cost them for, say, 30 days or 40 days and compare. Armed with this information, the organisation can evaluate different terms of trade and their cost benefit, i.e. the cost of financing them versus the potential sales lost by changing these terms. The more generous the terms of trade are, the higher the investment in working capital will be. This will be a trade-off for the organisation, as the more generous the terms of trade, the more attractive they are to customers, resulting in more sales. But they will have to fund these sales. The organisation's policy on the level of investment in current assets. This comes down to the organisation's attitude to risk. A company with a conservative attitude to risk will invest in current assets such as inventories and cash. This means that they can offer generous terms of business, as they can keep their daily operations going while awaiting for customer payment. Some people think that investing in current assets in working capital is a waste, as the excess could be invested to develop and grow the business. A more aggressive organisation will not invest as much in current assets and will be more profitable as a result. This is riskier, as they can run out of inventory and lose customers, or worse, run out of cash and get into a position of overtrading. The industry the company is in. I've already touched upon this, but the level of working capital investment that is needed does depend on the industry the organisation is in. Going back to our construction company example, they may take years to get the sales from their customers. Compare this to a coffee shop. They are paid immediately by their customers, and they can reduce their inventory investment by careful management. What are the key factors when determining working capital funding strategies? Here, you will look at permanent and fluctuating current assets, short and long-term finance, the matching principle, the costs and benefits of different funding policies, management's attitude to risk, previous funding decisions, and organisation size. Permanent and fluctuating current assets. So what are these when they're at home? The normal level of investment needed to support a normal level of sales. If the company decides to expand and increase its sales, this core level goes up. So if we take an example of a toy shop, the management should know month on month how much inventory, cash and other current assets they need to keep operations running smoothly. This is the permanent working capital investment needed. If the shop decides to expand and say open another shop or perhaps sell online, this increases the permanent current asset investment. The organisation will always need to have this amount invested. If not, they will negatively impact on their operations. Now, the same toy shop will have to increase its inventory levels at peak periods, such as Christmas. This increased investment in working capital is a normal part of business, and because this is not permanent, like the toy shop expects to have the inventory levels back to normal after the busy period, so say in January. The difference between a permanent and fluctuating investment is the time the investment is needed. The permanent current asset is in its name. It is permanent. Sometimes this can increase or decrease during the course of business, as you see with the toy shop. So when determining the level of working capital investment, the organisation must remember to take the fluctuating current assets into account. The cost and risk of short and long-term finance. You should already be familiar with the concept of long and short-term financing. In the context of working capital, sources of short-term finance include trade creditors. When organisations buy from suppliers, usually they will not pay up front. Instead, they will receive the goods on credit and get paid after 30 days, or whatever their supplier's terms of trade are. This is a free source of short-term finance. Sometimes organisations will offer discounts for early payment. For very big creditors, the organisations should measure these discounts against the cost of financing the working capital. Although this is a free source of finance, organisations should not abuse it, as it will result in poor supplier relations and the reduction on credit terms. Bank overdrafts and short-term loans, which you should already be familiar with. Invoice discounting or invoice factoring, where an organisation can sell its accounts receivable to an invoice financing company for cash. They sell the invoices for less than the value, and the difference is the financing company's fee. This is a good source of short-term finance as it doesn't affect the company's gearing levels. Customers are also unaware that their bill has been factored. The organisation can also reduce their risk of bad debt, depending on the agreement with the factoring company. However, if the organisation has tight profit margins, the factoring cost may be too high. Long-term finance sources would be, say, long-term loans of, say, over 20 years, mortgages, investors' funds, and retained earnings. Short-term financing typically tends to be more expensive on an annual basis than long-term debt. However, this is because long-term finance is given by the investor or the lender on the basis of it being a long-term investment, and they will receive a higher return over the long term. The asset being financed should be matched with a finance source. So long-term investments like a factory building should be matched with a long-term finance such as a 40-year mortgage. The benefits of this asset will occur over a long period of time, and the finance source should match this. This is the matching principle. For example, the toy shop from earlier shouldn't use a 40-year long-term loan to fund its temporary increased inventory at Christmas time. This is a current asset that fluctuates, so a short-term investment and the funds from it will be released in 30 to 90 days, so it should be funded with short-term finance. For example, with trade credit, a bank overdraft, company credit card, etc. Also, a mixture of short-term financing could be used. Example, Toys Inc. buys $100,000 of Christmas stock, which is delivered on the 1st of October. They are given 30 days trade credit. After 30 days, the 30th of October, they pay the supplier partially by credit card up to its $50,000 limit and partially by bank overdraft. Toys Inc. has sold enough stock by mid-November to pay off half the debt. They pay their bank draft first, as interest is charged per day of overdraft, whereas their credit card offers 60 days credit. By December, the organisation can pay off its credit card, but they don't. Instead, they use the available cash to generate more revenue or to pay their suppliers who offer high discounts for early payment. This is because they are maximising the 60 days free credit their credit card offers. At the end of 60 days, the end of December, Toys pays its credit card bill, avoiding the high interest charged by the credit card company. As you can see in this example, Toys Inc. has maximised its sources of short-term finance, and the extra cash they received from selling their inventory and not having to pay their credit card immediately means that they used the cash to get discounts and take advantage of business opportunities. If Toys Incorporated had not matched their short-term inventory fluctuation, they would have been left paying loan repayments long after the need of the capital had passed. Often hefty penalties have to be paid if you want to exit long-term financial lending arrangements. This is to compensate the lender, who is losing out on the returns over a long period of time. The permanent investment needed in working capital under the matching principle is matched by a long-term source of finance. This can be a little confusing as inventory, etc. are short-term or current assets. However, this consistent investment is long-term. Although the inventory might change and the assets themselves may change, it is a long-term investment. Management's attitudes to risk. We've discussed various funding policies and each of their pros and cons. What an organisation selects depends on their attitude towards risk. An aggressive working capital policy is where the owners and management acting on their behalf will want high profits and growth, and will manage their working capital in this way to maximise the capital so it can be invested into the business development and growth. A matching working capital policy matches the cash flows of the organisation, resulting in a less risky position and it being less likely to run out of cash. This policy is the medium between an aggressive and conservative funding policy. However, in practice, it is not as easy to apply as some organisations may not have access to enough long or short-term finance, so they cannot match their assets with their funding. A conservative policy would be adopted by risk-averse management. Shareholders who are risk-averse and want a steady, consistent dividend. So aggressive working capital policies that risk the organisation running out of cash and being unable to pay a dividend are not what they want. They will invest in working capital to ensure that this doesn't happen. Previous funding decisions. Have you ever heard of the phrase, once bitten, twice shy? This is where your past experience is affecting your current decisions. This is relevant in business and in life. Management's experience and history with funding will determine the current organisation's policy, whether it is an aggressive one or a conservative one. For example, if they ran into cash flow problems in the past, it is likely they will take active steps to ensure they have enough cash in the business. The size of the organisation will also factor into what funding policy an organisation selects. A smaller company will not have access to the same resources that a large multinational has. For example, they may not be able to get as much long-term finance from a bank or from their investors to fund their long-term capital need. This may force them to adopt aggressive working capital tactics and reducing investment in inventory and relying on trade credit. Try and apply what you have learnt to practice. What is the working capital policy in the organisation that you work in? What is your assumptions based on? Or what indicators of it do you see? The Baumol Cash Management Model. This model treats cash like inventory and finds what the company's optimal cash amount that should be invested or transferred at any one time. This is similar to the economic order quantity used for inventory management. It is calculated as follows. Optimal cash equals the square root and 2 multiplied by CO multiplied by D divided by CH. CO equals transaction costs. D is demand for cash over the period. CH, cost of holding cash. So let's apply it. Fashion Incorporated has a $5,000 excess cash balance per month. The interest rate on deposits is 2.5%. The transaction cost per transaction is $50. What is the optimal transfer amount? So the CO equals 50, D equals 5,000, and CH equals 2.5%. The square root of 2 multiplied by 50 multiplied by 5,000 divided by 2.5% equals $4,472. Every time a transfer is made to the investment fund, it should be $4,472. Now, this model, like the economic order quantity, relies on a number of assumptions. Cash is used in a steady and predictable manner. A quick note on this. Businesses are rarely steady and predictable. And this makes the result of the Baumol model unreliable in less than certain circumstances. Cash inflows are known and regular. A company can know what money is owed to it. It doesn't necessarily mean that they will receive payment when expected. This assumption reduces the reliability of the model for many businesses. 3. Daily cash needs are funded via a current account and buffer cash held in short-term investments. These assumptions are more likely to occur and something that most businesses would strive to achieve. However, anyone who works in business will know that this is often not the reality, and day-to-day expenditure could be funded by short-term loans, etc. So, as you can see, in reality, this model is not suitable where there is uncertainty over cash flows. That said, it is a useful calculation to do as it draws awareness to transaction cost and the opportunity cost of cash stored in the business rather than investing it. Thank you. Miller-Orr model. This is one model that can be used to manage cash. It is used to set a target cash balance for the company. The model sets a high and a low point of cash for the company to hold. The model also sets an ideal cash level called the return point. See the diagram. Line H is the maximum cash the company will hold, and line L the least. And Z, you may have guessed that this is the target cash balance or return point Z. And now you see a yellow wavy line on the diagram. This is the actual cash balance in the company. And as you can see, over time it is high and it is low. This model identifies the highest and lowest level of cash the company should hold and the ideal balance it is striving to reach and maintain. Once these high-low limits are hit, action is taken. You'll see at point X that the cash level is well above that of the target. This cash should be put into market securities and not just left in cash. Ideally, these securities will give a good return and the company will grow. How much should be put into the security? The amount from point X to bring the balance right down to line Z. So let's say point X equals $150, H $110, and Z $50. The amount transferred into non-cash securities is as follows. 150 minus 50 equals $100. By transferring this, the cash balance is brought back to the ideal Z. You could say the company is a bit sloppy at applying this model, having let the balance go to $150 when it should not go past $110. Now, having a cash balance that is too low presents a whole other set of difficulties. I'm sure that you would agree. Here, let's say the minimum level is $25 and we see that point Y is below that. What do we do if the cash balance hits its lowest threshold, or even lower than that, to point Y, which is $5 in this example? You should know by now that the company wants to maintain its cash levels at the return point. So in this example, it is $50. So the company would convert its non-cash securities into liquid cash to restore the cash balance to Z. How much does the company need when it is at point Y? To restore the cash balance to the ideal, it is $50 less point Y of $5. So it needs $45. Okay, so you now know how the model works. How do you set up this model? Firstly, you need to set up the maximum and minimum points. The minimum point is set based on management culture and experience. It is guided by how much cash shortfall the company is willing to accept, and the market circumstances, meaning how easily cash securities can be converted and borrowings can be assessed. So, for example, in a market where cash is hard to come by and borrowing costs are high, the minimum cash level will be much higher than in a market where interest rates are low and borrowing is cheap, and the non-cash marketable securities are easily converted into cash. So, as you can see, there's no exact science in setting this level. It involves management's attitude to risk, the ease of converting marketable securities, and the ease of borrowing. The maximum cash balance can be calculated once the minimum has been set. This is calculated using the spread calculation. This formula gives the difference between the max and minimum points, i.e. the spread. The formula is spread equals 3, open parentheses, and then 3/4 multiplied by transaction costs multiplied by variance of cash flows, then this calculation is divided by the interest rate to the power of 1/3. This formula requires variance of cash flows. These should be in daily terms. What is variance? It is the standard deviation squared. Once you know the spread, the maximum point is found by adding the spread to the minimum point. What about the ideal cash balance, or the return point? The return point equals the lower limit, and then add that to 1/3 multiplied by the spread. You can see that each point feeds into the next. Okay, now let's tackle an example. I want you to attempt the example that will come up on screen. Pause the video and apply the theory we just did, and then I will review it with you. So pause the video now. Fashion Incorporated is a successful retailer, and the directors have decided the lowest the cash balance can go is $10,000. Transferring money to or from the bank costs $25 per transaction. The standard deviation is $1,500 per day. The interest rate is 0.03% per day. The directors need to know what is 1. The spread between the maximum and minimum amount of cash the company should hold. 2. The maximum balance of cash the company can hold. And 3. The return point. Did you attempt the question? It's your last chance to pause the video. Remember, we learn by doing. Okay, so we need the spread, the maximum and minimum cash the company can hold. Let's work through them as we see them. The spread equals, and then we've got the formula. So the transaction cost is $25. Variance is the standard deviation squared. The standard deviation is $1,500. It is squared, and that's $2.25 million. The interest rate is 0.03%. So let's apply the formula. So we've got 3, and then inside the brackets we have 3/4 multiplied by 25 multiplied by 2.25 million. That's divided by the 0.03%. And then that's all to the power of 1/3. And you get $15,600. That is the spread. That's the first part of the question answered. Part 2, the maximum balance of cash the company can hold. We now know the spread is $15,600. Add that to the minimum balance is $10,000. So the maximum balance is $25,600. Now let's calculate the return point. The return point equals lower limit plus 1/3 multiplied by the spread. The lower limit is $10,000. The spread is $15,600. 10,000 plus, and inside brackets, 1/3 multiplied by 15,600, which is $15,200. Now you know the ideal point is 15,200. This is the cash balance Fashion Incorporated should have. The maximum point is 25,600 and the minimum 10,000. The benefits of the Miller-Orr model is that it gives clear cash balance parameters of how much cash is ideal, too little or too much. It also gives actions of what to do when cash is too low or high. The activity of implementing the model is great for an organisation as they must analyse and dissect the company's cash needs. The main disadvantage is that there is no objective guide in determining the minimum cash limit, cash balance.
Hello. We're now moving on to a major new topic, investment appraisal. This is highly examinable and is at the core of financial management. The financial strategy contains 3 key decisions. The finance decision, where do we get our money from? The investment decision, what do we spend it on? And the dividend decision, do we return our money to our investors or do we retain it to reinvest? During this part of the course, we're focusing on the investment decision. What do we spend our money on? Let's start off by making a key assumption. We're going to assume that we're trying to maximize the wealth of the shareholders. There are many reasons why businesses may invest: to secure growth, to achieve a non-financial goal or social purpose, but we're going to assume the deciding factor behind do we go ahead or not is, will it create wealth for the shareholders? If it will, let's go ahead. If it doesn't, let's not. There are four main investment appraisal techniques examinable. Two involve a process called discounting, building in the time value of money, and two do not. The two that don't involve discounting are the accounting rate of return, or ARR, payback period, or PBP. The two that do involve discounting are net present value, or NPV, and internal rate of return, or IRR. We'll start off with the non-discounting techniques, then work through the ones that involve the time value of money. We'll then go on to develop net present value techniques for longer questions. So, let's begin. The accounting rate of return is the percentage return a profit generates on average per year. It's also known as return on investment. The formula is as follows: average annual profit from investment over initial or average investment, where average investment equals initial outlay plus scrap value divided by 2. Our examiner prefers to divide by average investment. This will be specified in the question. So, suppose for example a potential project involves an initial investment in machinery of $1.7 million and has these operating annual cash inflows. Year 1, $300,000. Year 2, $550,000. Year 3, $600,000. And year 4, $440,000. The machinery will be sold for scrap at the end of year 4 for $200,000. Let's calculate the accounting rate of return based on average investment. Remember the formula: average annual profit from investment over average investment, times by 100 to give us a percentage. Average annual profit refers to accounting profit, so after depreciation. Total cash profits would be $300,000 plus $550,000 plus $600,000 plus $440,000 equals $1.89 million over the 4 years. Total depreciation would be the difference between initial cost and scrap value. So $1.7 million minus $200,000 is $1.5 million. So total profits after depreciation would be $1.89 million less $1.5 million depreciation is $390,000, or $390,000 divided by 4 is $97,500 per year. Average investment is initial outlay plus scrap value divided by 2. So $1.7 million plus $200,000 divided by 2 is $950,000. Accounting rate of return is therefore $97,500 divided by $950,000 equals 0.10, or 10%. The whole point of appraising this opportunity is ultimately to see if we want to go ahead or not, or if it will make our shareholders wealthier. Accounting rate of return is often compared to the company's overall return on capital employed, which is a similar measure to accounting rate of return, just for the whole business. A key point here is that shareholders, the owners of the business, often look at return on capital employed to help them understand how well the business is doing. Return on capital employed is profit before interest and tax divided by capital employed. The rationale is this: If a project has a potential return higher than the current return on capital employed, taking it on may well therefore increase the return on capital employed. This is the main reason why it's common in practice. Accounting rate of return has several advantages as an investment appraisal technique. First of all, it's a percentage measure, and managers like percentage measures as they can easily be compared to alternatives. Secondly, it's completely in tune with something that shareholders look at anyway, return on capital employed. It makes perfect sense for management to manage return on capital employed by considering the accounting rate of return of individual projects. Finally, in contrast to payback period, which we'll come to later, accounting rate of return does consider the whole life of the project. However, there are several serious disadvantages associated with this investment appraisal technique. As a percentage measure, it does not give us a direct measure of the impact on shareholder wealth as a result of taking on the project. It doesn't take into account the time value of money, the fact that money received later is actually worth less than money received today. Don't worry, I'll come back to this concept later. If there's a small trickle of cash flows at the end of the project for a few years, this can unreasonably drive down the accounting rate of return measure. For example, if we had an extra 10 years where we earn $1 a year, this would drive down the average accounting profits. However, the last 10 years of cash flows are completely insignificant to the project and so should be ignored. As we've seen, there are several good reasons why accounting rate of return is a common measure for investment appraisal. However, be aware that it has several serious theoretical flaws. In the next video, we'll go on to look at payback period. Hello. In this video, we're going to have a look at the concept of relevant cash flows and see how this applies to another investment appraisal technique, payback period. When we're making a decision about whether or not to invest, the amount to include in the appraisal should be future, incremental cash. The reason for this is as follows. Firstly, let's consider the significance of the word future. When we're making decisions, we're concerned about how that decision will affect the future. Anything that happened in the past cannot be changed, so should not be considered further in the decision itself. For example, suppose I commission an investigation into a project, and that investigation cost me $1 million. When I read the report, it says, if you invest $1,000 today, you'll get $2,000 back tomorrow. Am I upset that I've paid $1 million for this advice? You bet I am. But does that mean I don't invest $1,000 today to get $2,000 back tomorrow? I can't change the fact the report has cost me $1 million, so the cost of the report is irrelevant to the decision. The only decision we face is whether or not to invest $1,000 today to get $2,000 back tomorrow. 100% return in 24 hours sounds pretty good to me. Next, let's consider the significance of the word incremental. We're only interested in understanding how a decision will change the future. Financial accountants often struggle with this concept. For example, if you are paid $50,000 a year and your manager says to you, I need you to work on this project for a year, it will take up 1 day of your 5-day week each week. When you're considering the relevant cost of your time, it's very tempting to say something like $50,000 divided by 5 equals $10,000. So $10,000 is the relevant cost of my time on this project. However, in actual fact, you were paid $50,000 before and you continue to be paid $50,000. So the incremental cost of your time is 0. Opportunity costs and benefits are also relevant. Suppose we have some material in the warehouse that we bought for a project a while ago that didn't go ahead. Suppose it cost $1,000 to buy, and we have no further use for this material other than for a project we're considering. If we don't get on with the project, we could sell the material for scrap for $100. Let's consider the relevant cost of using this material on the project. Firstly, the $1,000 is irrelevant, as it's a historical cost and therefore sunk. If we don't go ahead with the project, we could sell this material for $100. So if we do go ahead, we'll be choosing to forego $100 income. In effect, using the material on the project has cost us $100, as we're $100 worse off as a result of going ahead. Finally, let's consider the significance of the word cash. In short, you can't spend profits. We make shareholders wealthier by giving them cash. So, when the company spends cash, it is at that point that it has cost the shareholder, as we can no longer give it to them. Equally, when cash flows into the business, this makes shareholders wealthier. Hence, we focus on cash flows. A good mental image to maintain when trying to decide on the size and relevance of a future incremental cash flow is as follows. Imagine a cash flow forecast of the business if you don't go ahead with the decision you are considering. And then, next to it, imagine a cash flow forecast of the business if you do go ahead with the decision. Anywhere there's a difference between those two cash flow forecasts, and the size of that difference is the relevant cash flow. In the previous video, we introduced the idea of accounting rate of return as a method for appraising a potential investment opportunity. Let's now have a look at the second non-discounting technique, payback period. The payback period for a project is the time it takes to recover its initial investment. It's the time it takes for the project to pay for itself. Let me remind you about the example we looked at in the previous video. A potential project involves an initial investment in machinery of $1.7 million and has these operating annual cash inflows. Year 1, $300,000. Year 2, $550,000. Year 3, $600,000, and Year 4, $440,000. The machinery will be sold for scrap at the end of Year 4 for $200,000. Key to calculating payback period is to calculate a cumulative cash flow column over time as follows. The scrap proceeds from selling the machinery are only received right at the end of the project, at the end of Year 4. The project pays for itself before the scrap proceeds are received, hence we don't need to include them in this analysis. The project pays for itself in the final year. At the start of that final year, the project still owes us $250,000. During that final year, $440,000 flows in over the year. Assuming that money flows in evenly, we could work out how far into that year we have to go in order to reach payback. We would need to go $250,000 over $440,000, or 57% of the way through that year. In other words, 57% times 12 months equals 6.8 months into that year. The payback period is therefore 3 years and 6.8 months. In order to decide whether or not to proceed, the payback period calculated needs to be compared to some relatively arbitrary benchmark. For example, the company may say, we only accept projects that pay back within 3 years. In which case we'd reject this project as it takes longer than 3 years to pay back. Payback period has several advantages as an investment appraisal technique. It's cash flow based as opposed to accounting rate of return, which is based on accounting profits. Accounting profits can be manipulated, and cash flow more directly relates to the fundamental objective of maximizing shareholder wealth. It also gives the decision maker a feel for how risky the project is. A project that pays back quickly is likely to be less risky, as the near future is simply more knowable than the distant future. Payback period is also useful if the company is facing cash flow difficulties, as it shows how long the project has to be financed for. However, payback period also has several disadvantages. It takes no account of the time value of money. More on this later. And it ignores all cash flows after the payback period has been reached. For example, a project may have a really fast payback, but then soon after the payback period has been reached, there could be an enormous outflow to decommission the site. Overall, the project could be very poor in terms of its financial performance, even though it has paid back quickly. In this video, we've considered how to identify the relevant cash flows in an investment appraisal decision that is cash flow based. We use the three-line test of future, incremental, cash flow. We've also considered a second investment appraisal technique, payback period, its calculation, advantages and disadvantages. In our next video, we turn our attention to the time value of money. Hello. In this video, we'll consider the time value of money. This is fundamental for the calculation of net present value and internal rate of return. $1 today is worth more than $1 in 3 years' time. There are 3 reasons for this. Firstly, inflation. You can buy more with $1 today than you could with $1 in 3 years' time, as prices tend to increase periodically. Secondly, interest. You could put $1 into a bank account today, and over 3 years, it would accumulate interest to grow into something bigger than $1 in 3 years' time. Finally, risk. $1 today is a definite dollar, whereas the promise of $1 in 3 years' time is never going to be quite as certain. This is sometimes known as the bird in hand principle, from the old expression, a bird in the hand is worth 2 in the bush. Firstly, let's consider the mechanics of compound interest. This can be considered as interest accumulating on a deposit in the bank. Suppose we put $1,000 on deposit today into an account that will earn us 10% a year. In 1 year's time, this will be worth $1,000 times 1.1, the 0.1 is for the interest, equals $1,100. By the end of the second year, the balance would be $1,100 times 1.1 equals $1,210. By the end of the third year, the balance would be $1,210 times 1.1 equals $1,331. This calculation can be done in one go as follows. $1,000 times 1.1 cubed equals $1,331. Or, in general terms, the present value times 1 plus r to the n equals future value, where r is the annual rate of interest and n is the number of years. Now, this is all well and good, but usually with investment appraisal, we estimate future cash flows and are more interested in knowing what their present value equivalent is right now. In other words, we'd like to know how much we'd have to put into the bank today for it to grow into that future value. This tells us what that future value is worth to us right now. Restating these future values to a present amount is known as discounting, and this is simply the opposite of compounding that we've already seen. For example, the present value of $1,331 received in 3 years' time at an interest rate of 10% would be $1,331 divided by 1.1 cubed equals $1,000. In general terms, the present value equals the future value divided by 1 plus r to the n, where r is the annual rate of interest and n is the number of years. This can also be written as follows. The present value equals the future value times by 1 over 1 plus r to the n. The term 1 over 1 plus r to the n is called a discount factor. Discount factor tables are provided for you in the exam, so you can look up the value of this term without having to calculate it. For example, the 10% 3-year discount factor would be calculated as 1 over 1.1 cubed equals 0.751. Alternatively, this can be looked up on tables as follows. Get used to using these tables, they save loads of time. So, now we can calculate the present value of a future amount. This is saying what the future amount is worth in today's terms. Sometimes cash flows repeat each period over several periods. For example, we might have $100 received each year for the next 3 years. A constant cash flow received each period for a fixed number of periods is called an annuity. To calculate the present value of this annuity, we could discount each cash flow individually and add them up as follows. We'll continue to assume the annual rate of 10%. So, the present value of this 3-year annuity is $248.60. A quicker way to do this would be to use an annuity factor. An annuity factor is simply the sum of the individual discount factors. In this case, the 10% 3-year annuity factor is 0.909 plus 0.826 plus 0.751 equals 2.486. So an alternative calculation would be $100 times 2.486 equals $248.60. Better still, annuity factors are available in tables too, and these are provided in the exam. Because discount factors are rounded to 3 decimal places, when we added the 3 together, it created a small rounding error. This is the only reason why the table showed 2.487 and we had calculated 2.486. Either would be acceptable in the exam. The annuity tables assume that the first payment under the annuity will be in 1 period's time. This may not be the case. For example, it may start in 4 years' time. This doesn't mean, however, the tables can't be used, so long as you remember that an annuity factor is simply the sum of the individual discount factors. Suppose then that our 3-year $100 annuity starts in 4 years' time. The present value will be $100 times annuity factor from years 4 to 6 at 10%, where the annuity factor from years 4 to 6 at 10% is the 3-year annuity factor starting in 4 years' time. We can calculate the annuity factor as follows. We take the 6-year annuity factor off tables at 10%. This is 4.355. But we don't need the first 3 years. So, if we deduct the 3-year annuity factor, which is 2.487 for years 1 to 3, from the 6-year annuity factor, which is 4.355 for years 1 to 6, that leaves us with 4.355 minus 2.487 equals 1.868 for years 4 to 6. So the present value would be $100 times 1.868 equals $186.80. Occasionally you might need to use an annuity factor that's not given to you in tables. The formula to calculate an annuity factor is shown above the tables in the exam. It is possible to have an annuity that actually never comes to an end. This is known as a perpetuity. The discount factor for a perpetuity is simply 1 over r. For example, the present value of $1,000 each year starting next year forever with a 10% per annum required rate of return would be $1,000 multiplied by 1 over 0.1 equals $10,000. This makes sense now we've got the answer in front of us. If we invested $10,000 into a bank account today, in a world with 10% interest rates, we could withdraw $1,000 each year forever. This recreates the perpetuity cash flows. Technically speaking, a perpetuity factor is the sum of the individual discount factors from 1 to infinity. It's useful to remember this if the perpetuity doesn't start immediately. If it doesn't start straight away, the approach we'd use will be similar to that we would use for an annuity. For example, if our $1,000 perpetuity didn't start for 4 years, then the present value would be $1,000 multiplied by 1 over R minus the annuity factor for years 1 to 3 at 10%, or $1,000 multiplied by 10 minus 2.487 equals $1,000 times 7.513 equals $7,513. Time value of money calculations are at the very heart of net present value and internal rate of return, our remaining last two investment appraisal techniques that are far and away the most important two on the syllabus. It's very important, therefore, that you get to grips with these mechanics now. You don't have time to be thinking through the detail in the exam. It needs to be second nature by that point. Give yourself plenty of time and question practice. In the next video, we'll start to look at net present value. Now we've got to grips a little bit with the time value of money calculations, we can have a look at the last two investment appraisal techniques: net present value, or NPV, and internal rate of return, or IRR. With NPV, the basic approach is to estimate the future incremental cash flows associated with an investment opportunity and restate all those future amounts to present value equivalents by discounting them. If we then add them all up, and if the answer is positive, then the project has a positive value in today's terms. Let's go back to our earlier example. A potential project involves an initial investment in machinery of $1.7 million and has these operating annual cash inflows. Year 1, $300,000. Year 2, $550,000. Year 3, $600,000. And Year 4, $440,000. The machinery will be sold for scrap at the end of Year 4 for $200,000. Now, let's work out the NPV for this project. Let's set up a table and fill in the cash flows. Next, we add discount factors from tables as follows. Let's assume we have a time value of money of 10% per year. Note, the T0 discount factor is always 1. There's no need to discount this value as it's a cash flow happening today. In effect, it's already stated at its present value. Also, to enable us to do discounting calculations, we have to make a simplifying assumption about the timing of cash flows. We need to assume that cash flows that arise over a period of time arrive at the end of that period. So, for example, the Year 1 cash flows of $300,000 may well arise evenly over that first year. We'll assume that it all arrives in one go, all at the end of that year, at T1. Then, multiply the discount factor by the cash flow to work out the present value of each cash flow. Finally, add up all the present values to get the NPV. We picked on 10% as the discount rate here for an example. The discount rate that should be used for investment appraisal is the investor's required rate of return, also known as the cost of capital. We'll come back to how we calculate this much later on in the course. Let's just take it as a given for now. The basic decision rule for an NPV assessment is that if the answer is positive, the project should be accepted. This is because the value of all the cash flows restated to present values is net positive. In other words, accepting the project will add to shareholder wealth. In this case, the NPV is negative, and this would suggest the project should not be undertaken, because to do so will reduce the value of the business by $85,300. NPV has much to commend it as a technique. First and foremost, it gives a direct answer to the question, what will be the impact on shareholder wealth if I take this project on? For example, an NPV of positive $100,000 means that if that project is taken on, shareholder wealth will be increased by $100,000 in today's terms. The value of the company's shares logically should increase by this amount in total. NPV is based on cash flows and considers the whole life of the project. However, it also has its disadvantages. It's not used that often in practice because it's not well understood by non-finance professionals. Alternative measures like accounting rate of return and payback period are more immediately accessible to understand. It needs a cost of capital to be able to calculate it. This is the discount rate that's used. This is relatively subjective and difficult to calculate, as you'll see later on. It assumes that cash flows arise at the end of the period. Operating cash flows often arise throughout the period. Before we move on to look at the internal rate of return, or IRR, let me briefly return to the payback period approach. One of the downsides associated with payback period was, we said, that it does not take account of the time value of money. We can modify the technique slightly to include discounting by discounting the cash flows first before working out when the cumulative cash flow returns to zero. This is known as discounted payback period or adjusted payback period. For example, suppose a project requires $1,000 investment today and will generate $390 each year for 5 years. The discounted payback period would be calculated as follows: time, cash flow, discount factor, multiply the discount factor by the cash flow to give present value, and work out the cumulative present value as it builds up over time. We can see in this example that the discounted payback period is approximately a little over 3 years. Lastly, let's now consider our final investment appraisal technique, internal rate of return, or IRR. IRR is closely related to NPV. It's the discount rate that yields an NPV equal to zero. If we took the cash flows associated with a project and did several different NPV calculations at different discount rates and plotted the results on a graph, it might look something like this. The more heavily we discount future flows, the less they are worth in present value terms, and the lower the NPV becomes. The IRR is where this curve crosses the x-axis. This is the discount rate where NPV equals 0. The way we interpret the IRR is as follows. If the IRR is greater than the cost of capital, then we would accept the project because this implies that at the cost of capital, the project has got a positive NPV. Let's see why this is the case on the graph. With similar reasoning, if the IRR is less than the cost of capital, we would reject the project, as this implies that at the cost of capital, the project has got a negative NPV. IRR is sometimes known as the break-even cost of capital, because that is the discount rate at which the project breaks even. In other words, where it has a 0 NPV. So, to recap, compare the IRR with the cost of capital. If the IRR is greater than the cost of capital, then accept the project. If the IRR is less than the cost of capital, then reject. Let's have a look now at how we actually calculate the IRR. We actually estimate the IRR using a process known as linear interpolation. The process is as follows. Calculate the NPV at two different discount rates. It doesn't really matter what the rates are, just use ones off tables like 5% and 10%. What we will have done then is find 2 points on the curve as follows. Mathematically, we will draw a straight line between these 2 points. Approximately, where the straight line crosses the x-axis is more or less where the curve crosses the x-axis. We can work out exactly where the straight line crosses the x-axis. Let's label the graph first. A is always the lower percentage. B is the higher percentage. NA is the NPV at A%, and NB is the NPV at B%, and combine them together in this formula. You have to learn this formula for the exam. It's not given to you on the formula sheet. However, it may help you to remember it if you do the following. Starting with the A and read across, the formula spells out a banana NB. Let's calculate the IRR of our earlier example. Here's the project in question. A potential project involves an initial investment in machinery of $1.7 million and has these operating annual cash inflows. Year 1, $300,000. Year 2, $550,000. Year 3, $600,000. And Year 4, $440,000. The machinery will be sold for scrap at the end of Year 4 for $200,000. The NPV at 10% was negative 85.3. If we rerun the NPV calculation from earlier on at 5%, we get the following. So, the IRR must be somewhere between 5% and 10%. Let's apply the formula. So the IRR is 8%. If the firm's cost of capital was 10%, we should reject this project as its return is less than the cost of its finance. You don't need to have a positive and a negative NPV for the formula to work. Suppose you picked 5% and 10% as discount rates and they both came out with positive NPVs. The formula will still work. All it's doing is the following. This is known as extrapolation. It's technically not quite as accurate as what we did before, but it's still perfectly acceptable for our exam. You'll notice that the black line is still pretty close to the curve on the x-axis. IRR has several advantages. It's a percentage and managers like percentages because they can easily be compared to other alternatives. It's based on cash flows and includes the time value of money. You don't need to know the cost of capital precisely to use it. For example, if you feel your cost of capital is somewhere between 5 and 10% and you calculate the IRR as being 18%, then you'd be safe in saying let's go ahead, as 18% is higher than the entire range from 5 to 10%. However, there are some problems with IRR. As a percentage measure, it always begs the question, percentage of what? For this reason, you cannot use it to compare two different projects. For example, suppose Project A has an IRR of 40% and Project B has an IRR of 20%. It looks like Project A is preferable. However, suppose I now tell you that Project A gives you a 40% return on $1 and Project B gives you a 20% return on $1 million. Clearly, Project B would make you wealthier, but IRR indicated Project A. We're assuming with the basic decision rule that the project involves an initial outflow followed by years of inflows. This is known as a traditional project. This is what gives the curve on the IRR graph its downward slope from left to right. Other types of projects will yield different shaped curves, hence the decision rule would need to change. For example, if a project consisted of an initial outflow, several years of inflows, and then a big outflow at the end, such as site cleanup costs, then the IRR graph may look like the following. And that's just one example. There are many possible graphs depending on the pattern of the cash flows of the project, which makes the basic decision rule of if the IRR is greater than the cost of capital, then accept the project unreliable. One final disadvantage of IRR, and this is a technical point, the IRR calculation assumes the cash flows that are generated early on in the project are reinvested at the internal rate of return. This is known as the reinvestment assumption. There's no reason to assume that this will be the case. Cash flows that are earned early on in the project are generally extracted from the project and something else is done with them. Investment appraisal, and especially NPV, is a highly examinable topic. Take time to get grips with it as a subject and work through plenty of question practice. We'll continue to build on the NPV idea in the coming videos. Hello, in this video we'll build upon the earlier concept of NPV and consider some of the more advanced issues that you may have to deal with in the exam, namely tax, inflation and working capital. In longer questions, a more orderly pro forma helps you to deal with the volume of information and also helps the marker to allocate marks to your answer. Remember, this is management accounting, so the pro forma is not prescribed in law and standards in any way. You just need to be aware of the general structure and a few principles. Start by putting time across the top. If the question tells you it's a 5-year project, put a 6th year in there. Often tax effects spill over into an extra year. If you don't use that final column, it doesn't matter. Better to do that than to squeeze in an extra column later that you realise you might need. Go to the bottom of the page and put some subtotals. Net cash flow, discount factor, and present values. Give yourself plenty of room, use a whole page. Then put cash flows down the side and populate the table as you go. For reasons that will hopefully become clear later on, it helps if you can put cash flows of income-related items such as sales, materials purchases, rent, payment to workers towards the top of the page, as this will gather things nicely to do a subtotal for corporation tax. Items that don't appear in an income statement should be put further down. Then, in the exam, start off with the easy numbers and put those in the pro forma and work your way up to the harder numbers. If you can't do the harder numbers or you're running out of time, make a simplifying assumption. This exam is method marked, which means even though you won't get any marks for that number being correct, you get credit for how you use that number later on. If you use the wrong number in the right way, you get the marks later. Let's now consider the impact of tax. Remember that this is not a tax exam. In this exam, we take a very simplified approach, simply to appreciate that taking on projects will impact our tax bills. There are generally 2 aspects to tax to consider: corporation tax and capital allowances, also known as writing down allowances. You need to read the question carefully, as it will tell you exactly what the treatments are to be. Let's start off by considering corporation tax. Usually the question will say something along the lines of, the corporation tax rate of 25% is charged on operating cash flows and is paid in the same year that the cash flows occur. This being the case, then any operating cash flows, such as sales, purchases, payments to workers or factory rent, should be put towards the top of the pro forma, so a subtotal can be performed like this. I'm making numbers up as I go here just to show you how it all works. Once we've got the subtotal, it's simply a case of multiplying by the percentage tax rate given in the question and slotting the number into the right column. If in this question the tax rate was 25% payable in the same year in which the cash flows occur, we'll calculate tax and add it into the pro forma as follows. If, on the other hand, the question had said something like, tax is payable at 25%, 12 months after the end of the year to which the cash flows relate, we would simply delay the cash flows by a year as follows. Writing down allowances, or capital allowances, is tax allowable depreciation. The capital allowance itself is not a cash flow. The cash flow is the saving in tax we benefit from as a result of having it. Let's work through an example together. Suppose our fictitious company needed to invest $250,000 at the start of the project, and this was eligible for writing down allowances at a rate of 25% reducing balance per annum. Suppose as well that the scrap value at the end of the project was $75,000. Before you get into the writing down allowances, let's include those two amounts on the pro forma. Here's a standard working to calculate the tax saved as a result of the writing down allowances. Let's set up the column headings first. Time, written down value, tax saved, and timing. Let's now calculate the first year. We take 25% of the initial cost of $250,000. This is $62,500 and is effectively depreciation for tax purposes. If we deduct this from the $250,000, we get the written down value of the asset at the end of that first year. The depreciation for tax purposes is not the cash flow, but it will appear on our tax return as an allowable deduction. This $62,500 allowable depreciation saves us tax at a rate of 25%, our corporation tax rate. So $62,500 times 25% equals $15,625. Assuming that corporation tax is paid at the end of the year to which the cash flows relate, the tax saved because of this first writing down allowance will be received at the end of that first year, which is T1. We work through a similar process for years 2 and 3 as follows. For the final year, you need to read the detail of the question to see what happens. However, usually there's a balancing allowance or balancing charge in that final year. This is the equivalent of a profit or loss on disposal for tax purposes. It's easier to see this through an example, so let's see what would happen in this case. We said the scrap proceeds of this investment was $75,000. We compare this to the tax written down value of $105,469. The difference of $30,469 is the equivalent of a loss on disposal for tax purposes. This is known as a balancing allowance. If it had been a profit on disposal, it would have been a balancing charge. Again, this balancing allowance of $30,469 is not a cash flow itself. It would appear on a tax return as an allowable deduction. The amount of tax this saves depends on the corporation tax rate, in this case 25%. So the cash flow benefit of the writing down allowance, or the balancing allowance in this case, is $30,469 times 25% equals $7,617, receivable at T4. We can now transfer these cash flows into our main pro forma. Next, let's have a look at working capital. Working capital is an investment that's required to have a project operating in the first place. For example, without any inventory, there won't be any raw materials to turn into the finished product. We have to buy this inventory in advance, so it's therefore a use of cash at the start of the project. Suppose that in our example the question states working capital equivalent to 10% of sales for that year needs to be in place at the start of that year. Let's work out the cash flow together. First of all, let's set up a pro forma working with time across the top. Just to remind ourselves how much sales occur in each year, let's also add sales as a memorandum row. Now let's work out how much working capital we need to have in place at the start of each year. Remember, for example, that the first year happens between T0 and T1. T0 is therefore the start of the first year and T1 is the end of that first year. Remember, we have sales of 100 at T1 as a simplifying assumption because we assume that cash flows that arise over a year arise at the end of that year. So we take 10% of sales for the year and note that down as needing to be in place for the start of that year as follows. Note that these are not the cash flows themselves. This represents the working capital that needs to be on the statement of financial position. It's only the movements from one period to the next that equate to a cash flow. For example, moving from year 1 to year 2, we need to have an extra 10 to take our working capital up to 20. In other words, take increments as follows. You'll notice if you add across the cash flow row, it sums to 0. This is a useful check in the real exam. All this means is that money that's invested in working capital ultimately comes back out at the end of the project. That's not to say it has a neutral effect on the value of the project, because these cash flows will need to be discounted. In other words, there is a finance implication associated with investing the money up front to get back later. We can now add these cash flows to our main pro forma. Assuming that we've now covered all the cash flows given to us in the question, we can complete the pro forma by doing the following. Add down each column to give us net cash flows. Add in the discount factors. Let's suppose here that the discount rate given to us in this question was 10% per annum. Remember, use tables to get these. Then multiply the net cash flow by the discount factor to give present values and add it all up. Last but by no means least, conclude by interpreting the answer. In this case, I might say something like, the NPV is 155 positive and therefore the project should be accepted, as to do so will increase shareholder wealth. Finally, let's consider the impact inflation might have in a question. Inflation affects both the cash flows and the cost of capital. Inflating prices increases cash flows. However, you may recall that the cost of capital is there to compensate investors for three things: interest, inflation and risk. So inflation also increases the cost of capital. In principle, there are two possible approaches here. Either you leave inflation out of the cash flows and leave inflation out of the cost of capital, or you include inflation in the cash flows and you include inflation in the cost of capital. Either way, in theory, gets you to the same result. However, in the main, for reasons I won't bother you with at the moment, it's usual in longer questions to include inflation in the cash flows and make sure inflation is included in the discount rate. Let's work with an example. Consider these cash flows for sales. T1, 100, T2, 150, and T3, 200. Let's assume these cash flows are in real terms. In other words, they are stated at today's prices and therefore don't include inflation. Let's assume that in this world, inflation is running at 3% per annum and that the uninflated cost of capital, also known as the real cost of capital, is 7% per annum. First, let's inflate the cash flows. We multiply the cash flows by 1 plus I to the n, where I is the annual inflation rate and n is the number of years, like this. These inflated amounts represent the cash that will actually be received. Let's turn our attention now to the cost of capital, or the discount rate. If in our world here I ask you to give me $100 and in return I give you back $107 in 1 year's time, I have given you a 7% return for that year. Unfortunately though, prices go up over the year, so you won't be able to buy 7% more stuff with the money I give you back. If I want to give you a real return of 7%, this means I want you to be able to buy 7% more stuff at the end of the year. So, if inflation is running at 3%, I would need to give you 100 multiplied by 1.03 equals $103 at the end of the year, just so you haven't suffered from inflation. With $103, you could buy the same stuff at the end of the year with your money that you could at the start of that year. If I want you to be able to buy 7% more stuff at the end of the year when there's 3% inflation, I'd need to give you $103 times by 1.07 equals $110.21. In general terms, 1 plus I equals 1 plus R times 1 plus H, where I is the inflated cost of capital, also known as the money or nominal cost of capital. R is the uninflated cost of capital, or the real cost of capital, and H is the inflation rate. This formula is given to you in the exam. In this case, 1 plus I equals 1.07 times 1.03 equals 1.1021. So I equals 1.1021 minus 1 equals 0.1021, or 10.21%. 10.21% is the inflated or money or nominal cost of capital. So, back to our question. We would discount the inflated cash flows at the inflated discount rate. 10.21 is pretty close to 10%. So let's use 10%. That gets us close enough to the answer, and we can use tables. We discount the inflated cash flows at the inflated discount rate of 10% to give us our present value like this. Just to prove the answer comes out the same if we discount the uninflated cash flows at the real rate of 7%, this $387.65 compares to the $389.40 from before. The difference is very minor and is due to rounding. Remember, we assumed an inflated discount rate of 10% instead of using the precise 10.21%. The difference is in fact insignificant and would be more than acceptable in the exam. Often in longer questions, different inflation rates may relate to different types of cash flows. In this situation, you inflate the cash flows at their own individual rate and then discount them all back at an inflated cost of capital. The inflation rate that you would use to calculate the cost of capital in this case would be general inflation, such as the Consumer Prices Index or Retail Prices Index. Also, sometimes in longer questions, some cash flows are given in today's prices and others are already inflated. In this case, you need to make sure that everything is an inflated cash flow and then discount back using an inflated cost of capital. Alternative terminology for the inflated cost of capital is the money cost of capital or nominal cost of capital. It is for these reasons and others that the general approach in longer questions is to ensure that all the cash flows in your NPV pro forma include inflation and to discount them at the inflated cost of capital. During this video, we've climbed the heights of difficulty as far as advanced net present value calculations are concerned. You should practice longer questions to ensure you're happy with these concepts. We're now going to go on and consider a variety of different questions that use the NPV concept in slightly different ways. Hello. In this video, we'll be considering how to deal with questions that involve a capital constraint, known as capital rationing problems. We may have loads of good ideas for projects to do, all with positive NPVs, but not enough capital to invest. We'll consider how we decide which projects to do. Firstly, let's consider why we have a constraint in the first place. The capital constraint can be described as hard, which means it's externally imposed. This means the money isn't there and that it can't be obtained in time. It could also be described as soft, which means it's internally imposed. This generally means the money is there, but self-discipline means the company doesn't want to spend it all. It may, for example, want to put some aside in case of difficulties. Often, businesses put together a capital expenditure budget to limit their spending on capital expenditure. This isn't to say that if they spent a little more than that, the business will be in financial difficulty. It's just that the company may not want to spend every last penny it has on new projects. To be honest, whether the capital constraint is hard or soft doesn't change the numbers. Either the money's not there, or it is there and the company doesn't want to spend it. Let's work with an example. Suppose the company's identified 4 projects with the following profiles. Now suppose it only has $300,000 to spend. It can't do all the projects, as this would cost a total of $575,000. Assuming that the projects couldn't be delayed and all avenues for finance have been explored, let's consider how it will decide what our investment plan will be. Firstly, we need to know if the projects are divisible or indivisible. A divisible project means that you can do, for example, 40% of the project for 40% of the investment and get 40% of the NPV. For example, if you were buying a chain of shops, you could buy the whole chain or potentially 40% of it. With indivisible projects, it's either all or nothing. For example, investing in a machine to create a new product. You either invest in the machine or you don't. 40% of a machine is not a machine, it's scrap metal. The question will guide you as to whether the projects are divisible or not. Suppose in our example the projects are divisible. The approach we take to solving this problem is very similar to limiting factors that you may recall from earlier studies. We want to direct our investment, when we have limited capital available, to ensure that we maximise the NPV per dollar invested. So our key calculation is to divide the NPV by the initial investment, sometimes known as the profitability index, to help us rank our projects from most favourable to least favourable. For example, for project A, the profitability index is 50 divided by 100 equals 0.5. And for the other projects, we then rank the projects from the highest profitability index down to the lowest, as follows. As we can see, project C is our preferred starting point. It has the highest profitability index because, as we can see, it gives us the greatest NPV per dollar invested, which is an important consideration when you don't have that many dollars available to invest. Let's set up a pro forma for our investment plan. We'll start off at the top of the rankings and work our way down until we've run out of money. In total, we have $300,000 to spend. Let's put that at the bottom of our working. We can afford to do 100% of Project C as we have $300,000 to spend, and the full Project C only takes $125,000. That leaves us with $300,000 less $125,000 equals $175,000 left to spend. So we move on to Project B, which was ranked number 2 on the list. We can also afford to do 100% of Project B, as we have $175,000 left to spend, and the full Project B only takes $150,000. This leaves us with $175,000 less $150,000 equals $25,000. Next on the rankings is Project D. We cannot afford to do a whole Project D, as that will take $200,000 and we only have $25,000 left. However, we can afford to do 25 over 200 equals 12.5% of a project D. Remember, these projects are divisible. This means it will cost us 12.5% times $200,000 is $25,000, and we assume that will generate an additional NPV of 12.5% times $130,000 is $16,250. This means, therefore, that the highest NPV we can generate if we have a capital constraint of $300,000 is $216,250. This is the total of the NPV column. In summary, if the projects are divisible, then we'd want to do 100% of project C, 100% of project B, and 12.5% of project D. If the projects are indivisible, then the only approach we can use is to look at all possible combinations of positive NPV projects, trying to spend as much money as possible, and see which combination gives us the highest NPV. For example, here we could do A plus B, which will give you 150 NPV, or A plus C, which would also give you 150 NPV, B plus C, which gives you 200 NPV, or A plus D, which will give you 180 NPV. So the combination of projects B and C give the highest NPV when the projects are indivisible, and this NPV equals $200,000. We've considered here the impact of having capital constraints and how D company can decide what to invest in to maximum effect. The company should make sure that it is definitely constrained as far as the amount of capital available is concerned before turning away positive NPV projects. It could consider, for example, delaying a project, leasing the assets, or trying to raise more finance. In our next video, we'll consider replacement analysis. Hello. In this short video, we'll be looking at replacement analysis. This is where a company may, for example, need a delivery van in its business and it thinks it may always need one. The question we're considering here is how often should it be sold and replaced with a new one. We'll work with an example here. Suppose the delivery van costs $10,000 brand new, and the company is trying to decide whether to replace the van every 2 or every 3 years. It costs $1,000 to maintain in the first year, $2,000 in its second year, and $2,500 in its third year. If the van is sold after 2 years, its scrap value is $4,000. After 3 years, its scrap value is $2,500. The cost of capital is 10% per annum. Let's first of all work out the net present value of each replacement cycle, starting with the 2-year cycle. If we buy the van, run it for 2 years, and then sell it for scrap, the net present cost of ownership would be calculated as follows. The initial cost, the maintenance costs, the scrap proceeds, all discounted at 10%, gives us present values and an overall net present cost of $9,257 for the 2-year period. Let's now consider the 3-year cycle. If we buy the van, run it for 3 years and then sell it for scrap, the net present cost of ownership would be calculated as follows. The initial cost, the maintenance costs, the scrap proceeds, all discounted at 10%, gives us present values and an overall net present cost of $12,561 for the 3-year period. So, in summary, the net present cost of a 2-year cycle is $9,257, and the net present value of a 3-year replacement cycle is $12,561. It's very tempting to say, given that these are costs, the 2-year cycle is obviously cheaper, so we should go for that. However, this is analogous to saying that if I buy a brand new car and it suffers $10,000 depreciation in 1 year
and a total of $15,000 depreciation over 2 years, that I'd rather suffer $10,000 depreciation than $15,000 depreciation, so I should replace my car every year. It's a good way to talk yourself into getting a new car, but it's not correct because we aren't comparing like with like. It'll be more reasonable to say if I replace my car every year, I suffer $10,000 depreciation every year, but if I replace my car every 2 years, I suffer the equivalent of $15,000 divided by 2 equals $7,500 depreciation a year. So I should in fact replace my car every 2 years. What we've done here is compare the equivalent annual depreciation cost of owning the car for 2 years versus 1 year. The equivalent comparison can be done with net present values by dividing the NPV of a replacement cycle by the cumulative discount factor or annuity factor for that number of years. In this case then, for the 2-year replacement cycle, the equivalent annual cost will be calculated as follows. $9,257 divided by the annuity factor for 2 years at 10%, which, using annuity tables, is $9,257 divided by 1.736 equals $5,332 a year. The equivalent annual cost of ownership for a 2-year replacement cycle is $5,332. Incidentally, what this is telling us is that if we were to hire a van for 2 years and paid $5,332 rental at the end of each year, that'll have the same NPV of $9,257 cost. So you can think of equivalent annual cost as being the same idea as an annual rental charge. For the 3-year replacement cycle, the equivalent annual cost will be calculated as follows. $12,561 divided by the 3-year annuity factor at 10% equals $12,561 divided by 2.487 equals $5,051 a year. The equivalent annual cost of ownership for a 3-year replacement cycle is $5,051 a year. Again, you can think of this as being an equivalent annual rental cost for a 3-year cycle. I would rather pay $5,051 a year compared to $5,332 a year. In other words, the 3-year replacement cycle is more economical. In this video, we've explored how to tackle replacement cycle questions. The key thing to remember here is that you can't compare NPVs of different replacement cycles directly as they relate to different periods of time. You need to divide each NPV by the annuity factor for the length of that cycle to convert the NPV into an equivalent annual cost. Equivalent annual costs can be compared directly. Hello. In this video we'll be considering a couple of financing options for a project we've already decided to do. Suppose you've already done your NPV analysis, assuming that you're going to borrow the money and buy the asset involved in the project. We are now asking the question, could we improve the NPV of that project by leasing as opposed to buying the asset? It's important to note that we've already decided to go ahead with the project, so the actual operational cash flows the project generates is not relevant here. We're only considering the incremental cash flows of comparing leasing versus buying the asset. You need to read the question to find out exactly what the differences are between leasing and buying in the jurisdiction of the question. Typically, it will include the following. If you lease the asset, you pay rentals. These rental payments are incremental to the leasing option, as is the fact that you will receive a tax deduction when paying them. They will be allowable for corporation tax purposes. If you lease the asset, you won't have to pay the initial cost of buying it, but you will also lose the scrap proceeds as you won't have an asset to sell at the end of the lease. Finally, if you lease the asset, you won't own it, so it's unlikely you'll be able to claim capital allowances. Let's work through a question to see how we tackle the situation. Suppose we're considering borrowing at an after-tax cost of 10% to buy an asset at a cost of $10,000 for a 3-year project. At the end of the 3 years, the asset will have a scrap value of $4,000. 25% writing down allowances are available on a reducing balance basis with a balancing allowance or balancing charge for the final year. Alternatively, you could lease the asset at a cost of $2,600 a year payable at the end of the year. This $2,600 is tax deductible. Corporation taxes payable at a rate of 30% per annum, payable in the same year as the cash flows that are being taxed. Should the company lease or buy the asset? There are two alternative approaches to dealing with a question like this. You could prepare two NPV tables, one for leasing and one for buying, and compare the two to see which is cheapest. Alternatively, you can prepare one table, which in one go compares leasing as opposed to buying. We'll have a look at both methods here. Generally, either are acceptable in the exam. First of all, let's have a look at the two-table approach. We'll start off by putting together an NPV table showing the cost of buying the asset. Time across the top, initial cost, scrap value, writing down allowances, we'll come back to this, net cash flow, discount factors at the after-tax cost of borrowing, learn this, to give us net present value. We calculate the value of the tax saved as a result of claiming writing down allowances in exactly the same way as we've seen already. Headings, the first writing down allowance, the second writing down allowance, and the balancing allowance in the final year. Now, let's get that into the NPV table for the borrow and purchase option. Let's now add up, multiply by the discount factor to give us the present values. If we add up the present values, we get a cost of, so negative, $5,483. Firstly, don't be put off by the fact that this is negative. We're only considering the cost of ownership. Secondly, you'll notice we don't put the loan that we take out as a cash inflow. We don't put the loan repayment as a cash outflow, and we don't even put the interest cost as a cash outflow. This is because it's all accounted for in the discount factor. That 10% represents the cost of financing this asset. Let's now have a look at the relevant cash flows associated with leasing the asset. Headings, rental costs, tax saving on the rental cost, add up the relevant cash flows, multiply by the discount factor. This is still the post-tax cost of borrowing of 10%, learn this, and add up the present value to work out the net present cost of the leasing alternative. So, the net present cost associated with buying the asset was $5,483. The net present cost associated with leasing the asset was $4,524. Leasing is therefore $5,483 less $4,524 equals $959 cheaper. All else being equal, we should therefore lease the asset. As mentioned earlier, this can be done through one table. We'll construct the table from the point of view of saying if we lease as opposed to buy the asset. Let's set up the pro forma first. If we lease as opposed to buy, then we will save the initial outlay, lose the scrap proceeds, lose the capital allowances, pay annual rentals and receive a tax deduction for doing so. We then add up all the relevant cash flows and multiply by the discount factor to give us present values, which we then add up to give us the NPV of leasing as opposed to buying. You'll notice that the answer is the same as before. Preparing a table that asks, should we lease as opposed to buy, has a positive NPV of $959, meaning that leasing as opposed to buying is a good thing to do. It is worth considering how you could possibly be better off to lease as opposed to buy, when presumably the company that leases you the asset is also making some money. There are several possible reasons for this. The leasing company may buy in bulk and therefore be able to buy the assets at a discount. The leasing company may have access to cheaper finance, for example if it's a bank. The leasing company may be prepared to take a small loss on the lease itself to encourage the sale to happen in the first place. Finally, sometimes leasing an asset may be the only way a business can finance the acquisition. For example, borrowing may not be possible if it has little to offer by way of security. In this video, we've compared leasing versus buying as two financing alternatives. Remember that the decision to go ahead with the project has already taken place, so there's no need to bring in the project cash flows. We're only considering how the cash flows change if we were to lease as opposed to buy. In this video, we'll have a look at how risk and uncertainty can be built into decision making by considering various techniques the decision maker may use, such as expected values, risk-adjusted discount factor, payback, and simulations. We'll consider sensitivity analysis and certainty equivalence in the next video. Technically speaking, risk and uncertainty are different things. Risk is quantifiable. We're dealing with known possibilities and known or estimable probabilities. An example of risk would be tossing a coin. We don't know whether it's going to be a head or a tail, but we know it's going to be one of those with a 50-50 chance of each. With uncertainty, either we don't know the probabilities and/or we may not know all the possible outcomes. This is therefore more difficult to quantify. Often, one person's risk is another person's uncertainty. If an individual has experience of a situation, they may well have an idea of what may happen and how likely it is to happen. This may not be the case if the situation is new to the individual. We often use the terms of risk and uncertainty interchangeably, but just bear in mind that technically they are different things. There are several ways of dealing with risk and uncertainty in decision making. Let's first consider the use of expected values. An expected value is an average. Suppose we're not certain what revenue will be next year. We think there's a 25% chance that it will be $100,000 and a 75% chance that it will be $200,000. The expected value for revenue next year is calculated like this: 25% times $100,000 plus 75% times $200,000 equals $175,000. If we were using expected values, we would use $175,000 as the figure for sales. This assumes a risk-neutral attitude. If the decision maker uses $175,000, from that point on they are no longer considering that sales could be as high as $200,000 or as low as $100,000. A little extreme perhaps, but imagine if the company will fail completely if sales were as low as $100,000. The decision maker, when using expected values, would therefore not be considering that there was a 25% chance of the company failing. Expected values are therefore a long-run average and are not suitable for one-off decisions. They're also highly dependent on the estimate of probabilities. Another approach that could be taken to deal with risk is to reflect it in the discount rate. Suppose a company's cost of capital is 10%, but it's considering undertaking a project that is riskier than their average. Remember that the cost of capital is there to compensate investors for three things: interest, inflation, and risk. So, if the project we're appraising is a higher risk than others, we can apply a higher discount rate, let's say 15%. It is possible to be more scientific than simply increasing it arbitrarily. More on this later in the course, when we have a look at the marginal cost of capital for investment appraisal. Payback period gives us a measure of risk. A project with a short payback period can be considered to be less risky, as the near future is more knowable than the distant future. We might be very concerned if it takes a long time to pay back, as the conditions that the project operates under could change more dramatically in the longer term than is likely in the shorter term. Lastly, in this short video, let's consider simulations. When we put NPV calculations together, we put our best estimates for what we think the cash flows will be into that calculation. For example, for sales, these estimates are what is known as point estimates. They're a number being used to represent a range of possible values. If we have the information, it would be more accurate to replace these point estimates with a fuller description of that variable, for example by replacing that number with a probability distribution. We may replace one or two numbers, or we may replace all of them with probability distributions. Don't panic. You're not going to be asked to do the maths of this in the exam. You just need to be aware of this as a technique and be prepared to explain it. If some of the point estimates are replaced with probability distributions, the natural conclusion of this is that there won't be a single number at the end of the calculation for NPV. The NPV itself will be a distribution, perhaps like this. The decision maker would need to consider the graph and make their decision based on that. We can see here that the expected or average NPV is $10,000, but the NPV could be higher or lower than this depending on the value of the underlying variables. Although this technique is much more in-depth than using point estimates, it assumes you know the probability distributions, which we may well not do given that we're dealing with the future. In this video, we have considered the various tools and approaches that we can use when building risk into our investment appraisal decisions. There are two more to look at: sensitivity analysis and certainty equivalence, and we consider these in the next video. Hello, this is our last video in relation to investment appraisal, where we will complete our studies of how we build risk into decision making. We will be considering here sensitivity analysis and the use of certainty equivalence. Once we've calculated the net present value, sensitivity analysis turns to the estimates we made in the calculation, and for any one estimate asks the question, how wrong could I be before the decision changes? In other words, how much different from that estimate will the number need to be before it turns out that I made a mistake in my initial conclusion? If the answer is it has to be very different, I'm probably feeling reasonably comfortable. If it only has to be slightly different before the decision changes, I'm very sensitive to that variable. For example, let's suppose we have calculated the NPV for a project to be positive $50,000. Within the calculation, there was an estimate for the initial investment of $1 million. Our initial conclusion would be to go ahead with the project, given it has a positive NPV. In fact, we'd be happy to go ahead with the project, provided the NPV is not zero or negative. For every $1 increase in the cost of the initial investment, the NPV will fall by $1. In other words, initial investment could increase to $1,050,000 and the project would still be viable. At $1,050,000, that initial investment cost has increased by $50,000 and has therefore eliminated the positive NPV. The NPV would be zero. We would typically express the sensitivity with the following calculation. 50,000 divided by 1 million equals 5% sensitivity. A lower percentage sensitivity means that only a relatively small movement in the value of that variable will change the decision. In other words, a lower percentage means we are very sensitive to that variable. In more general terms, we can calculate the percentage sensitivity as follows. NPV of the project divided by NPV of the cash flows affected by the variable. Now, suppose we're interested in the sensitivity of our project's NPV to sales price. Revenues are, let's assume, $250,000 each year for 5 years. Corporation tax is at 30%. The cost of capital is 10%. As previously mentioned, the NPV of the project is estimated to be $50,000, and on that basis, we may well decide to go ahead as a preliminary conclusion. Let's now consider the sensitivity of our decision to sales price. The net present value of the cash flows affected by sales price is as follows. $250,000 before tax is worth $250,000 times 1 minus 30% equals $175,000 after tax each year for 5 years at a discount rate of 10%. The present value of after-tax revenue is therefore $175,000 times the 5-year annuity factor at 10%, which equals $175,000 times 3.791 equals $663,425. If, for example, sales price halved, NPV would reduce by 0.5 times $663,425 equals $331,713. So we can afford to lose $50,000 divided by $663,425 equals 7.5% of sales revenue before we reduce our NPV down to 0. In other words, if sales price falls by 7.5%, we will eliminate NPV. We are therefore 7.5% sensitive to sales price. The same approach can be taken with the vast majority of cash flows that have gone into the NPV calculation. The decision maker can then focus in on the variables they are more sensitive to make sure that their estimates are reasonable. There are a couple of exceptions to this though, sensitivity to the cost of capital and sensitivity to the life of the project. Firstly, let's consider sensitivity to the cost of capital. With our project, the NPV at 10% is $50,000. Do you remember what the internal rate of return tells us? It is that discount rate that yields an NPV equal to 0. Suppose for our project the IRR has been calculated at 14%. This means if our estimate for the cost of capital of 10% turns out to be wrong, it will change our decision if the cost of capital turns out to be 14% or higher, because at that point the NPV equals 0. In other words, we would need to be 14 less 10 divided by 10 equals 40% wrong. We are 40% sensitive to our estimate for the cost of capital. Finally, with sensitivity analysis, let's consider sensitivity to the life of the project. Our 5-year project has an NPV of $50,000 positive. Suppose we rerun the calculation as if the project was a 4-year project and the NPV turns out to be approximately 0 if it only lasts for 4 years. The percentage sensitivity to the life of the project will be calculated as follows. 5 less 4 divided by 5 equals 20%. Although sensitivity analysis can be a useful guide to decision makers to focus their attention on the key variables in a decision, it does have its drawbacks. It only looks at one variable changing at a time. In reality, they'll tend to change together. A simulation may be more appropriate with more than one variable changing. It doesn't come with a decision rule. Does a sensitivity of 6% mean we don't go ahead? That's down to the judgment of the decision maker. There are no rules to help make the decision. Even though sensitivity analysis tells us how wrong we would need to be in order for the decision to change, nowhere in our analysis does it include how likely we are to be wrong. For example, on the face of it, a 1% sensitivity to price might be worrying to the decision maker. However, if they have a signed contract in place guaranteeing what the price will be should they go ahead, there is in fact no need to be concerned. Finally, let's consider certainty equivalence. This is something we tend to do naturally. Consider the receipt of $1,000 we may be receiving in a month's time. If you're absolutely certain it will arrive, we may include it in our forecasts as $1,000. If you're reasonably certain but not absolutely certain it will arrive, we might include it at, say, $900. If we think it could possibly arrive but we're not at all certain, we might include it at, say, $250. In effect, what we're doing here is restating the possible $1,000 as a certainty equivalent. For example, we're saying a possible $1,000 is worth the same as a certain $900, for example. Let's consider how this might be examined. Consider the following estimated forecast cash flows for revenue in a project. T1 $100,000, T2 $200,000 and T3 $250,000. Relevant certainty equivalent factors are as follows: T1 0.9, T2 0.8, T3 0.7. These certainty equivalent factors would need to be given to you in the question, or at least you would have to be given enough information to be able to work them out. Suppose the cost of capital is 14% and the risk-free rate of return is 10%. The risk-free rate is the rate of return required to compensate investors for interest and inflation only, i.e. no premium is included for risk. The present value using certainty equivalence will be calculated as follows. Start off by writing out the estimated cash flows. Multiply the estimated cash flows by the certainty equivalent factors. This strips out the risk from the cash flows and turns them into risk-free certainty equivalents. The certainty equivalents should then be discounted at the risk-free rate. There's no risk anymore in the cash flows, so we don't need a risk premium in the discount rate. There's nothing wrong with this calculation in principle, but in practice, the certainty equivalent factors cannot consistently be derived from anything objective. They will in effect be subjective, made-up numbers, which potentially undermines the accuracy of the overall answer. This brings us to an end of the investment appraisal part of the syllabus. Investment appraisal questions require a methodical approach. They're often quite numerically intensive, but with plenty of question practice and an orderly approach, they are eminently passable.
Hello. In this presentation, I'm going to look at sources of finance, i.e. how and from where organisations will raise the finance they need in order to operate. This analysis and discussion makes up the financing decision referred to in the Objectives of Financial Management presentation. Specifically, this presentation will cover the general concepts underlying the decision, short-term sources of finance, long-term sources of finance, implications of the decision made, raising equity, rights issues, and Islamic finance. Let's look at each of these in turn. General concepts underlying the financing decision. There are two basic guidelines to bear in mind as you consider and compare the various sources of finance that are potentially available. 1. The link between risk and return. This is discussed further below. And 2. There are two parties involved in a financing transaction, namely the lender and the borrower, and there must be benefits to both if the transaction is to go ahead. Imagine a scenario where you have £1,000 to invest. You could put your money into a bank or building society account. However, whilst your money would be safe, you are extremely unlikely to lose the money, you will not generate a particularly attractive return. Alternatively, you could consider putting your money into a company, i.e. buy shares. Unlike the previous option, your money is certainly not safe. Indeed, there is a very real possibility that you could lose your £1,000. This begs the question as to why you would take the risk. The simple answer is the potential to make a much higher return. In other words, you would only take the risk if there is the potential to get a higher return, and the higher the risk is perceived to be, the higher the potential return required. Ultimately, a risk may be seen as so high that you cannot foresee the necessary return and so will not be prepared to invest. Short-term sources of finance. There are a number of ways that a company can raise money where the need is short-term, i.e. up to around 12 months, and it is important to consider the pros and cons of each. Some of these sources are considered below. An overdraft is a facility whereby an organisation can spend more money than it has in its account. Effectively, it is spending the bank's money rather than its own and will be charged interest for the privilege. There is also likely to be a penalty fee imposed where the facility is not agreed with the bank in advance or where agreed limits are exceeded. An overdraft is quick and easy to arrange and is very flexible in that you only use what you need to at any point in time. The interest rate incurred is likely to be higher than that on a loan. However, it can still work out cheaper as interest will only be applied to the amount used rather than the whole amount agreed as with a loan. The major drawback of an overdraft is that it can be recalled by the bank at any time. A short-term loan is an advance of money by a bank or similar institution to a company for an agreed period of time, and, like the overdraft, is relatively quick and easy to arrange. Interest will be applied to the outstanding loan balance periodically. To some extent, the pros and cons are the opposite of those explained above in relation to the overdraft, i.e. it cannot be recalled unless any pre-agreed terms and conditions are breached, and it is a lower rate of interest. Conversely, it is less flexible and interest will be applied to the whole balance even if the company does not require it all at a particular time. Commercial papers are issued by companies and are effectively a formal IOU agreement. They enable organisations to raise relatively large amounts very quickly and are extremely flexible in that the terms can be whatever the company and the investor agree. A slight drawback is that they can only be issued by very large companies with excellent credit ratings. Trade payables, whilst not normally thought of as a source of finance, is effectively borrowing from your suppliers. It is a readily available, free source of finance. However, companies should guard against damaging the goodwill with a supplier. Payables are discussed in more detail in the Management of Receivables and Payables presentation. Long-term sources of finance. Where the financing need is longer than 12 months, the sources can be categorised between debt and equity. Strictly speaking, equity refers to raising money by issuing ordinary shares. However, preference shares are sometimes considered under this heading. Investors acquiring shares are referred to as shareholders, and in the case of ordinary shareholders, they are the owners of the company and will be entitled to vote on matters raised in open meetings. In return, they may receive a dividend if the directors deem sufficient funds are available. The attraction to the company is the flexibility to only pay what they can afford, whilst the attraction to the shareholder is the potential to make a limitless return. Preference shareholders do not usually get a vote, and dividends that are paid, like the ordinary dividend, is at the discretion of the directors, are a fixed percentage of the nominal value. For example, 6% £1 preference shares will pay a dividend of 6 pence, 6% of £1, assuming one is paid at all. Preference dividends have to be paid before ordinary dividends, and in the case of cumulative preference shares, dividends not paid in 1 year are carried forward to the next. Accordingly, in the above example, if the 6 pence is not paid 1 year, 12 pence can be paid in the 2nd year, 18 pence in the 3rd, etc. A company must be fully up to date with preference dividends before it can consider paying anything to ordinary shareholders. Debt can be raised either in the form of a loan, the considerations discussed above will still apply, or via what might be termed tradable debt, i.e. debt that can be sold on from one investor to another in much the same way that shares are traded. The company will issue a debenture certificate, similar to a share certificate, as proof of monies invested, and the funding may be referred to as debentures, bonds, loan stock, debenture loan stock, etc. More detail on debentures can be found in the cost of debt presentation. Another source of debt finance is the use of leases, and these again will be the subject of a separate presentation. Implications of the decisions made. A company will need to consider the pros and cons of particular sources within the context of their individual circumstances. However, a major consideration will be the implications of using debt as opposed to equity. There are advantages to using debt, not least of which is that it is usually cheaper than equity due to the lower risks faced by the investor. The costs of debt and equity will be covered in separate presentations. Other advantages will include: interest will usually attract tax relief, making it even cheaper still. The fact that interest must be paid makes cash flow forecasting easier and can act as a discipline on management that they understand and plan their cash resources. Taking on debt can send a signal to the markets that management have confidence in their cash flows, as otherwise they would presumably not wish to burden themselves with debt obligations. Conversely, as referred to above, debt brings with it a financial obligation in that interest and potentially the redemption of the loan have to be met. Failure to do so may result in the company being forced into liquidation. Consequently, A company that cannot meet its interest obligations, or even is perceived to be unlikely to meet them, is seen as a high risk. This higher risk level may increase the cost of debt or potentially make debt sources unavailable. Summarising, whilst there are benefits to using debt, the company must guard against taking on financial obligations that it cannot meet. The debt level can be assessed and compared to industry norms by calculating the gearing level, debt as a percentage of equity, and interest cover, PBIT divided by interest, which assesses the ability of the company to pay its interest. Raising equity. Where a company already has shares in issues, any new shares must, in the first instance, be offered to existing shareholders. This is called a rights issue and is discussed in more detail below. Where a company is looking to issue shares for the first time, or where they have existing shareholder permission to do so, a company can issue shares externally, i.e. to new investors. In so doing, they will want to do so as quickly and cheaply as possible. Accordingly, their first choice is likely to be a placing, i.e. they place the shares to be issued with an institutional investor. Merchant banks will assist in identifying potential investors. However, there will be a limit as to how much can be raised via this method. For large share issues, a public offer is likely to be used. Now, shares can be obtained by anybody. However, it will be expensive, as the issue will need to be advertised, administered, and underwritten. Underwriting refers to an institution agreeing to buy up any shares not subscribed for by the public. Any shares bought up in this way will usually be acquired at a discount to the issue price, and there will be a fee paid to the underwriter even if their services are not ultimately required. Rights issues. When a company wants to raise capital by issuing new shares, in the first instance these shares have to be offered to existing shareholders. In other words, existing shareholders have the right, known as preemptive rights, to first refusal on new shares. Usually these shares are offered at a discount to the current share price. 18 to 20% is typical, and this will cause a dilution of the share price. The price at which the shares will trade after the issue is referred to as the theoretical ex-rights price, or TERP, and can be calculated as follows. Imagine that a company offers a 1-for-4 rights issue at a 20% discount to the current share price, the cum rights price, of £2. This means that an existing shareholder has the right, though not the obligation, to buy one new share at the rights price of £1.60, £2 less a 20% discount, for every 4 shares currently held. To calculate the TERP, consider a shareholder who holds 4 shares worth £8, 4 times £2. If they exercise their right to buy the new share at £1.60, they will then own 5 shares worth £9.60, £8 plus £1.60, which produces a share price of £1.92, £9.60 divided by 5 shares. As referred to above, shareholders are not obliged to take up the rights offered and are also entitled to sell them to other investors who are interested in buying shares in the company. In theory, the rights will be sold for the difference between the TERP and the issue price. So £1.92 minus £1.60 equals 32 pence in the above example. In practice, the rights value will be influenced by the desirability of the share purchase. Based on theoretical values explained above, the wealth of an investor will remain the same as long as they do something, i.e., either exercise or sell the rights. It should also be noted, however, that a shareholder who sells their rights will relinquish some of their control. Islamic finance. Islamic finance is a rapidly growing area in finance and is not just restricted to Islamic banks. Islamic finance products are products that are Sharia compliant, i.e. acceptable under Islamic law. This is an extremely complex area, and this presentation is not intended to give more than an overview. However, there are two basic principles. One, the earning of money from money, i.e. interest or riba, is immoral. Instead, money should be earned from business endeavour. And two, traditional debt approaches are unfair in that the lender receives a guaranteed return irrespective of the borrower's outcome. For example, the lender receives the agreed rate of interest, let's say 5%, whether the funded business makes 0% or 20%. Accordingly, Islamic finance products are all concerned with sharing the risks and rewards in some way, and examples of products include the mudaraba is a form of partnership whereby one partner provides capital and one provides expertise. Profits are shared according to a predetermined agreement, however, all losses are borne by the lender. The musharaka, similar to the mudaraba, however, all parties input capital and all parties can be involved in the management of the business. Profits are shared according to a predetermined ratio, while losses are shared according to capital amounts input. The muaraha. A bank acquires assets at the request of a client and sells them to the client at a markup, often for a deferred payment. The markup reflects the services provided by the bank and the risk carried by the bank that the client may not complete the purchase. Ijara is similar to a traditional lease, and a bank will purchase an asset and rent it to the company for a predetermined period. At the end of that period, a new current rate can be agreed for a subsequent period of use. Thank you.
Welcome to F9 Financial Management. In this section, I will go over capital structure theories and practical considerations. In this video, we are going to look at the traditional theory of capital structure. We're then going to look at Mogliani and Miller's theory of capital structure. And finally, we will look at the pecking order theory. The traditional theory of capital structure. What is the ideal capital structure? What is the ideal balance between debt and equity financing? As I've said in earlier videos, a little bit of debt is believed to be good for the WACC, as it will lower the cost of finance. This is the traditional view of capital structure, which is represented in this graph. The cost of finance is lowest when there is some debt. But look, once a certain gearing level is reached, the cost of capital dramatically increases. As we discussed in video sources of finance and their relative costs, the gearing that debt finance introduces to the capital structure can cause many issues that cause the WACC to increase. Once debt goes over a certain level, the cost of equity and debt increases. The traditional view is realistic. But what is the problem with this theory? The main issue with the traditional theory is that apart from trial and error, we don't know what level of gearing will reach the optimal level. We don't know how much gearing will affect the cost of equity and debt, and by how much. We can only just try and get this balance right. Modigliani and Miller's theory of capital structure. Their theory argues that investors are rational and their required rate of return of equity is directly proportional to the increase in gearing. So there is a linear relationship between the cost of equity and the gearing. So the increase in the cost of equity offsets the benefits of cheaper debt finance. So the WACC is unchanged. Let's look at the graph to demonstrate their theory. As you can see, the WACC lies between the cost of debt and equity on the graph. It is constant. As any increase in the gearing will increase the cost of equity, it is offset by the cheaper debt financing. So the WACC remains the same. There are a few key assumptions that Modigliani and Miller's theory makes. Firstly, that there is no corporation tax. Secondly, that it operates in perfect capital markets where all investors have the same information and they react rationally to it. And finally, that there are no transaction costs and that debt is risk-free. Now, seeing the assumptions that underpin this theory, you can imagine that there were many criticisms, particularly that it assumed no tax. When looking at capital structure, tax is very important. Why? Because the interest payable on debt is tax deductible, so impacts on the cost of debt. So the model was revised to include tax. This model still assumed perfect market conditions and that investors were rational and the required rate of return of equity is directly proportional to the increase in gearing. The adjustments were that since debt interest is tax deductible, the cost of debt is less than the original theory. This reduced debt cost means that returns are more predictable. Since returns are more predictable, the costs of equity, in other words, the investor's expected return, do not go up as much as the initial theory did without corporation tax, as it did when gearing went up. This is because debt is not seen to introduce as much risk to investors as the initial theory. Since the increase in the cost of equity does not completely offset the benefits of cheaper debt, the WACC falls as gearing increases. And that is, in a nutshell, what it is. The WACC falls as gearing increases because the introduction of corporation tax makes the debt financing, it reduces the risk that the debt financing is seen to introduce. So, what does this mean? The revised theory indicates that the WACC reduces with gearing and that the company should use as much debt finance as possible to increase the market value of the company. This is very different from what you might have learned so far, and there are a few strong arguments against adopting Modigliani and Miller's theory. The first one is that increased gearing increases bankruptcy risk. If shareholders become concerned about bankruptcy, they will sell their shares in the company. The share price will drop and the WACC will increase. Debt financing, as you learned in earlier videos, can place restrictive conditions on companies and limit the activities of management. Charges can be placed on assets restricting management activities. Other restrictions that debt financiers can place on an organisation is restrict the levels of dividends that can be paid to shareholders. They can also limit the level of debt that the company can take on. So the level of debt a company can take on has a limit, one that is imposed by the debt financiers. Tax exhaustion. This means that after a certain level of gearing, the interest charges cannot be offset against tax. This increases the cost of debt. Modigliani and Miller's theory assumes perfect capital markets to operate. In the real world, our markets are not perfect, and these market imperfections are another argument against their theory. Specifically, it assumes that in a perfect market there are no concerns about bankruptcy. And by now you are very aware that this is something investors do worry about and will want higher returns to compensate for this risk. Now, let's look at the pecking order theory. This theory states that organisations have a preferred hierarchy for financing. They'll firstly use internally generated funds like retained earnings. These funds are available and there are no transaction costs such as administration fees associated with them. Then the company will look to use debt financing. There are a lot of benefits of debt financing. As we've said, it is cheap. It can reduce the WACC. If it is secured by an asset, it is even cheaper. And there is far less work that goes into raising debt finance than equity finance. And debt financing is suitable for shorter term projects because it can be paid back and there is no control sacrificed. The last option a company will look at is raising equity finance. Raising finance in this way, for example through a share issue, is very time consuming. There is an awful lot of administration fees and administration work to be done, and it would need to be for a permanent investment as the company is diluting control by raising this finance. They will also have to consistently invest resources in maintaining shareholders' relations. So, how would this theory impact on investment? This theory means that the value of a project would depend on how it is being financed. It also means that some projects will only be undertaken if they can be funded internally or with risk-free finance. And the pecking order theory means that companies with less cash and higher gearing will be more prone to underinvest.
Hello. In this presentation, I'm going to look at the cost of equity, both from a calculation and a meaning perspective. Equity was introduced in the Sources of Finance presentation, and it may be beneficial to watch that presentation first if you've not already done so. Specifically, this presentation will cover what the cost of equity represents, methods for calculating the cost of equity, the dividend growth model, estimating growth, and the capital asset pricing model. Let's look at each of these in turn. What the cost of equity represents. The cost of equity is the return required in order to satisfy equity shareholders. As discussed in the Sources of Finance presentation, dividends are not guaranteed, and neither is it certain that share prices will increase. Despite this, shareholders invest in the hope or expectation that one or both of these things will happen. Indeed, it is this variability or uncertainty in the outcome that is described as risk, and given that the risk, i.e. variability, is high, the return required, and therefore the cost of the company, will also be high. Despite all of the above, even though a shareholder return is not guaranteed, companies still need to be aware of the return required to keep investors happy in order that they can allocate funds to appropriate projects. It is the estimation of the return required that we turn to now. Methods for calculating cost of equity. Broadly, there are two approaches to estimating the cost of equity. One, dividend growth model, and two, capital asset pricing model, or CAPM. I deliberately use the term estimate rather than calculate, as there are drawbacks or weaknesses to both approaches. Accordingly, when considering the two approaches, it is important to consider the calculation itself, assumptions made, and weaknesses or drawbacks. Let's look at each approach in turn. The dividend growth model. The dividend growth model values a share as the present value of its future expected dividend stream. In other words, it assumes that when an investor is determining how much to pay for a share, they 1. Estimate the dividend stream, 2. Determine their required return, and 3. Discount the dividends at the required rate of return to arrive at the share price to be paid. Whether this actually is the thought process that investors go through can be challenged. However, using this process, if a company knows the share price and can estimate the dividend stream, they can calculate the discount rate applied, i.e. the return required by shareholders. This is represented by the following formulae. For preference shares, the cost of preference shares, KP, equals the dividend D divided by the current share price, P0. For equity shares, the cost of equity, KE, equals the dividend in 1 year's time, D1, divided by the share price now, P0, plus G, the percentage growth in dividends per annum expressed as a decimal. D1 can also be shown as D0 multiplied by 1 plus G, the current dividend increased by a year's worth of growth. The slight difference between the formula for preference and equity shares is simply because the preference dividend is a fixed percentage and doesn't grow. The drawbacks of this approach are 1. The validity or otherwise of the underlying assumption of the investor's thought process discussed above. 2. It can only be applied to companies whose shares are listed and regularly traded, i.e. they have an accurate share price. 3. It can only be applied to companies who pay a dividend. 4. It assumes that dividend growth rates are constant. And 5. It assumes that the dividend growth rate can be estimated. This last point is discussed further below. Estimating growth. As discussed in the Sources of Finance presentation, dividends are paid at the discretion of the directors based on their assessment of the company's finances at that point in time. Accordingly, nobody can accurately predict in advance the rate at which dividends will grow. Notwithstanding this fact, the dividend growth model requires an estimate to be made, and there are two mathematical approaches that may be adopted. One, based on historic rates. If the latest dividend paid is 50 pence, and recent dividends have been 45 pence, 42 pence, 40 pence and 39 pence 4 years ago, then the dividend has grown from 39 pence to 50 pence over the period. The average rate can then be estimated as the fourth root of 50 divided by 39, which gives 1.064. If you then subtract 1, you are left with 0.064 or 6.4%. It is assumed that this same rate of growth will continue moving forward, albeit this is another assumption whose validity can be questioned. 2. Growth is calculated as B multiplied by R, where B is the balance of earnings retained and R is the return earned. Imagine a company has assets of £100 and makes a return on those assets of 20%. In the first year, the company will earn a profit of £20, 20% of 100. If the company decides to pay a dividend of £5, it will retain the other 15, and so the assets now invested are £115. Assuming the 20% return is maintained, the profit in year 2 will be £23, 20% of 115. Comparing the £23 in year 2 to the £20 in year 1, this represents a growth rate of 15%. This growth is predicted by B multiplied by R, as 75%, the proportion of the £20 profit retained, multiplied by 20%, the return earned, is 15%. Capital Asset Pricing Model. CAPM links the return required by shareholders to the level of risk they face. It does not, however, consider all of the risks as described here. In simple terms, there are two types of risk faced by a company. 1. Unsystematic or specific risk, which are the risks linked specifically to a particular organisation, and 2. Systematic or market risk, which are the risk of being in the market. As a generalisation, when markets fall, all shares fall, and when markets rise, all shares rise. Unsystematic risk can be diversified away by holding a portfolio of investments. For example, if you hold shares in one company and that company is involved in exporting to the USA, you are exposed, amongst other things, to an exchange rate risk. If you buy shares in a second company that imports from the USA, you are now exposed to the same risk, but in the opposite direction. Accordingly, you are no longer exposed to exchange rate risk and so have reduced the overall risk. By holding more and more shares, individual or specific risks can gradually be reduced, and it is estimated that you can largely eliminate unsystematic risk with a portfolio of around 15 to 20 shares. A first assumption of CAPM is that if you can diversify, you will, and therefore unsystematic risk can be ignored. Whilst this may be largely true for institutional investors who employ fund managers for that very reason, it is less appropriate for individual investors. CAPM then assesses the cost of equity by comparing the risk-free return, the return required from a risk-free investment, to the market return, the return required given the average market risk, and is given by the following formula. Cost of equity, KE, equals RF plus RM minus RF multiplied by the beta, where RF is the risk-free return and RM is the market return. Alternatively, RM minus RF is the market premium. Beta is a risk score assessed by comparing the historic volatility in a share price with the volatility in the market during the same period. A beta of 1 indicates that the company's risk is the same as the average market risk. A beta higher than 1 indicates a higher than average risk. A beta lower than 1 indicates a lower than average risk. The drawbacks of CAPM are: it assumes that all investors hold diversified portfolios. It assumes that the historic risk relationship estimated by the beta holds true moving forward. It assumes that reliable figures for RF and RM can be established. In practice, the return on government stocks is often taken as an indicator of risk-free. Finally, it can be argued that having only one indicator of risk is too simplistic. Thank you. Hello. In this presentation, I'm going to look at cost of debt, i.e. the cost to the company of servicing its debt obligations. Debt was introduced in the Sources of Finance presentation, and you may wish to watch that first if you have not already done so. Specifically, this presentation will cover the meaning of the cost of debt, the cost of bank loans, the cost of irredeemable debt, the cost of redeemable debt, the cost of convertible debt, and terminology. Let's look at each of these in turn. The meaning of the cost of debt. As discussed in the Sources of Finance presentation, when a company is looking to raise finance, there must be benefits to both the borrower and lender. The benefits to the company were discussed elsewhere. However, it is important to also think about the benefit to the investor. In short, this is a guaranteed rate of return. Guaranteed in the sense that the company cannot choose whether or not to pay, in the way that it can with the equity shareholders' dividend. The return itself can be provided in a number of ways, namely, interest on outstanding amounts, paying back more than was borrowed, i.e. a premium on redemption, or anything else that may be attractive to a potential investor, sometimes referred to as a debt sweetener. The company does not need to provide all three elements, but merely to find a combination of one or more of the three that is sufficient to satisfy investors. Ultimately, it is the combined cost that is of interest to the company and must be calculated. The way or ways in which the return is provided will impact on the way that the cost of debt is calculated, and we will now look at these techniques. It is the cost to the company of providing the necessary return that is represented by the cost of debt. The cost of bank loans. When a company borrows from a bank, they will repay the original loan or principal as well as interest. Interest will be calculated periodically on the outstanding principal according to the loan agreement. The calculation of interest was considered in a little more detail in the discounting presentation. With a bank loan, the amount borrowed is the amount repaid, i.e. there is no premium on redemption, and so the only cost is the interest. It is important to remember, however, that, unlike dividends, interest is tax deductible. In other words, if a company pays interest, this is an expense that will reduce its profit and therefore its tax bill. Accordingly, the cost to the company is the interest rate applicable to the loan multiplied by 1 minus t, where t is the tax rate. If a company takes out a loan at 6% and the tax rate is 25%, the cost of the loan is 4.5%. That's 6% multiplied by 1 minus 25%. To demonstrate this tax deductible aspect, consider two companies, A and B, who both have profit before interest and tax of 100. Company A has an interest expense of 10, thereby reducing their PBT, profit before tax, to 90. If we now deduct tax at 30%, Company A will pay 27, 30% of 90, and B will pay 30, 30% of 100. The PAT of the two companies is therefore 63 and 70 respectively. The end result is that although A has paid 10 in interest, its profit after tax has only decreased by 7, 70 minus 63. This could have been predicted as 10 multiplied by 1 minus t, or 70%, is 7. The cost of irredeemable debt. Irredeemable debt is debt that is never repaid. Initially, this appears to be a very strange concept, i.e., why would you lend money knowing that it would not be repaid? However, it is important to remember that we are talking about tradable debt, and as such, the original lender can simply sell the debt to somebody else when they want their money back. In many ways, this is exactly the same as when an equity shareholder buys shares in a company. They will have no expectation that the company will buy the shares back, but are free to sell them at any time. Indeed, the cost of debt can be calculated using the dividend growth model introduced in the cost of equity presentation. The one difference is that, as discussed above, interest is tax deductible, and so the formula becomes interest I multiplied by 1 minus t divided by the current price P0. Debentures are usually issued with a nominal value of 100, and this would be assumed to be the case unless you are told to the contrary. They may trade at a higher or lower than this figure, depending on the attractiveness of the debenture. This latter number is described as the market value and can be expressed either as a monetary value or as a percentage of the nominal value. For example, a company has some 5% irredeemable debentures in issue trading at 95%. The 5% denotes the rate of interest expressed as a percentage of the nominal value. If the tax rate is 20%, what is the cost of debt? Well, I equals 5% of 100, which equals 5. T is 20% or 0.2. And P0 is 95% of 100, which equals 95. So the cost of debt equals 5 multiplied by 1 minus 0.2 divided by 95. That equals 0.042 or 4.2%. The CAPM method, introduced in the cost of equity presentation, can also be used if you have a debt beta for the company. The cost of redeemable debt. Redeemable debt is debt that is bought back or redeemed by the company that issued it. This is usually at a predetermined time and price. For example, 5% debentures 2018 denotes that the debentures will be redeemed in 2018 and that interest at 5% of the nominal value, assumed to be 100 in the absence of anything to the contrary, will be paid in the meantime. Redemption will take place either at par, at the nominal value, at a premium, at higher than the nominal value, or at a discount below the nominal value. A debenture being redeemed at a premium would usually offer a lower interest rate than one being redeemed at par or at a discount. This is because the lender will benefit from the gain on redemption and so does not need so much interest to entice them to invest. Accordingly, the total return is made up of interest and a premium on redemption, and so the dividend growth model approach, which only considers the interest element, can no longer be used. Instead, an IRR approach must be adopted. It is probably easiest to look at this from the perspective of an investor buying a single bond. Let's look at the following example. A company has 5% redeemable bonds in issue, currently trading at 95%. Interest is paid annually and they are due to be redeemed at a 10% premium in 4 years' time. Tax rate is 20%. What is the cost of debt? Split your page into 6 equal columns. Head the first column time and the second column pounds. On the first row, enter 0 under time and negative 95 under pounds. On the second row, enter 1 to 4 under time and 4 under pounds. Finally, on the third row, enter 4 under time and 110 under pounds. These first 2 columns show the cash flow for an investor buying a single bond. Namely, pay out £95 immediately to acquire the bond at its market value, and then receive interest for each of the next 4 years and the redemption value in 4 years. Because we're trying to calculate the cost of debt to the company, it is shown net of tax. So £100 multiplied by 5% multiplied by 1 minus 0.2 equals £4. Redemption is at a 10% premium, so the amount received will be £100 plus 10%, which equals £110. It can be seen that the investor gets more back, 110 plus 4 lots of 5, than they invest, 95. And we can use the IRR approach to estimate the percentage return achieved. Firstly, choose a percentage that is likely to be somewhere near the final answer, For example, 5%, although other percentages would be equally acceptable. In the third column, enter the discount factors for 5% and each of the time periods. At time 0, the discount factor is always 1. The interest is received each year, and so the annuity table is used. The debt is only redeemed once, so the present value table is used. More guidance on using discount tables can be found in the discounting presentation. In the third column, you can now add the 5% discount factor on each row, and then in the fourth column you can multiply the cash by the discount factor to arrive at negative 95, 14.18 and 90.53 on each row. Adding the column down, the present value is 9.71 positive. The fact that it is positive indicates that the actual return is higher than 5%, and so the discounting process is repeated using a figure higher than 5%. I have used 10%, however, other figures were equally acceptable. The discount factors in column 5 will be 1, 3.170 and 0.683, and the present values in column 6 will be negative 95, 12.68 and 75.13, which produces a total present value of negative 7.19. The numbers calculated can now be used in the IRR formula. A, the lower of the two percentages used, plus NPVA, the NPV at that percentage, divided by NPVA minus NPVB, the difference between the present values, and multiplied by B minus A, the difference between the percentages. In this example, plugging the numbers into the formula, you get 5 plus 9.71 divided by 9.71 minus 7.19 and multiplied by 10 minus 5. This produces a cost of debt of 7.87%. Note that you may get a slightly different answer if you have used different percentages initially, and hence the cost derived can only be an estimate. The cost of convertible debt. Convertible debt is essentially redeemable debt. However, at redemption, the debt holder has the option to receive equity shares rather than cash. The number of shares received is defined by the conversion ratio. For example, if a £100 bond can be converted into 20 shares, the ratio can be expressed as 20, or alternatively, that one share equals £5 of bonds, 100 divided by 20. The cost of debt is calculated in exactly the same way as the redeemable debt. However, on the last row you use the higher of the redemption value or the conversion value, the assumption being that given the choice, this is how the debt holder will decide. The conversion value is the number of shares received multiplied by the market price per share. Imagine you are offered a convertible bond currently trading at £105 that has the option to convert into 20 shares. If the debt holder was making the decision today, they would sell the debt for £105 rather than converting for £95. Further, this can be expressed as a conversion premium of £10, 105 minus 95, or 10.5%. That's 10 divided by 95, the conversion premium divided by the conversion value. Whilst conversion is not currently attractive, it should be remembered that there will often be an assumption that share values will increase over time. Specifically, in this example, share prices would need to increase by 10.5% before the conversion option started to become attractive. Companies will want to set the premium low enough to be attractive to investors without offering more shares than is necessary. Assuming that the conversion option is attractive, i.e. it has a value to investors, the company will not need to offer as much interest as on non-convertible debt. Terminology. Finally, you may come across the following terms in conjunction with tradable debt. Debentures may also be described as loan notes, loan stock and bonds. The interest rate is described as the coupon rate. Debentures that don't pay any interest, i.e. they attract investors in other ways, are described as zero coupon. A debenture that is issued below its nominal value, thereby increasing the premium on redemption, is described as a discounted bond. Where the discount is high, typically 15 to 20%, the term deep discounted bond is used. Thank you. In this presentation, I'm going to look at the weighted average cost of capital, or WACC. In separate presentations, I have covered the cost of debt and the cost of equity, being the returns required to keep debt holders and shareholders satisfied. In practice, firms will often raise finance from a number of sources simultaneously, and so they will need to be able to calculate the overall or average return required. Specifically, this presentation will cover the meaning of the WACC, calculating the WACC, limitations of the WACC, and a project-specific cost of capital. Let's look at each of these in turn. The meaning of the WACC. When investors put money into a company, whether they do so in the form of debt or equity, they are looking for a return on their investment. In order that the company can make appropriate investment decisions, i.e. ensure the return anticipated is sufficient, they need to estimate the level of return required. An added complication is that different investors face different levels of risk, and so will have different expectations as to the return they require. Accordingly, the various returns required have to be averaged to obtain the overall cost to the company, and it is this that is referred to as the weighted average cost of capital. Calculating the WACC. The easiest way to approach the calculation of the WACC is to think of it as a four-step process. 1. Identify the sources of finance. 2. For each source, identify the market value. 3. For each source, identify the cost. And 4. Combine the information in the WACC formula. Sources of finance have been discussed separately in the sources of finance presentation, and similarly the cost of debt and equity have been covered elsewhere. The market value of finance will be the value at which the source can be traded. For equity, this equates to the number of shares in issue multiplied by the share price, whilst for debt, this will be the number of bonds multiplied by the quoted price per bond. Remember that this quoted price can also be expressed as a percentage of the nominal value. Finally, if one of the sources is a bank loan, it does not have a market value, it cannot be traded, and so the loan amount is used instead. The WACC formula can be expressed as the cost of equity multiplied by the market value of equity and divided by the market value of equity plus the market value of debt, i.e. the cost of equity multiplied by the proportion of the total finance represented by equity. This is added to the cost of debt multiplied by the market value of debt and divided by the market value of equity plus the market value of debt. This assumes that there are two sources of finance, one equity and one debt. However, any number of sources can be accommodated by applying the above logic, i.e. the cost multiplied by the proportion of the total represented by the source under consideration. Limitations of the WACC. As discussed in the Sources of Finance presentation, there is a direct link between the risk faced by investors and the return required by them. Accordingly, when a company calculates its WACC, it is based on current risk levels. The limitation this presents is that if they are trying to identify the return that will be required from a project under consideration, they are, in effect, assuming that the project will not change the underlying risk profile of the company. Further, the WACC can only be used where this is the case. The risk profile refers to both the relative proportions of debt and equity, the financial risk, and the business area of the new project compared to the current company, the business risk. If either or both of these changes, then it is no longer appropriate to use the existing WACC as the measure against which the project is assessed. If this is the case, then a marginal or project-specific cost of capital should be derived and used to assess the project. This process is discussed further below. A project-specific cost of capital. As discussed above, the total risk faced by an organisation can be broken down into two elements. One, business risk, and two, financial risk. It is essential that the return required from a project takes changes in both of these into account to ensure that the anticipated return is sufficient compensation for the risk taken on by investors. Where a project being considered will change the business risk of an organisation, the following approach can be adopted. 1. Find a similar company that already operates in the new business area, a proxy company, and identify their beta. Betas were introduced in the cost of equity presentation. This beta recognises the total risk profile of the proxy, both business and financial, and is referred to as an equity or geared beta. 2. Whilst this beta reflects the business risk of the new project, it is unlikely that relative debt levels in the proxy and the project will be the same. Accordingly, strip out the financial risk of the proxy, referred to as ungearing the beta, using the following formula. The equity beta multiplied by the value of equity divided by the value of equity plus the value of debt net of tax, added to the debt beta multiplied by the value of debt net of tax divided by the value of equity plus the value of debt net of tax. If the debt beta is 0, the second half of the formula can be ignored, and the value of debt net of tax is simply the value of debt multiplied by 1 minus t. 3. The new beta derived in step 2 only reflects the business risk and is referred to as an asset or ungeared beta. Before this can be used, therefore, it needs to be adjusted to reflect the finance risk of the company. The process for doing this is the opposite of the ungearing in step 2, uses the same formula as above, and is referred to as re-gearing. 4. The beta now obtained is an equity beta for the company that reflects the business risk associated with the new business and the finance risk associated with the debt levels of the underlying business. Using this beta in the CAPM formula will calculate an appropriate cost of equity, which can in turn be used to calculate a WACC. Thank you.
In this section, I will go over finance for small and medium-sized entities, otherwise called SMEs. In this section, we are going to look at the financing needs of small businesses, the financing problems for small businesses, solutions to solve small businesses' financing problems, and the financial impact of sources of finance for SMEs. The financing needs of small businesses. Small businesses, like large ones, need money to fund their activities and working capital. Yet it can be much more difficult for smaller businesses to get finance than larger ones. Small businesses often find it very difficult to get credit, but they are in the difficult position where often they have to offer credit to their customers to remain competitive. Small businesses are typically new and without a track record or a history, and it is very difficult to secure finance as they are seen as riskier than larger organisations by financiers. Small businesses need to fund their startup costs, be able to supply credit to their customers, which is one aspect of their working capital that they will need to fund. As well as these costs, they need to fund. SMEs will need funds for their future, to grow their business, to invest in profitable projects. Financing is extremely difficult, as you can see, for smaller organisations, and the sources of finance available to them are limited, and much more so than the sources available to larger organisations. Typically, the sources of finance available to an SME is retained earnings, so these are previous year's profits, bank borrowings. Bank loans can be very difficult for small businesses to get. I'll go over the reasons for this on the next slide. It is often remarked that SMEs can get a long-term loan, such as a mortgage, and not a short or medium-term loan. This is referred to as the maturity gap, and it means that SMEs can find it very difficult to match short-term projects with short-term finance if the only source of finance available is a long-term source. Why is this? Because long-term loans are easily secured, or easier secured, by an asset which the company could have. So you could secure a long-term loan such as a mortgage against a company property. However, the bank will not offer a short-term loan with the same asset against it, and the company will not have the track record to get the short-term loan. Another source of finance available is from seeking additional finance from their current shareholders. So, for example, a rights issue. It is quite difficult to sell additional shares in a small company, much more so than for a larger quoted company. To seek money from existing investors assumes that they have the finances to invest, which is often not the case. Often, a small company's main investors are the founders themselves, who have already exhausted their savings trying to set up the business. Increasing your investment in an SME is not very attractive for many investors, as they will not be able to sell their investment as they could on the stock exchange. Another point I want to make is that these are unlike stock exchange investors who have studied the market and buy shares to diversify their portfolio and to get high returns, etc. Often, SME investors invest for a very different reason. They invest because of, say, a friendship, or because that they really believe in a product or the service being provided. SME investing is very risky, as most do fail within 2 years. A funding gap occurs when SMEs want to expand and need more finance than what is available to them. But they are not yet big enough to get access to the funding available from the stock exchanges. They are not ready or able to apply to the stock exchange or the alternative investment market for a stock exchange listing to raise this finance. Financing problems for small businesses. So the lack of available credit is a big problem for SMEs. Why is this? As I already said, they are often new businesses, so they have no credit history. Often they have no assets that can be used as collateral. Also, smaller businesses are more vulnerable to market forces. Therefore, their situation can change quickly. This volatility would deter financiers, and if they do decide to lend, they will monitor the activities of the SME and can place many restrictions on them. So, by now, you should be fully aware that it is difficult for SMEs to get finance, and they face difficulties such as lack of collateral, the maturity gap, and the funding gap. So what can be done to ease these problems? Here are a few alternative sources of funding that can bridge the funding and the maturity gap. Venture capitalists. They offer finance for an equity stake in a business. They give large sums to high growth companies. Venture capitalists are a department of most major finance providers. Since they don't offer smaller funds than typically less than $100,000, for businesses seeking a smaller investment, there are business angels. Business angels are wealthy individuals who typically offer smaller sums to high-growth businesses. Often, they offer business expertise to help that startup. This is a very risky investment for the business angel. So they will want a high return or a big stake, as in percentage ownership in the company for their investment. Are you familiar with TV shows such as The Dragon's Den or The Shark Tank? The investors in these would be classed as business angels. I recommend you watch an episode of these shows. Although they are for entertainment purposes, they will give you an idea of what this type of investor wants to know. Another financing option is crowdfunding, which is also called peer-to-peer financing. This is where businesses seek funding from the public at large. They may want to raise $100,000, but each investor may donate as little as, say, $20. The business will showcase their product and display their future plans, and sometimes pre-sell their product. This is a very popular option for startups, as it serves as a marketing platform, and the organization can test their product on the target market and assess the market's reaction to their offering. There are fees to be paid with this source of finance, and normally, if the organization does not reach its target investment, they don't get the investment. So it can create pressure. Check out the crowdfunding website Kickstarter to get a sense of what information companies are providing. Supply chain financing is where the organization can get credit in their supply chain to fund working capital. So, for example, they get 30 days credit from suppliers, or perhaps customers pay in advance for a product or service. It is hard for new companies to get trade credit, but if they do, it's great because it's free. Government intervention. Small businesses and startups are very important to the economy and to the country's jobs market, so governments often take measures to fund them. There are two main ways this is done. They increase the marketability of the organization's shares, or they can provide tax incentives to the investors. Increasing the marketability of an organization's shares has been done in some countries by creating a small firms market. By creating this, smaller organizations can sell their shares more easily than before to the public, raising equity. This is also much more attractive to those who are investing because it increases the marketability of the shares, and they can sell them on if they need to realize their investment. Providing tax incentives to investors, to small firms, means what it says. It often gives investors who have a high tax bill a win-win situation. They can offset some or all of their investment, even if it is profitable, against their tax bill, depending on the type of tax incentive being offered, of course. This takes a lot of risk out of investing in smaller firms, so if the investor doesn't receive a return on their investment, they can still reduce their tax bill. Governments often use these types of incentives to stimulate areas in the economy. So, for example, to develop environmentally sustainable energy, or the film industry. Other ways governments assist SMEs is by providing grants and small loans. These are very useful for organisations who cannot access bank financing. Welcome to F9 Financial Management. In this section, I will go over sources of finance and their relative costs. Please review F4's videos on loan and share capital to revise the basics. In this video, we are going to go over the following: debt versus equity, the creditor hierarchy, issues with high levels of gearing, and using the weighted average cost of capital versus the capital assets pricing model in investment appraisals. You'll have seen this from earlier videos, that there are two categories of finance within a business: debt and equity. Debt financing is sourced from outside the organisation, a bank loan is a common source of debt financing. The costs of debt financing is the interest rate charged by the lender. This will depend on a variety of factors: the creditworthiness of the organisation, the current market conditions, the amount of finance being sought, etc. Debt financiers often require collateral for loans and will take a charge or can take a charge over companies' assets. If the company fail to keep their side of the agreement, the financier can take the asset. Companies' creditors can put the company into receivership and liquidate the company if they are not making their loan repayments. Because of this, debt financing is seen as adding more risk to a company. In business, every investment has a risk. Some shareholders and business owners believe that debt financing is good because the risk associated with it motivates the directors to work hard and create a return to meet the loan repayments. Using debt financing to fund an organisation increases the organisation's gearing. You should already be familiar with gearing, which I will go over later in more depth. Equity financing is sometimes called internal financing, as it is the shareholders' funds. It can be mistakenly viewed as free finance because, unlike a bank loan, there are no scheduled loan or interest repayments. But these are the shareholders' funds in the form of share capital and retained earnings, etc. These investors want a return for their money invested. This return is the cost of finance. And this is the opportunity cost also associated with their funds, because they could put it into another project. Equity financing will reduce gearing, but it can also reduce the current shareholders' power. So, for example, by issuing more ordinary shares, you're diluting the current shareholders' control in the company. So, debt versus equity financing. When looking at finance, you will need to assess debt and equity financing under these following headings. So firstly, gearing and financial risk. Debt, as I've already said, increases the gearing, and financial risk, equity, reduces it. So the target capital structure. So the goal of target capital structure is to minimise the weighted average cost of capital. Debt is a cheaper source of finance initially. It must be controlled because otherwise the company will risk financial distress. Equity reduces gearing, and to obtain the ideal capital structure, a mixture of debt and equity need to be maintained. Collateral. Debt finance, as I've said, often requires collateral, which will place a fixed or floating charge over the asset. Equity funders don't receive collateral, so the organisation doesn't need an asset to offer a charge over, but instead they have ownership and control of the company. Economic forecasts and expectations. This will dictate the type of loans that the company will undertake. If they expect interest rates to drop, for example, they may choose a variable interest rate loan. And then when investors are looking at their economic forecasts and expectations, they will have certain ones and the returns that they would expect that their investment to achieve. Control. Mentioned this a few times. Debt financing increases the risk but does not dilute the control in the company. So if a company gets a bank loan, the lender cares about the repayments of their loan. They don't have an involvement in how the company is run and how these repayments are made. However, equity financing does have control. The shareholders own the company and have control, so they will have an input into different decisions. The creditor hierarchy. You should already be familiar with this from earlier videos, but let's go over it in more depth. You should know from your studies of investment that the greater the risk, the higher the return. When we examined investment appraisal, you learned about the risk premium applied to investment projects. When an organisation is seeking finance, it is flipped. Instead of appraising the investment, you must view as the organisation as the investment. With this viewpoint, let's look at the creditor hierarchy and the costs associated with the finance. In the event of a winding up of a company, debt financing is paid before equity holders, who are paid after all creditors. First paid are the debenture holders. These are the lenders who secured a fixed charge over an asset. The asset is usually in the form of property, like land and buildings. Since these lenders didn't take a high risk, they had security over the finance that they loaned to the organisation, so the cost of this finance is relatively lower than the following creditors who come after them in the creditors hierarchy. Creditors who had a floating charge over the assets such as inventory. They are more protected than unsecured creditors, but they're also not first paid like the secured creditors who have a fixed charge. Then we have the creditors who are protected by the law. So, for example, in many countries, tax authorities and the employees must be paid before unsecured creditors and shareholders. Next to be paid in the hierarchy are the unsecured creditors. For example, suppliers will be paid. Then we have the equity holders. So the preference shareholders are paid back their investment. And then, after everybody else is paid, we have the ordinary shareholders. They take the most risk. As you can see, they are the only group who didn't get a predetermined amount. All creditors have received amounts billed and the preference shareholders received back their investment, but the ordinary shareholders will receive the balance. As you can imagine, this can be much higher than their initial investment, meaning they can make a big return. But from this hierarchy, you can also see they may receive much less than they invested. Ordinary shareholders face the greatest risk, and their finance as a source for the company is the most expensive. Its cost is the risk-free rate of return plus the risk premium attached to it. The cost of equity finance is also the investor's required rate of return. Given that equity financing is expensive, why not just borrow all the finance? Debt financing, as you've learnt from previous videos, increases the company's gearing. It is acknowledged that some level of debt financing is good for the weighted average cost of capital of a company because it is a cheaper source of finance. But high levels of gearing pose many problems. A highly geared company is considered more risky and is more vulnerable when there is a downturn. This could be in the economy or in consumer demand for the company's product. If they experience dropping sales, they cannot meet the loan repayments. This may cause them to be put into receivership, putting the company into a winding up situation. If they are not wound up, but experience repayment difficulties, the organisation can damage its credit rating, which will reduce finance available to them in the future and may even prevent certain suppliers supplying them with credit. The cost of servicing loans will reduce profits, reducing shareholders' dividends and returns. This could cause them to sell their shares, leaving the organisation open for a hostile takeover. As you can see, there are a plethora of problems associated with high gearing, and this is why having a proportionate amount of equity finance is considered to strengthen a company, and it will be able to service its debt requirements during a downturn, avoiding the problems we've just discussed. So, how do you know if a company is heavily geared? It is important to look at the industry that the company is in. What is the debt to equity ratio of similar sized companies? If it is similar, then it is at an acceptable level. However, if it is significantly higher, it may be too highly geared, and efforts should be made to reduce it. To measure gearing in an organisation, you can calculate it with the following ratios. I discussed ratios in F3 ratios. I recommend that you look at this video and earlier ones. With these ratios, you can look at the extent of the gearing of an organisation and compare it to similar organisations and to the previous years of the company. First is the debt to equity ratio, where you divide the total debt by the total equity. This shows a debt as a percentage of equity. The higher this number, the more highly geared the organisation. Now there is the interest cover ratio. This takes the earnings before interest and taxes divided by the total interest. The higher this number, the better, as it shows the organisation's ability to service its debt. What this number should be depends on the company and the attitude of their investors. A 2 or higher is considered sound, but some companies may require a higher number and others a lower one. Next is the equity ratio, where equity is divided by the asset value. This will indicate the level of leverage of the company and how much of their assets are financed with debt. The higher this number, the more assets are financed by equity. And finally, the debt ratio. This ratio looks at how much the assets have been financed by debt. The total debt is divided by the total assets, and the higher this number, the higher the gearing, and the more assets that have been financed by debt rather than by equity. Debt financing is a very important part of business financing. It is cheaper than equity, as I have said, and its interest costs are tax deductible. However, as you can see the problems arising from gearing, it must be managed carefully. Another type of gearing is operational gearing. This examines the relationship between fixed operational costs and the organisation's overall operating costs. This is examined with the following ratio: fixed operational costs divided by the total operating costs. The higher this number, the more operationally geared this organisation is. This means that if they experience a downturn, they will still have to incur these fixed costs, making it a more risky organisation. On the flip side, with high levels of operational gearing, the cost does not increase with high levels of production and consumer demand, so the organisation can get higher profit margins and avail of economies of scale. Operational gearing is determined by the industry the organisation is in. However, as the organisation can suffer serious losses when demand dips, they will need to forecast and manage this. The gearing we have discussed is risk for the shareholder, and cash flow forecasting can manage this risk, as management will predict future cash flows and match this to debtors' requirements and their equity holders' rates of return. Obviously, their forecasts may not always be accurate, but some future planning is needed, and it can help manage equity holders' expectations. Funding an asset. One of the main reasons an organisation undertakes financing is to get an asset. They can do this by leasing the asset or borrowing to buy the asset. Leasing finance agreements have changed a lot in recent times, and it is important that you do read the terms and conditions of these agreements carefully, particularly over the area of ownership of the asset. But typically, when leasing an asset, the organisation doesn't own the asset, or doesn't own it until the final lease payment is paid. The leasing company does, and if the organisation fails to make any of their repayments, the leasing company will take the asset back. Leasing agreements differ, but they may offer additional support like maintenance, which will reduce the risk of ownership If, say, for example, the asset breaks down, they may also replace the asset if it does break. And if the organisation, for example, no longer wants or needs the asset, they can exit the agreement. So while they may have to pay a penalty clause to do this, but again, it offers greater flexibility. When an organisation borrows to purchase the asset, they incur all the risks and the rewards of ownership, and the extra supports that were available, say, under lease agreements, may not be available. They'll have to get them separately. However, the asset will be theirs. If they no longer need the asset, they'll have to sell it. It's not a case of paying a penalty clause and the asset is taken away. As you can see, owning an asset is riskier than leasing it, and obviously the lease repayments are a little bit more expensive. The management will have to analyse the costs of both options. An NPV analysis is good to do this. So when we are looking at the mix of debt and equity capital, we are looking at the cost of each. How do they impact the investments that are made? Well, as you've seen from investment appraisals, the discount factor used is largely based on the cost of capital, and a risk premium is then added depending on the project's risk. So the lower the cost of capital for a company, the lower the discount factor, and the more projects will get a positive NPV when assessed. The weighted average cost of capital can be used in investment appraisal when the project is relatively small, the current capital structure is maintained, so the debt and equity structure remains the same. The project has the same business risk or operating risk. Business risk arises from the nature of the organisation's operations, so their operations will remain pretty much the same. So what if the company has a project that doesn't meet this criteria? When we look at the capital asset pricing model, which you will have seen in earlier videos, this model examines the cost of equity, which is based on the risks faced by the shareholders. What are the advantages of the CAPM over the WACC when management wants to decide the cost of capital of a specific project? CAPM is used to look at projects that have a different business risk than the company's normal business risk. This model focuses on the shareholders and to maximise their wealth. The model can set the required rate of return that the shareholders want. This may be higher than the WACC given the project has a different risk profile. So let's apply the CAPM. ABC Incorporated had difficulty sourcing finance after the global recession, and it is an all-equity company with a beta of 0.7. Management are looking at investing in a one-year project, which requires an initial investment of $10,000 now. The project will give an expected return of $12,500. This project has a beta of 1.4. The risk-free rate of return is 10% and the market rate of return is 18%. So, looking at this example or this question, what is ABC's cost of equity? So pause this video and attempt. Have you done it? We know that the company has a beta of 0.7. This project has a beta of 1.4, so the risk profile is very different. If this was a risk-free investment, the beta would be 0. The risk-free rate of return is 10% and the average return from the market is 18%. ABC's cost of equity is found by the risk-free rate added to the market risk premium, which is multiplied by the company's beta. So that is 10% plus and then 8% multiplied by 0.7. This gives us a result of 15.6%. So now, what is the cost of financing this individual project? Pause this video and attempt to calculate this now. So, have you done it? Okay, let's begin. The risk-free rate added to the project's beta multiplied by the market risk premium. So 10% plus, and then we've got the risk premium of 8% multiplied by the beta of the project, which is 1.4. That gives a result of 21% and 0.2. So 21.2%. This is substantially higher than the company's cost of equity, but the risk profile of this project is also much higher. Now, should the company invest in this project? Pause the video and calculate your answer. Done? First, we calculate the expected return of the project. So, in 1 year, the cash flows will be $12,500. Deduct this from the original investment of $10,000 and divide it by 10,000. And the return, or the expected return, is 25%. This is above the minimum expected return for the investor, which is 21.2%. So it should be selected. Now, you've probably spent a lot of time looking at the NPV when you're assessing investment projects. So would the NPV tell us that this is a good project? Let's calculate it. So, as you can see from your calculations, the NPV is a positive one. It returns $313. So it is positive, showing that yes, the project should be selected.
Hello. In this presentation, I'm going to look at the area of business valuations, including an overview of the various methods that can potentially be adopted. Specifically, this presentation will cover introduction and rationale, an overview of valuations, share-based approaches and the EMH, asset-based approaches, dividend-based approaches, earnings-based approaches, and cash flow-based approaches. Let's look at each of these in turn. Introduction and rationale. As is discussed in the Financial Management Objectives presentation, one of the decisions that finance managers have to make is the investment decision. As is also covered, one aspect of this is the decision to invest in other companies, i.e. the acquisition of other companies. If this is to happen, the company will need to decide how much the target company is worth, i.e. how much it should pay. This is, however, only one reason why a business valuation may be required. A company may wish to value its own business either because it is the subject of a takeover bid or because they wish to float the company on a stock exchange. An overview of valuations. In many ways, there is no such thing as the correct value of a company. Indeed, the only true value is the value that two parties agree on for the transfer of ownership from one party to another. Having said that, as discussed in the introduction above, both companies will need to form an opinion as to the amounts they are willing to pay or accept in order that they can negotiate to a final price. In simple terms, the seller will need to identify the minimum price they are willing to accept and the buyer the maximum they are willing to pay. Assuming the maximum is higher than the minimum, certainly not guaranteed, then somewhere in between the two is a figure at which both parties would be willing to trade. The exact figure within the range will be determined by the relative bargaining power of the two parties. How much the seller wants to sell, how much the buyer wants to buy, etc. We will now look at some of the approaches that the parties might adopt in arriving at a range of valuations that they can negotiate within. Share-based approaches and the EMH. Many companies already have a value in that they have a share price. The company value can then be derived by multiplying the share price by the number of shares in issue. In order for this to be a valid approach, however, the company must be listed, i.e. it must have a share price. The shares must be regularly traded, i.e. the share price must be current, and the market must operate efficiently, i.e. the share price must be adjusted quickly and accurately in the light of new information. Market efficiency is concerned with how quickly and accurately a market interprets available information and updates share prices accordingly. One interpretation of this final aspect is provided by the efficient market hypothesis, or EMH. This states that markets operate at one of three levels of efficiency. A weak form efficient market will only consider things that have actually happened, including past share purchases. It will not reflect latest information with regard to expected future performance. As such, the quoted share prices cannot be guaranteed as up to date. A semi-strong form efficient market will include all historic information as described above, however, will also include all information that is in the public domain. A strong form efficient market will include all of the above, however, in addition it will reflect information not in the public domain, i.e. that held privately by directors. It is difficult to see how this can be achieved in practice. An individual investor can outperform the market if they are able to operate at a higher level of efficiency than the market. Accordingly, a weak form market will be beaten by an investor that operates in a semi-strong way. In the same way, a semi-strong market would be beaten by a strong investor. However, taking advantage of private information, known as insider dealing or insider trading, is illegal. Asset-based approaches. A company can be valued as the value of its net assets, i.e. assets minus liabilities. The simplest way to assess this is based on book values. However, these do not necessarily reflect the amount that would be achieved in a sale. As such, a realizable value, the amount generated from a sale of the assets, will provide a more accurate valuation, albeit it is more difficult to assess. Limitations of the asset-based approach are: it ignores the value of intangible assets, and it ignores the fact that the company can be used to produce future profits and cash. The asset-based approach is likely to produce a valuation towards the bottom of the negotiation range and is only really valid when liquidation is the only other option for the seller. Dividend-based approach. The dividend-based approach values a company as the present value of the future dividend stream that would be earned if the target company continued under current ownership. Effectively, it is offering equity shareholders a lump sum now that equates to the value of dividends that are expected to be received in the future. This approach is most appropriate where a minority shareholding is being valued, as it does not include any premium for control. For example, if a 10% shareholding is worth £10 million, you would expect to pay more than £60 million for a 60% shareholding due to the control that would be acquired. The value can be calculated as the dividend in 1 year's time, divided by the cost of equity of the target company shareholders minus the expected dividend growth rate. Weaknesses of this approach are: it is difficult to estimate the dividend growth rate. The model assumes the dividend growth is constant. Not all companies pay dividends, and this model would value such businesses at nil, and the model would produce a negative value for an organisation where the dividend growth rate is higher than the cost of equity. Earnings-based approach. A company can be valued as a multiple of its earnings. Earnings are the profits that are distributable to equity shareholders, and the multiplier is provided by the price earnings or PE ratio. The PE ratio is effectively a measure of confidence that the market has in the company. In other words, it reflects market expectations of growth set against inherent risk levels. The valuation is simply the earnings multiplied by the PE ratio. However, an unlisted company will not have a PE ratio. This can be overcome by using an industry average PE ratio, or better still, using the ratio of a similar company, referred to as a proxy, that is listed. Obviously, the resultant valuation will be limited to the level of similarity that can be achieved between the target and proxy companies. It is also common practice to reduce the proxy company PE to reflect the difference in status. Adjusting downwards by a third is typical. Cash flow based approach. The final approach involves treating the acquisition of a new company in the same way as any other capital purchase, i.e., estimating the present value of relevant cash flows via an NPV. The cash flows should include any benefits from the acquisition known as synergies. For example, it may be the case that the buyer would move the target staff into its own premises and sell off some of the target's property. Allowance should also be made for the replacement of the non-current assets of the target moving forward. In other words, if the buyer acquires the target and distributes all profits to shareholders, over time the assets of the target will start to wear out and need replacing. Finance will be required to achieve this, and the funds that are available to be distributed without jeopardizing this aspect are sometimes referred to as free cash flows. Thank you.
Welcome to F9 Financial Management. In this section, I will go over the valuation of debt and other financial assets. So, if we wanted to get debt financing, we would approach a bank and get a loan, or at least attempt to secure a loan. This is the same for small businesses. But large businesses and organisations can issue debt. You've already learnt about debt that can be issued and traded on the financial markets. But how does the company value this debt, and how does the investor put a value on this debt that they invest in? Traded debt takes on many forms, and they are called loan notes, loan stock, debentures, and bonds. They are all traded debt, and investors assess their value based on their expected return. In this section, I will cover the valuation methods to value irredeemable debt, redeemable debt, convertible debt, and preference shares. What is the market value based on? As I said, the value of traded debt and any asset, when you think about it, is based on the expected returns of the asset. Debt is traded in nominal amounts of $100 and offers an annual coupon rate. Its value is dictated by its expected returns. The expected future returns are then discounted to the present value based on investors' expected rate of return. What affects expected rate of returns? As I have said before in earlier videos, the risk-free rate of return affects the expected rate of return. This will set the boundary for what is the minimum return investors expect. If banks offered a 10% return for monies held on deposit, then investors would expect to receive more than 10% return for their investment. If the next year the banks lowered their return, only offering a 4% return, this would mean that investors would require a lower rate of return for their investment, and the value of debt assets would increase. The current value of debt is determined by the current expected returns of that asset. So, for example, an investor expects their investment to be worth $1,000 in 5 years' time, and the current cost of finance is 10%. We use the discount factor at 10%, which is the cost of finance or the investor's expected rate of return, and get the current value of the investment. It is $620.92 if you calculated it. Now, between today and 5 years, a lot can happen, completely changing the value of this return. But today, the expected return of this asset, which is expected to be $1,000, so this is what we base the value on. So, how do we value irredeemable debt? Let's start with what it is. It is debt that has no fixed repayment date. Instead, the company pays interest on the debt annually. The interest rate is also referred to as the coupon rate, which is paid in perpetuity. So let's look at an example. Longevity Incorporated has 6% irredeemable debt in issue. Investors required a return of 9%. What is the value of the debt? We value this debt as follows. We assume $100 nominal value at 6%. We know that $6 are being paid to investors annually. We also know that this is irredeemable, so technically this will be paid forever. What does that tell us? It is paid in perpetuity, so we must discount it on this basis. How do we get the discount factor of a perpetuity? 1 divided by OR, where OR is the discount rate. It is the expected market return. So here 1 is divided by 0.09, which is the expected market return, 9%. So what is the value of this irredeemable debt? $6 multiplied by 1 divided by 0.09, which is $67. Next, how do we value redeemable debt? Redeemable debt is repayable on a certain date. It is issued and has an interest rate attached to it. Sometimes it is repayable at a premium. Let's look at how it is valued here. XYZ Incorporated has 5% debt that is redeemable to investors in 5 years. The investor's expected rate of return is 6%. Knowing what you know from valuing irredeemable debt, and that its value is based on the expected returns, pause this video and calculate the value of XYZ Incorporated's debt now. Have you done it? Okay, so we assume that the nominal value is $100, so the question does not mention a premium. So at the end of 5 years, the $100 will be repaid to investors and they will receive 5% interest annually. So we also know that investors expect a 6% return for their investment. So let's put this information together and calculate the present value of the future returns. In this table, you can see the annual cash flows. The investors receive $5 a year, which we get from the coupon rate. In year 5, they also receive back their initial investment of $100. These cash flows are discounted at 6%, which is the investor's expected rate of return. Total, the present values, and the market value is $95.79. This should look familiar to you. It is very similar to valuing projects. Now, what if XYZ Incorporated paid a premium of 20% after 5 years? Assuming everything else remains the same, I want you to pause this video and calculate this. Done it? So let's start with calculating the premium that they will pay. It is 20% of the nominal value. So that is $100 multiplied by 20%, which is $20. This means in year 5, the investor will receive $120. You can see the calculations on this table. Now, the investment is worth $110.74 since the premium increases the expected return of the asset. Its value increases. Because as you know, the value of the asset is based on its expected returns. Now, let's look at convertible debt. What is it? This is initially debt. However, on the repayment date, the investor can choose to convert their debt into a fixed amount of equity. So, for example, Indigo Incorporated has 5% debentures that are convertible in 5 years' time into 30 shares in the company. The current share price is $2, and this is expected to increase to $5.50 in 5 years' time. Investors expect an 8% return per annum. So, what is the market value of these debentures? First, we must find the future expected returns. In 5 years, investors can choose to receive their initial investment of $100 back, or they can receive 30 shares which are expected to be worth $165 in total. Well, looking at this, what would you choose? I hope it's converting the debt to shares. It's worth $65 more. Remember, they don't need to keep them. They can sell them on the stock market and receive $65 cash more than their initial investment. Pause the video here and calculate the value of this convertible debt. Have you done it? So, in the table you can see the annual interest or coupon rate of 5%, which is $5. And then in year 5, the expected value of the shares is calculated, and the value of the investment is worth. Now, I know you are thinking that the share prices could just as easily fall, and you're right. The valuation of the convertible debt is only based on the expected return at the time, and as the expected return changes, so does its value. So an investor may ask, or an examiner may ask you, what is the floor value of this investment? How low can it go? So let's look at the example again. What if the share prices do not go up in value? So the investor will have the option of their $100 initial investment, or $30 worth $2, so $60 in total. Now we calculate the floor valuation as follows. See the table. It is $88. The floor valuation is how low this investment can go, and in this case, the investors will get back their initial investment of $100. Now, let's look at valuing preference shares. These are an interesting mix of debt and equity, and you have heard a lot about them. But how are they valued? Like debt, there is redeemable and irredeemable preference shares. They pay a fixed interest rate or coupon rate, which is paid annually. Let's look at an example. Preferred Incorporated has 10% preference share capital, and investors' expected return is 5%. Pause the video and calculate this. Have you done it? Was it familiar? Since the question didn't mention anything about redemption date, I am going to assume that there is none, and that 10% or $10 will be paid into perpetuity. So what is its value? Like irredeemable debt, we find its value as follows. So it's $10 multiplied by 1, which is divided by 0.05. That's the 5%, which is the investor's expected return. And that equals $200. Now, what if the company sold these preference shares that were redeemable after 5 years? How would you calculate that? Pause and give it a go. Have you done it? Okay, let's look. So it is just like the redeemable debt. The annual interest payable is 10%, which is $10 per year, discounted, and at the end of 5 years, investors receive back their initial investment. Now, just to finish off, I want to discuss the interest yield and the redemption yield. The interest yield is defined as the coupon rate divided by the market value at 100%. So ABC Incorporated has 5% debentures trading at $15. The interest yield is $5. Redemption yield. This is the overall return per annum. The interest plus any gain on repayment. Thank you.
Hello. In this presentation, I'm going to look at exchange rate risk, both in terms of what it is and how it can be managed. As was discussed in the Sources of Finance presentation, there is a direct link between the return required by investors and the risks that they face. Accordingly, it is essential that businesses both identify and attempt to manage risk, of which exchange rates is one example, in order to keep the cost of finance as low as possible. Specifically, this presentation will cover exchange rate mechanics and terminology, types of exchange rate risk, managing translation risk, managing economic risk, and managing transaction risk. Let's look at each of these in turn. Exchange rate mechanics and terminology. An exchange rate is effectively the cost of buying one currency with another. For example, a rate of $2 to the pound indicates that if you have £1, you can use it to buy $2, notwithstanding any transaction costs. You have exchanged your pounds for dollars. The same relationship could be expressed as 0.5 pounds to $1, and either way, the rate at which the currency could be exchanged now is referred to as the spot rate or spot. An added complication, however, is that banks or similar institutions offer different rates depending on whether you are buying or selling a currency. Accordingly, rather than seeing the rate expressed as $2 as above, you may see it quoted as $1.97 to $2.03. The difference between the numbers is called the spread, and this is part of the profit that the bank makes on the arrangement. If you think of a bank as a trading organisation, they will buy at a low price and sell at a high price. Unfortunately, this means that businesses will buy at a high price and sell at a low price, the exact opposite of what they would like to do. Let's look at an example. Imagine you are a UK business that has $1 million that it wishes to exchange for pounds, and the spot rate it has been quoted is $1.97 to $2.03 to the pound. Firstly, you should always consider the exchange from the perspective of your domestic currency. So in this case, as a UK company, we need to think in terms of pounds. We are going to use the dollars to buy pounds. We will buy at a high price, the opposite of what we would like to do, and we will receive £492,610.84, being $1 million divided by 2.03, the higher of the two rates. Finally, if the spot rate of $2 moves to $1.90, buying dollars has become more expensive for a UK company. £1 will now only buy $1.90 compared to $2 previously, and the dollar is said to have strengthened against the pound. Saying the pound has weakened against the dollar would be exactly the same thing. Types of exchange rate risk. There are broadly three types of exchange risk. In mathematical terms, risk simply means a variability in the possible outcomes, and the wider the range of possible outcomes, the higher the risk is said to be. In this regard, therefore, a currency moving in favour of the organisation would be a risk in the same way that a move against would be. Notwithstanding this fact, the word risk is used in everyday language in a negative way. We only talk about the risk of something bad happening, and even in business we tend to worry more about the downside. Management of the risk will be covered later in the presentation. However, the risks themselves are explained below. Translation risk is the risk that the value of an overseas asset will change when the asset is translated into a company's domestic currency for inclusion in its accounts. For example, imagine you hold an asset worth $1.2 million. At the start of the year, when the exchange rate was $3 to the pound, the asset value in the UK accounts was £400,000, 1.2 million divided by 3. At the end of the year, when the asset value was $4 to the pound, the asset value appears to have fallen to £300,000, 1.2 divided by 4, a loss of £100,000. Economic risk is the risk that the currency in a country where we operate will weaken, thereby reducing the equivalent performance expressed in domestic currency terms. For example, imagine a business makes a profit of $15 million each year in 2 consecutive years. The average exchange rate was $1.5 to the pound in year 1 and $2 to the pound in year 2, producing a profit expressed in pounds of £10 million in year 1 whilst only £7.5 million in year 2. Although in dollar terms the performance has been maintained, expressed in pounds the performance appears lower in year 2 than in year 1. Transaction risk is the risk that the value of a transaction denominated in a foreign currency will change due to exchange rate movements between the contract being agreed and monies being transferred. For example, a UK company entered into a contract to sell goods for $900,000 when the exchange rate was $1.5 to the pound, i.e. the equivalent of £600,000. By the time the contract is completed and monies transferred, the exchange rate has moved to $2 to the pound. Accordingly, although the contract goes according to plan and generates sales of $900,000, in sterling terms sales have fallen to £450,000. It is worth a reminder that whilst all of the examples above show a downside risk, i.e. a worsening of the position, companies could just as easily benefit from exchange rate movements. Managing translation risk. The easiest way to manage translation risk is to match foreign assets with foreign liabilities, i.e. use foreign currency finance to purchase the assets. The impact of this is that if the asset falls in value in domestic currency terms, the liability will also fall in value, thereby offsetting the loss in asset value. Managing economic risk. To avoid exposure to an economic risk, a company would want to avoid entering an economy where it was anticipated that the currency might weaken. Obviously, over an extended period of time, currency values will tend to ebb and flow, thereby making such an approach difficult. Notwithstanding this fact, in the short term, the following factors might all indicate that a weakening of the currency was likely. High inflation in country A relative to country B would indicate that the currency of country A would weaken relative to B. This phenomenon can be used to estimate future rates, and the exchange rate in 1 year's time can be calculated as the spot rate multiplied by 1 plus the inflation rate in the foreign currency and divided by 1 plus the inflation rate in the home country. This is referred to as purchasing power parity. For example, if the spot rate is $2 to the pound, US inflation is 5% and UK inflation is 3%, the expected rate in 1 year is 2 multiplied by 1.05 divided by 1.03, which equals approximately 2.04. As discussed in the circular flow of income presentation, high inflation rates often lead to high interest rates, and the latter is another indicator that a currency may weaken. Further, interest rate parity theory can be used to calculate forward rates, covered later, in the same way that purchasing power parity is used to predict future exchange rates. The difference between the two is that whilst the latter uses inflation rates, the former uses interest rates. Finally, a balance of payments deficit, the situation where imports are higher than exports, or high government borrowing, are both indicators that a country is not doing well and could result in its currency weakening. Managing transaction risk. There are broadly two categories of risk management, and these can be thought of as internal, i.e. the company can achieve on their own, and external, i.e. the company will use derivatives and other financial products. Internal approaches for an exporter receiving foreign currency include trading in your domestic currency. This does not remove the risk, however, it does transfer it to your customer. The ability or otherwise to achieve this is dependent upon the relative bargaining power of the two parties. Leading. This refers to encouraging your customer to pay more quickly so that funds can be received and exchanged before rates change too much. Lagging. This involves delaying the exchange of monies received in the hope that the exchange rate will move in your favour. Netting and matching involves creating payments in foreign currencies so that monies received do not need to be exchanged. External approaches include forward contracts, money market hedges, and futures and options, and these are discussed in more detail below. Forward contracts are an agreement to buy or sell a fixed amount of currency on an agreed date at a rate that is agreed now. They work in exactly the same way as an exchange at spot. However, there is usually a larger spread between the buy and sell rates quoted. They are easy and quick to arrange, are available in many currencies, and available for more than a year ahead. Conversely, they are non-cancelable, have to be honoured on a specific date, and the rates quoted may be unattractive. A money market hedge involves buying or selling the currency relating to the transaction now at spot so that the exchange rate achieved is known. More specifically, for a currency receipt, the process is as follows. Borrow an amount of foreign currency today equal to the amount due to be received less the interest that will accrue on the borrowing. Use the currency borrowed to buy domestic currency at spot and deposit the domestic currency acquired for the period up to the date for the receipt of the transaction currency. This will earn interest to offset part of the cost of the currency borrowing. The net receipt under both approaches should be very similar. A future is a derivative product that is separate from the business transaction giving rise to the risk. If a business is expecting to receive an amount of foreign currency in the future, this will be converted at the prevailing rate at that time. The risk is that they will not know what the exchange rate will be and therefore the domestic equivalent of the currency. The company will be concerned that if the foreign currency weakens, the effective receipt in its domestic currency will fall. To offset this, the company will enter into a separate futures contract to buy domestic currency in the future. This contract is set up in such a way that the company will benefit if the foreign currency weakens. The net effect is that a loss on the transaction is offset by a gain on the future and vice versa. The company will need to deposit funds when they buy the future to cover any losses that may arise. Options are very similar to futures. However, the company has an option whether or not to exercise the contract. This means that they will use gains on the option to offset losses on the transaction, but will ignore the option if the transaction shows a gain. This approach allows the company to avoid the downside while still benefiting from any upside. However, a premium is paid to obtain an option, and this may make it an expensive option. Thank you.
Hello. In this video we'll be considering how organisations can manage their foreign exchange risk. Steps taken to reduce or eliminate a company's exposure to foreign currency risk is known as hedging. Initially, let's be clear how an exchange rate works. An exchange rate is simply the price of one currency in terms of another. A spot rate just means the rate of exchange right now. For example, a spot rate of exchange of $2 to £1 means that £1 sterling has an equivalent value of $2. This means I could exchange £1 for $2 or $2 for £1. Banks will do this for us for a charge. They make their money by offering us a different price for buying as opposed to selling. A shopkeeper does exactly the same thing. They might buy a tin of soup from their supplier for 75 cents and sell it to their customer for $1. They make 25 cents profit every time they then buy and sell a tin of soup. Banks offer what is known as a spread. This just means two prices, a buy and a sell price. For example, they may offer a spread of 1.3 euros to 1.25 euros per dollar. This means if they're buying dollars, they will only pay 1.25 euros, but they'll sell dollars to you for 1.3 euros. Often it's tricky to decide which is the right price to use. Remember this golden rule. Always pick the worst rate for you. That's because it's the best rate for the bank, and the bank always wins. The worst rate for you means if you're selling currency, you'll get the smallest amount back, and if you're buying currency, it costs you the most. If I am an American and I export to Europe, and my European customer owes me 1 million euros, suppose the exchange rate when they pay me is 1.25 to 1.3 euros per dollar. When my European customer pays me, I will need to divide by either 1.25 or 1.3 to work out how many dollars the bank will give me when I sell them the euros. If I divide by 1.25, this would give me 1 million divided by 1.25 equals $800,000. If I divide by 1.30, this gives me 1 million divided by 1.3 equals $769,231. This is smaller than $800,000, so the 1.3 is the worst rate for me, and this is the one that the bank will give me. If we made our sale on credit, the spot rate of exchange will probably move between the point of sale and when the customer pays. So unfortunately we cannot guarantee what the dollar value of that receipt will be. Now let's consider ways of trying to remove our exposure to that fluctuating spot rate. There are some simple ideas, sometimes known as internal hedging techniques, so called because external contracts are not used. Firstly, as an American exporter, we could invoice customers in US dollars. We therefore won't be exposed to any foreign exchange. Unfortunately, all you're doing here is passing the risk 100% onto our customer. Our European customer will have to pay a certain number of dollars when they settle their bill. As the spot rate moves, the amount of euros this will cost them will fluctuate. The customer may choose to buy from elsewhere if we impose this risk upon them. Secondly, netting and matching. If we export to Europe from America and also import from Europe, then we only need to worry about the net position as we are matching incomes with expenses here. If the exchange rate moves against us on the receipt, it will move in our favour on the payment and vice versa. Netting can be considered at a group level. One subsidiary could export to Europe and another subsidiary could import from Europe, and even though they are each individually exposed, only the net group position needs to be considered. This overall view can be compiled by a group treasury function. This is convenient if possible, however having receipts and payments relating to the same foreign location may be unlikely. Next, let's consider leading and lagging. Leading means paying early, and lagging means paying late. Suppose we're an American exporter who have a customer in Europe who's due to pay us in 2 months' time. If we also happen to have a European supplier that we're due to pay in 3 months' time, we may choose to lead and pay the supplier in 2 months' time to match the timing of the receipts from our customer. This means the movement in the spot rate between the point of sale and the point of payment will be the same, as we are ensuring we pay our supplier at the same time as we receive money from our customer. However, paying suppliers early is bad news for our cash flow, and paying them late is bad news for our supplier relationship. Let's now consider some external hedging techniques. These involve contracting with third parties to help manage our risk. We'll consider forward exchange contracts, money market hedges, and the use of derivatives such as futures and options. A forward contract is a contract agreed with the bank to exchange a certain amount of foreign currency for a specified rate on a specified date. These are common in practice because they are easy to arrange. It's a conversation with the bank, and it gives certainty. From the moment the contract is signed, you know exactly what the exchange rate is going to be relating to that future transaction. The banks will quote a price when you go to see them to arrange the contract. This might look like a spot rate, for example 1.25 to 1.35 euros per dollar. Forward rates also have a spread like spot rates do. Only the difference between the two prices is larger than the spot rate, as the bank extracts more compensation for the administration of the contract and the risk they take on. The spot rate may be different from the forward rate when the contract is executed. Alternatively, the forward rate may be quoted as an adjustment to the spot. For example, today's spot rate may be 1.25 to 1.35 euros per dollar, with a forward adjustment of 0.3 to 0.2 cents premium. Firstly, a premium needs to be deducted from the spot rate and a discount needs to be added on. You might like to remember this using addis, add a discount. This might feel counterintuitive, but the reason we deduct a premium is that as the currency is at a premium, you get less of them to the dollar. So the forward rates implied by this forward adjustment would be calculated as follows. So we've got spot rates of 1.25 and 1.35 euros per dollar. We then deduct the forward premium of $0.003 and $0.002 to give us forward rates of 1.2470 and 1.3480 euros per dollar. And again, pick the worst rate for you. If I'm selling euros, I'll divide by 1.3480 to work out how many dollars I'll receive. And if I'm buying euros, I'll divide by 1.2470 to work out how many dollars I'll need to pay. Forward contracts fix the rate for us, but they are a binding obligation and therefore unavoidable if, for example, our customer defaults. And they're tailored to us. We are a named party in the contract, as is the bank. They therefore offer no flexibility and the contract can't be sold on. Another external hedging technique is a money market hedge, sometimes known as a synthetic forward. The reason we're exposed to spot rate movements is that cash is going to cross borders at some point in the future as opposed to today. We can eliminate risk by borrowing the money now and crossing borders today instead. This is perhaps easiest to see by talking through an example. I am a US exporter and I've made a sale to my European customer. They are due to pay me in 3 months' time. Suppose the current spot rate is 1.25 to 1.35 euros per dollar and interest rates in the two locations are as follows. We have US and European borrowing rates at 4% and 5% and lending rates or deposit rates at 2% and 3% per annum. These rates are generally quoted on a per annum basis in questions. Now let's suppose the value of the sale is 1 million euros. Let's work through a standard diagram to help us. On this diagram we have the US and Europe across the top and then a timeline down the side, now and in 3 months' time. Starting with the end in mind, we'll receive 1 million euros in 3 months' time. We would love to bring that money across border today, but we haven't got it. That's okay, we can borrow the euros to bring it back. Unfortunately, the amount we borrow will have to be less than 1 million euros because the amount we borrow will accrue interest charges over the 3-month period. The European borrowing rate is 5% per year, or 5% divided by 4 equals 1.25% for the 3 months. So we'll discount the 1 million euros by 1.25%. So this means we need to borrow 1 million euros divided by 1.0125 is 987,654 euros. This will then grow into a 1 million euro liability that we can pay off with the 1 million euro receipt from our customer in 3 months' time. We then bring back the money we've borrowed to the USA at today's spot rate. The worst rate for us is to divide by 1.35 to give us the smallest number of US dollars in our hands. This gives us $731,596 today in the USA. To get a comparable dollar amount for our receipt in 3 months' time, we assume that the US dollars are put on deposit in the US. This will earn us 2% per annum or 0.5% for the 3-month period. We therefore end up with $735,254 in 3 months' time. This means we have achieved for ourselves an effective exchange rate of 1 million euros divided by $735,254 or 1.3601 euros to the dollar. A similar approach can be used to hedge payments to an overseas supplier rather than a receipt from an overseas customer. The only difference is that the money would be borrowed in the US and sent over to Europe to put on deposit there. This deposit would then be used to pay the European supplier in 3 months' time. Money market hedges are often used by banks and in many ways achieve a similar result to a forward contract, perhaps with a bit more flexibility. However, they require management effort to set up overseas deposits and loans, which may not be easy in all cases. Derivatives can be used to help reduce or eliminate foreign currency risk. We'll consider futures and options here. You should note that numbers are not examinable, only an overview is required. Firstly, futures. Suppose we know we have a foreign currency receipt in the future. We can effectively agree right now a rate with the futures market. We need to pay a deposit to an exchange in order for this to happen. When we receive the money from our customer, we would exchange that at the prevailing spot rate. However, the futures market will compensate us if we make a loss due to adverse movement in the spot rate. Similarly, if the spot rate moves in our favour, the futures market will take that gain away from us. In effect, the futures market acts like a counterbalance on a seesaw. The net effect is a fixed outcome, as gains and losses due to movements in the spot rate are effectively removed by the futures market. Futures give some date flexibility. For example, September futures can be used at any time up to the end of September. So if the customer pays a little late, this can usually be accommodated. However, futures are only available in large standard contract sizes, and a deposit needs to be made and potentially topped up if the futures contract is building up losses in the run-up to the customer paying their bill. Futures can be used equally to hedge payments as well as receipts. Next, options. An option gives the buyer a right, but not an obligation, to buy or sell something at an agreed price. An option to sell is called a put option, and an option to buy is called a call option. So, for example, an option to sell euros would be known as a euro put option. If the price agreed in the option, known as the strike price or exercise price, is better than the spot rate when the customer pays, then the option will be exercised and the holder of that option will receive the agreed exchange rate in the option, the strike price. If, however, the spot rate is more favourable than the strike price in the option, then the option can be abandoned and ignored. The holder of the option can then use the more beneficial spot rate. There is a price to pay for this flexibility. An option only seems to have upside potential for the holder and no downside. The seller of the option charges a premium at the start that's non-refundable, a bit like selling an insurance policy. An option, if it's exchange traded, gives date flexibility like a futures contract does, and it has upside potential with no downside risk. It's also useful for transactions if they aren't definite. For example, if we tender for a contract, we could hedge the offered tender price using an option that we could then just abandon if we fail to win the tender. However, exchange traded options like futures are only available in large standard size contracts, and the option premium makes them very expensive. Last but not least, something a little different. Suppose we invest in a foreign subsidiary. This means we'll have a foreign currency asset on our statement of financial position. As foreign exchange rates move, then the value of this asset will increase or decrease due to movement in that spot rate. If we finance this investment with a loan also denominated in that foreign currency, this will cushion our exposure. As the value of the asset increases, so will the value of the liability, and similar for a decrease. In summary, there are many ways of reducing or eliminating foreign currency risk, and each has its own advantages and disadvantages. The treasury function of the business will need to decide what's most appropriate in the circumstances.
Hello. In this presentation, I'm going to look at interest rate risk, both in terms of what it is and how companies might protect themselves from its effects. It is also worth noting that there are many crossovers between the risk management techniques described here and those discussed in the exchange rate risk presentation. Accordingly, it may be beneficial to watch that presentation first if you have not already done so. Specifically, this presentation will cover types of interest rate risk, the yield curve and how it can help companies determine their approach, internal solutions, forward rate agreements, and futures and options. Let's look at each of these in turn. Types of interest rate risk. The interest rate determines the amount of interest paid on borrowings and the interest received on deposits, and can therefore have a significant effect on the performance of an organisation. This presentation will focus on loans being taken out, i.e. interest being paid. However, the same principles could equally be applied to deposits. The following risks need to be considered. 1. If an existing loan has a variable or floating rate of interest, this can lead to the amount of interest paid changing throughout the period of the loan. 2. If a company is planning to take out a loan in the future, even if this is at a fixed rate, the interest rate and therefore the profit impact can change between the decision and the loan starting. 3. Interest-bearing assets and liabilities may not move in line with each other. This is known as basis risk. And 4. Interest rates on assets and liabilities may change at different times. This is known as gap risk. The last two aspects are mainly relevant to banks and are not considered in detail here. However, we will now look at the first two in more detail. The yield curve and how it can help companies determine their approach. The term structure of interest rates looks at the yield on bonds and how this varies with the maturity of the bond. It is usually based on government bonds and enables companies to establish a view as to the likely movement in interest rates. As can be seen from the graph, a normal yield curve is upward sloping, indicating that loans get more expensive the longer they are. The precise shape of the curve is governed by three separate theories. 1. Liquidity preference theory states that investors like to hold cash, and accordingly, the longer the period they are asked to give that up, the greater the compensation they require. This explains why the curve is upwards. 2. Market segmentation theory explains that loans of different maturity are obtained from different segments of the market with different expectations. This explains why the graph is a curve rather than a straight line. And 3, expectations theory reflects expectations as to future interest rates. This reflects the angle or slope of the line. For example, a steep sloping curve would indicate an expectation that rates will rise. Internal solutions. Companies will often adopt an approach known as smoothing in an attempt to manage the interest rate risk on current borrowing. This refers to holding an appropriate mix of fixed and variable rate debt. The fixed rate provides protection from adverse rate movements, whilst a variable rate still allows them to benefit if the rate moves in their favour. It is important to remember that risk simply refers to a variability in the possible outcomes. As such, there is an upside as well as a downside risk. In determining what an appropriate mix is, companies will take into account both expectations as to what future rates will be and the impact that rate movements will have. For example, if a company has relatively low levels of debt, they may be willing to use a bigger proportion of variable rate, as an increase may not prove too costly. A company wishing to change the proportions may consider entering into a swap arrangement, an agreement whereby two companies pay each other's interest rate liabilities. This aspect is not covered further in this presentation. Forward rate agreements. A forward rate agreement, or FRA, enables a company to fix the interest rate it will pay or receive on loans it is planning to take out in the future. It is very similar in terms of what it achieves to the forward contract described in the exchange rate risk presentation. However, the mechanics as to how it achieves the outcome is very different. The major difference is that the FRA is a separate contract from the loan itself, i.e. the FRA is not a loan. An FRA fixes the rate of the loan and is shown as follows. So £10 million, 4 to 7 FRA at 6%. In this example, the interest rate on a 3-month £10 million loan, starting in 4 months' time and finishing in 7 months' time at 6%. If in 4 months' time the rate applicable on the actual loan is higher than 6%, the company will receive compensation from the FRA equal to the actual rate minus 6%. Conversely, if the actual rate is less than 6%, the company will pay compensation. Either way, the effect is that the combination of the interest rate on the loan and the compensation paid or received on the FRA fixes the rate at 6%. Finally, it should be noted that the FRA rate refers to the base rate or LIBOR. Companies will borrow at a premium above LIBOR based on their credit rating. For instance, in the above example, a company who can borrow at LIBOR plus 1% will fix the rate at 7%, being the 6% quoted in the FRA plus the 1% premium. Futures and options. Futures and options are derivative products and they work in a very similar way to that described in the exchange rate risk presentation. A future is exchange traded, which means it is only available in set contract sizes, for example blocks of £500,000, and so it may not be possible to exactly hedge the loan being taken out. A future is similar to an FRA in that it is separate from the loan it is protecting, and the process is as follows. A company plans to take out a loan in the future and will take out that loan at the prevailing rate at that time. Separately, the company will sell interest rate futures, i.e. a commitment to pay interest in the future. When the loan starts, the company will close out the futures by buying contracts, i.e. a commitment to receive interest, simply the opposite of the original futures position. If interest rates have increased between the decision to take out the loan and the loan starting, the loan will have become more expensive than anticipated. However, if the rate has increased, the company will be receiving more interest on the futures bought than it is paying on the futures sold. This gain on the futures offsets the loss on the loan. If interest rates decrease, the opposite happens, and the loss on the futures offsets the gain on the loan. Either way, the effective rate when the two aspects are combined is fixed. A company taking out futures will be required to deposit funds, called paying a margin, to cover any losses that may occur on the futures. The margin will also need to be topped up if losses increase, but is returned to the extent that it is not needed. An option works in exactly the same way, but with one important distinction. Under an option, the holder can decide whether or not to exercise the option. This means that if the loan cost has increased, the company will exercise the option, thereby benefiting from the gain and reducing the effective loan cost. Conversely, if the loan interest has decreased, the loss on the option will be ignored. Accordingly, an option enables the company to cap the rate of interest payable at a maximum while still being able to benefit if the rate goes down. Whilst this is obviously very attractive, options have to be purchased, i.e. a premium is paid, and this can make them expensive. Thank you.
Hello. In this video, we will consider some of the techniques available for managing interest rate risk, including matching and smoothing, asset and liability management, forward rate agreements, also known as FRAs, and derivatives. Derivatives, the use of futures and options to help manage interest rate risk, is a discursive topic only. No numbers will be set on this in the exam. Firstly, let's consider matching. Suppose I'm a bank and a customer has come to see me to ask about a mortgage on a property. If that customer would like a variable rate mortgage, in other words, the interest rate will go up and down in line with market rates, the bank's income will vary depending on what the prevailing rate is. It might be sensible for the bank to finance this mortgage by taking out a variable rate loan itself. If the bank were to do this, then as interest rates rise in the market, then as income from our customer rises because we charge them more, our own finance charges will rise similarly. This means the bank's profit, the difference between income and expenses, will stay approximately the same. For example, suppose the bank agrees the mortgage with their customer and the variable rate of interest at that point is 5% per annum. And the bank manages to finance that mortgage by obtaining a loan from elsewhere at a variable rate of 3% per annum. The initial profit of the bank will be 5 less 3 is 2%. If, let's say, interest rates on the market rose by 1%, then this would mean the income from the customer would increase from 5 to 6%, and the interest we have to pay to finance that customer would increase from 3 to 4%. The bank's income is still 6 minus 4 or 2%. This protects the bank's exposure to increases and decreases in interest rates. If the customer had originally asked for a fixed rate mortgage, the bank could then finance this with a fixed rate loan, so that the bank's income and outgoings would stay the same no matter what happens to interest rates. In other words, the bank is matching variable rate assets with variable rate liabilities and matching fixed rate assets with fixed rate liabilities. Next, let's consider smoothing. If a company uses nothing but variable rate loans, then the interest that it pays will rise and fall in line with what happens with variable rate interest rates. This makes interest rate costs relatively volatile. An alternative would be to use all fixed rate loans, which eliminates the volatility, but there's no benefit to the company from a drop in market rates. The company may decide to use a mixture of both fixed and variable rate loans. Suppose it uses 50% fixed and 50% variable. Interest payments still vary with changes to the variable rate, but it's smoothed by having a proportion of the debt as fixed rate. The company can decide what proportion it would like. The more heavily weighted it is towards fixed rate finance, the flatter this line will become. Assets and liability management considers the nature of projects and the cash flows associated with them, and seeks to match the nature of those cash flows with the nature of the finance. For example, if a project is likely to generate very stable cash flows, it makes sense to match this with stable outgoings.
In other words, finance it with a fixed rate loan. Matching, smoothing and asset and liability management are all examples of internal hedging techniques. In other words, external contracts are not used specifically to manage interest rate risk. A forward rate agreement, or FRA, is an example of an external hedging technique. An FRA is separate from the loan, but acts as a top-up payment or receipt. Suppose it's the 1st of January, and as a result of doing our cash flow forecasting, we see we need a $5 million 6-month loan in 3 months' time. Even if we were to fix the rate on that loan when we sign it in 3 months' time, we couldn't say now, on the 1st of January, what rate we'll get when we fix it. This is where we can use an FRA to help us. The bank offers us a $5 million 3 to 9 FRA at 5%. The 3 to 9 refers to the number of months until the loan starts from today and the number of months from today until the loan finishes. So a 3 to 9 FRA describes a 6-month loan due to start in 3 months' time. This FRA is guaranteeing a base rate of 5% for the loan. When we sign the loan in 3 months' time, suppose the base rate is 5.75%. When we sign the loan, we'll pay the base rate of 5.75% on the loan itself, but the FRA will pay us 0.75%. So overall we pay a net of 5%, which was the base rate we agreed to in the FRA. The quid pro quo for this, though, is that if, suppose for example, the base rate drops to 4% by the time we sign the loan agreement at the end of March, we'll pay a base rate of 4% on the loan itself, but we'll have to pay an extra 1% under the FRA. Again, this equates to a total payment of 4 plus 1 is 5%. In other words, in coordination with the actual loan we take out, the FRA is guaranteeing us an overall base rate of 5%. FRAs guarantee us a rate, but they're a binding obligation. If rates drop in the intervening period before we sign the loan, we're forced to pay under the FRA. Equally, if circumstances change and we actually don't need the loan, the FRA remains in place and will be obliged to pay if rates drop, albeit we'll have a receipt if they rise. It's worth noting that a saver or lender can also use an FRA that will pay them compensation if rates drop, and they'll have to pay out under an FRA if rates rise. In other words, the net rate is protected. A saver is described as selling an FRA, whereas a borrower is described as buying an FRA. Futures contracts can also be used to act as a counterbalance against movements in interest rates. They work on a similar principle to that explained in relation to foreign currency risk management. Following from our earlier example, a rate is agreed with the futures market when it's forecasted that we'll need to borrow in the future. So, if on the 1st of January we realise we'll need to borrow $5 million on the 1st of April, we can agree a rate for the loan that we'll sign on the 1st of April on the 1st of January with the futures market. At that point, on the 1st of January, we'll need to pay a deposit to the exchange. If by the time we get to the 1st of April rates have risen, the futures market will compensate us for the increase in rate. If the rate drops, we'll need to make up the difference and make a payment to the futures market. In many ways, the outcome appears to be similar to that of an FRA. However, FRAs relate to a particular date when the loan will be signed. You get some date flexibility with futures. For example, a March future can be used on any day up to the end of March. However, futures are standardised contracts and relate to a fixed amount of borrowing for a fixed period of time. For example, one futures contract might relate to a $500,000 loan for 3 months. If we wanted to borrow $1 million for 6 months, we'd need 4 futures to cover the amount of interest. We would need to double up for the amount and double for the term. Due to standard contract sizes, you may not be able to get an exact match for your needs. You may end up being over or under hedged. In addition, the deposit you need to pay up front may need to be topped up if it looks like losses are accruing in relation to your futures. The exchange will not take credit risk. In other words, if you run up losses, you need to pay them as you go. This presents a liquidity disadvantage, therefore. Cash outflows even before you sign the loan. Options operate very much like futures, except there's no downside other than a premium that needs to be paid at the start. As a result of paying the premium, if rates in general drop in the run-up to you taking out a loan, you get to keep the low loan rate and you won't have to pay out under the option. In similar circumstances, if you'd used a futures hedge, the low rate would effectively be taken away as you have to pay out losses under the futures arrangement. However, if rates rise, you pay out more for the loan you sign, but you receive compensation from the options market. This means you can benefit from a drop in rates if you're a borrower, but are protected from an increase in rates. However, the price you pay is a premium as the hedge is set up. A short note on terminology. A borrower would hedge potential borrowings using a put option or selling futures. A saver or lender can also use derivatives to hedge against interest rate movements. They'll be concerned about a fall in rates, as this will reduce their income. They will hedge this position by buying futures or using a call option. In summary, internal hedging techniques can be used to mitigate interest rate risk, such as matching, smoothing, and asset and liability management. External techniques can also be used, forward rate agreements and futures and options. Remember, in your exam, futures and options are not examinable numerically.
In this video, we consider the nature and type of risk that exists in organisations and approaches to risk management. This is a very broad topic and is almost a subject in its own right. We'll therefore restrict our discussion here to what is examinable in the F9 paper. First of all, let's distinguish between risk and uncertainty. Risk concerns known possibilities or outcomes and known or estimable probabilities. The benefit is that we can therefore do some calculations to help us assess the risk. For example, the risk associated with tossing a coin. There are 2 possible outcomes, heads or tails, and a 50-50 chance of each. With uncertainty, either some of the probabilities are not known, or potentially some of the possible outcomes are not known, or maybe a mixture of the two. When starting out on a new venture, you may have no real idea how likely it is to be successful. This is uncertainty. Although this distinction may be important for a multiple choice question in your exam, the terms risk and uncertainty are often used interchangeably in everyday language. Strictly speaking, risk can be upside or downside. Upside risk is the chance that something good might happen, as opposed to downside risk, which is the chance that something bad might happen. That said, the word risk often has a negative connotation associated with it, so it's often taken to mean the negative or downside. It's worth noting that risk management is not the same as risk minimization. At some point, a company's investors decided to invest in the company, which implies taking a risk with the hope of making a return. Inherently then, business cannot be about simply minimizing risk. This would imply never setting up in business in the first place. That said, risk must be managed to make sure that risk that is purely downside is eliminated where possible, and the remaining risk is managed to a level that's acceptable to investors. Different decision makers may have a different attitude to risk. A risk-averse decision maker focuses on the downside
and makes the decision that ensures the downside is the best it can possibly be. It's an inherently pessimistic outlook, as the risk-averse decision maker is assuming downside will occur. A risk-seeking decision maker will consider potential upside and choose options where that upside is high. This is an inherently optimistic view, as it doesn't consider the downside risk may result. The risk-neutral decision maker will make their decision based on the balance of probabilities, without focusing particularly on positive or negative outcomes. Risk comes in various different guises, and many frameworks are available to distinguish between different types of risk that the company may face. Simpler frameworks may consider, for example, strategic, financial and operational risk. Other frameworks can become much more complex. There are also frameworks to assist an organisation with managing the risks that they identify. However, this is a topic that is examinable elsewhere. There are two particular aspects of risk and risk management that our examiner focuses on: foreign currency risk and interest rate risk. In the remainder of this video, we'll examine the nature of this risk. We'll consider how managing this risk can be undertaken in other videos. First of all, foreign currency risk. Foreign currency risk includes the way we are financially affected as a result of movements in exchange rates. An exchange rate is simply the price of one currency in terms of another. So, for example, an exchange rate may move from $1 to £1 to $1.30 to £1. This would mean that anyone who exports from the USA to the UK used to get $1 for every pound of export revenue, whereas they are now getting $1.30 for every pound of export revenue. Foreign currency risk can be one of three types: translation risk, transaction risk, and economic risk. Suppose we are based in the USA and we sell something to someone in the UK. If we give our UK customer 3 months credit and we're invoicing them in sterling, we don't know how many dollars that sterling is going to be worth when they pay in 3 months' time. That's because the exchange rate will move between now and then in a way that we can't predict with any certainty. This is known as transaction risk. It directly affects the cash flows of the business. We will end up with more or less dollars as a result of transaction risk. Now, suppose we have a financial reporting deadline, such as the year end, 1 month after we make the initial sale. At the year end, we will have a foreign currency receivable on our statement of financial position, being the amount that our UK customer owes us at that point. This receivable would need to be retranslated at the exchange rate prevailing at year end, and any movement between the point of sale and the year end in that exchange rate will therefore result in a profit or loss due to foreign exchange. This is known as translation risk and will affect reported profits. Although exchange rates fluctuate constantly, they often follow a long-term trend that's consistent with the changing economic circumstances of the two countries in question. These long-term trends can fundamentally affect the value of our business. For example, if we constantly make sales to the UK from America, then the value of each individual sale will go up or go down in value depending on the direction of the exchange rate movement at the time. However, over time, there may be a long-term trend, which means fundamentally the value of my business gradually increases or decreases because of that direction of movement. This is known as economic risk. We may face economic risk even if we don't sell overseas, as it may affect our input costs or our competitors' pricing. Interest rate risk is an increase or decrease in our profitability due to movements in interest rates. A simple example of this is a company with a variable rate loan. If that variable rate increases, interest payments will increase. If the variable rate falls, then interest costs will fall. Gap exposure occurs if the company has a different amount of interest-bearing assets and liabilities. The net exposure will generate an impact on profit when interest rates move. Basis risk occurs when interest-bearing assets and liabilities vary with reference to a different interest rate source. For example, interest rates on savings that are based on LIBOR, the London Interbank Offered Rate, may move at different times or by different amounts to liabilities that may be based on, say, Euribor, the European equivalent of LIBOR. Again, this means that company profits will be exposed as the interest rates move at different times or by different amounts. In summary, risk is essential in business, but it needs to be managed to maximise returns for a controlled level of risk. Risk management is a large subject area. However, our examiner only touches on a relatively small part of risk management, essentially interest rate risk and foreign currency risk.